Where were you last few days? Are you did the mock? How was it? Got the scores? What's wrong with this? Why isn't this working? So guys, how's it going? All okay? Everyone? Good morning. Good morning. Why isn't this open? Good morning, everyone. Can you please change that app because it's not downloading? Can you change my iPad? Okay, so we are navigating towards the last part of our session, and today we planned originally to do what did we plan to do? We planned to do IAS 41 biological assets, and then we had to finish off fair value. Correct? We had to. I'm unable to download this thing. This doesn't downloading this iPad. I think the problem with the server is not down. Something went wrong. I keep getting that. That's not my. Actually, that is. It has to come on a Premier Partners 1, 2, 3, 4. So, do you have another iPad? Which has Premier Partners 1, 2, 3? Hi guys, how's it going? All okay? So today the plan is very simple. We'll be looking at IAS 41 biological assets. So you can go to your notebook, say IAS 41 biological assets. IAS 41 biological assets, and then we will be also looking at some questions. We'll be looking at some questions. Did you go home and check the question that we did? Were you able to check the question that we did? No? Yesterday's question? No? You're not able to check? No? Why? Ratios. Did you understand the ratio questions that we did yesterday, guys? Because that's a bigger part of our syllabus and you have to be very familiar with it. Sorry? Yeah. Ratios are tested, a primary area. Your examiner continues to say that ratios will be tested in every exam session. So it's a big primary area. So, yeah, there you go. We are getting into our final area, but I see a small issue with my camera. So let me fix that. Give me a moment. Anyway, you can go to your notebook and say IAS 41 biological assets. IAS 41 biological assets. IAS 41 biological assets. Guys online, am I clear? Guys online, am I clear? Okay, so you can now see me. Okay, perfect. Okay, IAS 41 biological assets. IAS 41 biological assets. Okay, now guys, uh, this particular standard covers biological assets. Now, what are biological assets? Biological assets are living plants and animals. So the standard covers something called assets, but living plants and animals. So go to your notebook and say number one, biological assets. Below that, biological assets are living plants and animals. Biological assets are living plants and animals. Biological assets are living plants and animals, which are held for, which are held for, which are held for. Biological assets are living plants and animals, which are held for biological transformation, which are held for biological transformation, which are held for biological transformation, which are held for biological transformation. Number one. Okay. Below that, number two, agriculture, 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 agriculture. Say this refers to the management of, this refers to the management of biological transformation. This refers to the management of biological transformation. This refers to the management of biological transformation. For the purpose of, for the purpose of, for the purpose of for the purpose of sale, comma, for the purpose of sale, reproduction, comma, creating additional biological assets, or harvesting agricultural produce from that asset, or harvesting agricultural produce from that asset. Or harvesting agricultural produce from that asset. Okay. Now, what did I say? Number one, biological assets. Number two, agriculture. Number three, agricultural produce. Number three, agricultural produce. Number three, agricultural produce. Mohammed Shan, this is your first class, is it? I have not seen you before. Mohammed Shan. This is the first time are we meeting? Where have you been all these years? Agricultural produce. Say, this means, this refers to, this refers to the output, this refers to the output of the biological assets. This refers to the output of the biological assets. This refers to the output of the biological assets. Okay, so let's try to understand what this is. Okay. Have you been a recorded student? Have you been following the recordings, Sean? Okay. Where are you in terms of the recording? Are you okay? In terms of the recording, are you okay? Right. Guys, we are looking at biological assets. Biological asset means, guys, like I told you, living plants and animals. It can be goat, it can be wolf, it can be crocodile where we get leather from, whatever. Apple trees, living plants and animals. Sheep. So guys, this particular standard, biological assets, cover living plants and animals. Living plants and animals. Are we clear? Super. Now, my dear, these living plants and animals, for example, you take sheep. Sheep's output will be wool. Sheep will give you wool, correct? So the direct output of these living plants and animals are known as agricultural produce. What they produce is known as directly agricultural produce. So when you take living plants and animals, when you take living plants and animals will result or will give us directly agricultural produce. Agricultural produce. In other words, the output of these living plants and animals are known as agricultural produce. Are we clear? Are we clear? Super. Now, my dear, these biological assets, which we call as living plants and animals, they go through a biological transformation. Animals will go through a biological transformation. The biological transformation is the production, that is the generation, growth and degeneration of living plants and animals. Now these biological assets will die, obviously. All of us will grow, will reproduce, correct? Now these activities where there is growth, generation and degeneration is known as biological transformation. Biological transformation. So biological transformation is the process of generation, growth and regeneration. In other words, when someone manages this generation, degeneration and growth, it is known as agriculture. In other words, when someone manages this, oh, what happened? What the hell did I do? Where did this come from? Are okay, take it easy. So when someone comes in and manages this, the commercial management of generation, degeneration and growth, the commercial management is known as agriculture. The commercial management is known as agriculture. So the standard IAS 41 gives us guidelines, number 1, for biological assets, that is living plants and animals, and number 2, agricultural produce, that is the direct output by the animals. Are we clear? Guys online, 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 everyone, are we clear? Now, how does this work is, guys, very simple. Okay. Now, it works in a very easy way. You have a sheep. Sheep is a biological asset, correct? So IAS 41 is applicable. Why? What is the biological asset? Living plants and animals, correct? The output given by sheep is wool. The direct output is the agricultural produce. Am I clear? The direct output is the agricultural produce, which is wool by the sheep. The direct output will also be covered the direct output cover will be covered by IAS 41. Are we clear? Hello, sir. I'm a student from Shafis's batch who should have sat for exams in last June but wasn't able to. In this manner, revision session. Yes. I'm working through IAS 41 and then I'm getting back to past paper questions. Okay. So how the marathon will normally work is, in the marathon we will do a particular topic normally and then come back and do past paper questions. So don't worry, you should be fine. So you have the sheep. The direct output of the sheep is wool. So sheep is also covered by IAS 41. The output wool is also covered by IAS 41. But with the wool, what you are doing is, you are making a carpet, manufacturing a carpet. So if you are manufacturing a carpet, or if you are manufacturing a jacket or whatever, now we need to understand what is the applicable standard. Now here, number one, sheep, living plant and animal, IAS 41 is applicable. Wool, once again, direct agricultural produce, IAS 41 is applicable. Now you have a product, carpet. What is the accounting standard that is applicable? IAS 2, brilliant, inventories is applicable. Superb. IAS 2, inventories is applicable. The moment it becomes a product, IAS 2, inventory is applicable. You will value the inventory at cost or NRV, whichever is lower. Are we clear? Now look at the process, my dear. The process is, yes, you have an animal, living plant and animal that goes through a process, and then there is output, which is wool. From the wool you produce carpet. That is going to be a product. And now the carpet is held for sale. What is the accounting standard? IFRS 15 revenue. Brilliant. IFRS 15 revenue. Now it is a stream of processes that is happening, and for each and every stream you should know the applicable accounting standard. Are we clear? Understood? Yes or no? Everybody understood? Yes or no? Everybody understood? Okay. Quickly copy this, please. And I'll give you the accounting treatment also. So when I do the marathon, anyway, I will cover the theory also. Okay, it's not that just directly I'll go to past papers. No problem. Rishma, you didn't sit for exams at all, is it? Okay. What were your knowledge level marks? How much did you score? First time student sitting for exams. First time student sitting for exams. First time. First time skills level exams. First time. 1, 2, 3, 4, 4, 5. First time. Okay. Guys, if you're sitting for exams first time, okay, one thing that will happen in the exam is as you enter the examination hall, I know you have a bit of anxiety because this is first time you're going to sit for a skills level exam. Okay, the problem here is as you sit, there will be at least about 50-60 people around you. There will be about 50-60 people around you, and all these guys will start, typing very, very, very hardly with a loud noise. Some students panic. It's normal. So don't panic there. It's normal because you will get a lot of disturbance in terms of typing. It's not like writing. There'll be a lot of disturbance in terms of typing, but you have to be focused in what you have to do. Are we clear? Super. Now, accounting treatment, okay? Let's say accounting treatment, okay? Accounting treatment. Okay, accounting treatment. Say biological assets, are initially recognized. Biological assets are initially recognized. Biological assets are initially recognized. Biological assets are initially recognized at fair value less cost to sell. At fair value less cost to sell. Biological assets are initially recognized at fair value less cost to sell. At fair value less cost to sell. Now guys, what do I mean by biological assets over here? Okay, these biological assets are initially recognized at fair value. Fair value means here market value minus any cost to sell. What are these costs to sell? Any commissions, any transportation cost can be deducted. Are we clear? Number one, that is initial recognition. As at the year end, 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 as at the year end. At the year end, biological assets are revalued to fair value. Are revalued to fair value. Now let's say I have a sheep, right? I have valued it. I have valued it at 100,000 rupees. I have a sheep. I valued it at 100,000 rupees. Okay, guys, you are with me? I have a sheep. I valued it at 100,000 rupees. As at the year end, there was a little accident, and the sheep's leg is a bit damaged. Sheep's leg is a bit damaged. Now I valued it at 100,000 initially, but now there is a damage on the sheep. Now the value of the sheep should come down or go up technically. Come down. The value is going to come down. So as at the year end, I will say, okay, what is the value? 70,000 bucks. Meaning has come down from 100,000 to 70,000, meaning 30,000 loss. People are willing to buy it at only 70,000, meaning 30,000 loss. The standard says is 30,000 loss has to taken to P&L. P&L, directly P&L. As at the year end, any fair value gain or loss, as at the year end, any fair value gain or loss is taken to the statement of profit or loss, Gain or loss is taken to statement of profit or loss, That is for biological assets. Number two, agricultural produce. Number two, agricultural produce. Number two, agricultural produce. Number two, agricultural produce. The standard requires agricultural produce to be recognized that fair value less cost to sell, to be recognized that fair value less cost to sell, fair value less cost to sell. Once again, fair value less any cost to sell. Guys, once you do that, agricultural produce, now you take goat milk, cheese. Milk is the direct output, that's going to be the produce. Cheese is going to be a product, not the produce. Once you get the produce and once you convert it to a product, immediately classify it as inventory. So put an asterisk, put a big asterisk, put a big asterisk. The standard requires the produce to be immediately recognized, classified as inventory. The standard requires the agricultural produce to be immediately reclassified as inventory. Okay, it's a very straightforward accounting standard. Okay, all what you need to know is, my dear, all what you need to know is under that standard, you need to understand, okay, what is biological asset, what is agricultural produce, recognition criteria of agricultural biological assets and agricultural produce. That's it. Are we clear? Okay, superb. We were looking at a past paper question on ratios. And I told you the exam technique to answer ratio questions. Yesterday we looked at a question called SOTAR. Okay, and guys, the technique for ratios is a major part of your syllabus of your exam. You will definitely get ratio calculations in your exam with an analysis, performance analysis and position analysis. Yesterday we looked at an analysis based on cash flows, and the P&L was amalgamated and given to us, correct? And the recommendation as to how to answer ratio analysis question would be this. For example, yesterday we looked at operating profit margin. We compared it for 2 years. We gave a comment. Now, what I did was everything that comes under operating profit margin, I gave it as a point. 1, 2, 3, 4, I gave it as a point. And I told you entirely how to get your 20 marks in the exam. Correct? Okay. Today also we'll be looking at a ratio question plus a consolidated P&L question. And we know we have our mock today scheduled at 2 p.m. So our mock will also replicate something like this, okay? So I'm practicing your Kaplan kit using your study plan. It's working for me perfectly. Is there any way to get study plans for other subjects? Other subjects, study plans, you have to speak to the other tutors. I believe you followed classes with me before. I have not given the study plan for this batch yet. I'll be giving by tomorrow, day after tomorrow, I'll be giving the study plan. Okay. I have a study plan, a 10-day plan that I'll be giving with you, to you as well, as to what areas that you need to focus. I'll give that to you. Okay. Now, today we'll be looking at, as a part of our marathon, we'll be looking at consolidated financial statements, a question there, how to approach it in the exam. Plus, once again, we are coming to ratios. Okay. Superb. I was looking at Gold Co. It's a past paper question once again. It's March, June 2021. Okay, so we're going to see in the exam if we get a question like Gold Co, how we are going to handle it. Okay, super. So let's go back to Gold Co. Okay, now it is a very common question. We've seen these types of question in the exam quite a lot, right? Where we have consolidated P&L and goodwill being tested together. It's a very common scenario, very commonly tested by the examiner. And as you know, Consolidation will also be tested in any part of your syllabus. It can be section A, section B, or section C. It can be tested any part of your syllabus. And ratios will be tested definitely in section C. So we're talking about a good 40% of your syllabus to be covered today in our marathon session. Okay. And as I do the session, I will make sure I go back and I'll take you through some of the theories as well so that you are comfortable. So I'm not just going to take you through the past paper only, but we'll be looking at a bit of theory as well. So I'm not going to promise you that I'll be doing the question under exam timing, because that is not possible if I'm going to take you through the theory. Okay, right. You are in the examination hall. You see, as you go to the examination hall, you see requirement number one: calculate goodwill arising on acquisition. Okay, goodwill at acquisition, meaning everything at acquisition becomes relevant for me. Goodwill at acquisition means everything at acquisition. Everything at acquisition becomes relevant for me. What is goodwill? Goodwill is the premium paid over and above subsidiaries net assets. Okay, you have subsidiary. For you to acquire the subsidiary, you are making an investment, and if this investment is above the net asset value of the subsidiary, you will have goodwill. So the investment cost, when you take goodwill, you are going to invest in a subsidiary. The investment cost can primarily be an immediate cash payment. You're immediately paying cash. You're paying cash to acquire another entity, or it can be a deferred payment. If it's a deferred payment, you're not going to immediately pay, you're going to pay in the future. Or number three, it can be a share exchange. A share exchange means you give your shares and you acquire subsidiary shares. So primarily what your examiner will test you in terms of investment cost will be an immediate cash payment. Number two, a deferred payment. A deferred payment means a payment that you're going to pay in the future. If it is deferred payment, you should not forget to calculate finance cost. With deferred payment, you have to calculate finance cost. And number three, share exchange. A share exchange means you are exchanging your shares. Or number four, a loan note exchange can also be tested in line with IFRS 3 business combination revise. So you need to keep in mind when you take your when you take your investment cost, your investment cost can be primarily of three types. Your investment cost in the exam can be primarily of three types. Number one, your investment cost can be immediate cash payment. Immediate cash payment means you will debit investment, credit cash. Because you are investing, you will have an investment cost that you will debit investment, credit cash. That is number one. Number two, you can have a deferred payment. A deferred payment means you are not going to make the payment immediately, you are going to make the payment in the future. If it is a deferred payment, once again you will debit your investment. You are making an investment, you will debit your investment. You will credit payable, because you are not going to pay now, you are going to pay in the future. Are we clear? Number three, you will have a share exchange. If it's a share exchange, my dear, you're giving your shares and you're acquiring subsidiary shares. You're exchanging the shares. In that case also, you will debit your investment cost, you will credit your share capital, and if you're issuing at a higher price, you will credit your share premium. Are we clear, everyone? Yes or no? Everyone, guys online, are we clear? Are we clear? Primarily, this is tested. So if you're taking goodwill, number one, if you're going to look at goodwill, you will have to know the investment cost. That is number one. Number two, apart from investment cost, you should always keep in mind that certain adjustments for goodwill is very, very, very important. All adjustments at acquisition is important for you. That is number one. Number two, your examiner can confuse you with retained earnings, because retained earnings you need it at acquisition date. So your examiner will play around with you. Now, primarily how your examiner plays around with you is, okay. we have a problem with the pencil. Okay, my dear, what your examiner will do with you is, okay, very importantly, your examiner will say, okay, this is 1st of January 2024. This is 31st of December 2024. That's your full year, no, my dear. But the parent is acquiring the subsidiary at this point. What is this point? Maybe 1st of July 24. Now you have a problem. Now your examiner will give you maybe retained earnings at this point or retained earnings at this point. But you can't use retained earnings at this point or this point to calculate goodwill. You require retained earnings at this point. For that, what you will have to do is you will have to take the profits. You will have to take the profits and you will have to time apportion the profits. Divide it by 12 into number of months, 6 months or 7 months or whatever. And you have to get to this point. From here, if you're getting to this point, you will deduct from your closing retained earnings. If you are planning to come from here, you will add it to your opening retained earnings. Are we clear? Are we clear? Are we clear? Yes or no? No, you did not understand it. Okay, fine. Now you require retained earnings at this point, no, my dear. Okay. For you to get to this retained earnings at this point, there are two ways. Number one, opening retained earnings plus 6 months profit, or closing retained earnings minus 6 months profits. You can't use retained earnings at this point or at this point in the exam. You have to use at this point only. Are we clear? Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Everybody? Yes, 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 yes. Okay. Now, what is our requirement? Our requirement is to calculate goodwill on acquisition. So everything at acquisition is relevant for us, number one. Number two, we got to get our investment cost correctly. Now I'm in the examination hall. I know my theory, what I need. You know it. Number two, prepare the consolidated statement of profit or loss for gold for the year ended 30th September 2012. Okay, in a scenario like this, how would I want you to approach the question is, first do part B and then come to part A. Because when you do part B, you'll be able to spot all the acquisition figures. And based on acquisition figures at acquisition, we are going to do our goodwill calculation. Are we clear? Are we clear? Everyone, are we clear? Everybody, are we clear? Guys online. Okay, superb. Take a good 5 minutes. Take a good 5 minutes and read this question on your own. Read the question on your own. Take a good 5 minutes, read the question on your own. Read the question. So I have been watching the recordings as I missed the live classes. I just wanted to confirm if all the sessions have been covered so far have been uploaded to the LMS. Did they upload yesterday? Yesterday's day for yesterday's Fridays. Just check now. When did you check? Well, the volume of recordings are very, very, very high. So let me get it sorted. Go through the question on your own and give me a done. Once you're done, give me a done. Guys, if you're all done, give me a done. If you're all done, give me a done. I want everyone to give me a done. Chamudi Hajira Haze Kiroshi Janodya, Manisha Shan, Mujahid, Naresh, Rishma. Zara, why are you not here? Done, 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 done. Okay, superb, Rishma. Okay, shall we? Okay, let's look at the question together. Okay, in the exam, I'm in the examination hall. I'm not worried about anything. Okay, very simple. My techniques are going to be the same. What are my techniques? I'm gonna have an easy structure to respond to the question when it comes to consolidation. Okay, now my structure is I'm gonna go to my Excel. Okay, and there you go. That's my question. Gold, go. Okay, so I'm gonna get something like this in the exam, a sheet like this in the exam. I will leave about 40-50 lines. I'll come right to the bottom. I'll say workings. Always in the exam, I'll say workings. I will leave about 40-50 lines. I'll come down, I'll say workings. My workings, my working number one. Always my working number one. Always my working number one. It will not change. It will never change. Working number one is W1 group structure. I need to understand what is the structure of the company. The company structure can have one subsidiary, can have more than one subsidiary, two subsidiaries, or one subsidiary and an associate. That's how it is tested. So you have to be prepared for one subsidiary or two subsidiary, or one subsidiary plus an associate. Okay, now I need group structure. So in the exam, my requirement is I need to finalize my group structure. So I will go back to the question and try to work around the group structure. On 1st January 2012, my year end is 30th September 2012. What does it indicate? What does it indicate? 1st of January 2012, you're acquiring gold, acquired 90%, but your year end is 30th September. Superb. It's a mid-year acquisition. A mid-year acquisition occurs when the parent acquires the subsidiary during the current year. A mid-year acquisition occurs when the parent acquires a subsidiary during the current year. If it's a mid-year acquisition, subsidiaries, incomes and expenses are time apportioned. Subsidiaries, incomes and expenses are time apportioned. Are we clear? Understood? So, well, you have to keep that in mind. Group structure, it's a mid-year acquisition. Okay, going back, gold acquired 90% of the 16 million equity share capital of Silverco. So you have gold acquiring 90% of Silverco. Gold is the parent, silver is the subsidiary, and you have 10% NCI. You have got the structure. You have got the structure. That's all I want you to do initially. That's all I want you to do. I want you to get the structure properly done. That's done. Next should always be line by line addition. I'm going to do my line by line addition. Line by line addition is this. Now, I don't see anything else. I don't see an associate there. Correct. So, if I have an associate, I will put associate. I never know. Maybe down the line, I might have. But here, my group structure is very simple. Correct. So if there is anything that comes down, then I will go and adjust it. I can always go and adjust my group structure. But here, all what I need is my group structure initially with my subsidiary. That is done. Next is my line by line addition. Now to do my line by line addition, it's very simple. Come here. Oops. This is, oh shoot, why did I close that? In the exam, this is exactly how it's going to look like. Hell. Split view. Okay. Now this is eggs. File is already open. Where is it open? It's open here. So let me come here. Split view. Excel. Okay, there you go. In the exam, this is exactly how it's going to look like. Okay, you'll have your question here. You'll have a space to answer here. I'm sure by now you have gone and checked the workspace. If you have not checked, please go and check your workspace through your My ACCA logins. Through your My ACCA logins, you can go and check your workspace. Okay. Right. I'm done with my group structure. Next, it's my line by line addition. Adding the parent and subsidiaries figures together. So there you go. I'm gonna do my consolidated P&L. So I'm gonna say Gold Coast. What's happening? Okay. I'm gonna say Gold Coast consolidated statement of profit or loss for the year ended 30th September 2012. Now guys, you give the heading correctly. You get 1 mark in the exam. For the heading. See how generous your examiner is. Okay, I'll give you time to write. Look here. I want you to focus. Group structure done. You're going back to line by line addition. See, I have not even read the question. I'm getting my structure right. If I get my structure right, it's easy for me to add my points. Okay, right. Revenue. I need my revenue. Now, my dear, I'm acquiring on 1st of January. My year end is 30th of September. How many months? 11 months. Wow, amazing. 9 months. Jan, Feb, March, April, May, June, July, August, September. Okay, I know you know your months. I know that really, really well. But let's sit in the exam and let's do the calculation. I know you're so confident. You'll take 30th September. Okay, 11 months. You'll do the 11 by 12 calculation. That's okay. Say Jan, Feb, March, April, May, June, July, August, September. That's okay. Do that in the exam. I want you to do that in the exam. I know you're confident with your months, but no, that's okay. Let's do it again. One last time. How many months? 9 months. So this is the approach that we're going to take. Equals 103,360 equals 103,360 plus open brackets. Open brackets. Open brackets is very important. If not, you're not going to get your marks. 6,800 into 9 over 12. Are we clear? Number 2, cost of sales. What do I have? Equals 81,920 plus open brackets 41,600 into 9 over 12, close the brackets. Gives you your gross profits. Are we clear? Okay. And then I have my distribution cost. How much is my distribution cost? Now in the exam, don't please go and say, okay, DC, AE. Don't do that in the exams, okay? Please don't do that in the exam. You are professionals and you are going to prepare financial statements. Your examiner doesn't want DC and BC there. You understand? You have to make sure you give your correct, proper name of the line item. You can always copy paste it. In the exam, you have the option to copy paste it. From the question itself, you can copy paste it. Nothing to worry there. So distribution cost. How much is your distribution cost? Equals 2560 plus open brackets 2980 into 9 over 12. Done. What's next? Administrative expenses. Don't say admin expenses. Please use the word administrative expenses. Okay. Equals 6080 plus open brackets 3740 into 9 over 12. 888.5. Are we clear? What's next? Investment income. They say investment income is 800, and then they say finance cost. Finance cost is 672. Now, my dear, in the exam, don't put here minus, don't put here plus, don't do all those. Just take the figures. When doing the calculation, we can take the positive and negative. Just take the figures. Do you understand my point? Just take the figures. Don't give any signs there. Okay. Now that's done. Now what do I have? Profit before tax. Always remember in the exam, to leave a line item here. Always, if there is an associate, you will have associate share of profits to be presented before profit before tax. Just to be on the safe side, associates share of profits. Just to be on the safe side. Sometimes you might have it, sometimes you may not have it. But just to be on the safe side, associate share of profits. If you don't have it, still fine. Okay? Right. Profit before tax, and then we have income tax expense. That's going to be equals 4480 plus open brackets 2560 into 9 over 12. 6400. Are you clear? And then we have group profits, and then we have group profits, and then we have NCI share of profits, and then we will have parents profits. Now this structure you have to put it up. See, I have not even read the question. I do not know the content of the question, but I've got my structure sorted, because it will help me to build my answers. You understand my point, everyone? Are we clear? Yes or no? Everybody clear now? Hurry. Now see, I've got my finances. It's a matter of me working through it. Let's go to the question now. Only now I'm going to read the question. Until this point, my dear, I have not read the question. I do not know what is there in the question. Only now I'm going to read the question. Are we clear? Super. I know right now I have taken the statement. Number two, I know that it's a media acquisition. Now I'm going to go further. I know I require goodwill calculation to be done. Okay. On 1st January 2012, gold acquired 90% of the 16 million equity share capital of silver. Gold issued 3 new shares in exchange for every 5 shares it acquired in silver co. Additionally, gold will pay a further consideration on 31st December 2012 of 2.42 per share acquired. Gold's cost of capital is 10% per annum, and the discount factor at 10% for 1 year is 0.9091. At the date of acquisition, shares in Gold Co and Silver Co had a fair value of 8 and 3.5 respectively. Right now, why is this information given to us? For goodwill. For goodwill, I need my investment cost, correct? So yes, what we can do is come right to the bottom. Under our workings, working number 2, investment costs. Now here under working, you say I see investment cost, I'm okay, I'm happy, I don't have a problem. If you say it here only, I have a problem. Here under your workings, it's not a problem at all. However you do it, I don't have a problem. Okay, right. Now my dear, if you take your investment cost has how many elements? 3, 4, 2, 1. How many elements? Your investment cost has how many elements? Your investment cost has a share exchange number 1 and a deferred payment number 2. Only 2 elements. I have number 1, a share exchange. What are they saying? You are acquiring $16 million one equity shares. The subsidiary has. Out of that, you are acquiring 90%. So therefore, keep your pens down. Look here, I'll give you time slide. 16,000 into 90%. And in your share exchange, what you are doing, you are issuing 3 new shares for every 5 shares that you acquire. Into 3 over 5. For every share that you acquire, the parent is paying money. Parent will pay money at what price? When parent issues shares, I give you shares, I'm the parent, when I give you shares, at what price will I give you my shares? What is the value? What is the price? We are here. I have not got to this point. That is my second part of it, my dear. When parent is giving shares, at what price will the parent give its shares for? Huh? Well done, Naresh. Market value, KLP1, market value. We studied it. And what's the market value of parent shares? $8. At the date of acquisition, shares in Goldco and Silverco had a fair value of 8 and 3.5 respectively. So if I am the parent, I am going to give it at $8 into $8. Now you can't go wrong here. Always when parent issues shares for investment, it will be parent's market share. We've covered this before and I'm telling it to you again. Are we clear? Equals 16,000 into 90% into 3 over 5 shares, total number of shares. That's going to be 8,640 equals 8,640 into 8. You get 69,120. Debit investment cost, credit share capital and share premium, but not relevant right now for you. But if you have to put up your balance sheet, in your balance sheet it becomes relevant for you. Are we clear? Understood? Yes or no? Okay. In the exam, you don't have to show this. This is not required in the exam. In the exam, this itself is enough. Your examiner will have to go to the cell, click the cell and see what you have typed. You understand my point? So you don't have to waste time putting up this entire thing, but I am doing it so that you will understand. Are we clear? Number one. Number two, you're going for a deferred payment plan. What is your deferred payment plan? Your deferred payment plan is further gold will pay a further consideration on 31st December 2012. Meaning at this year, on this particular year itself, you're going to make a payment. So within 1 year itself, you're making a payment of 2.42 per share acquired. So in other words, the deferred payment will be 16,000 shares in total into 90% you are acquiring. For every share you are paying 2.42. Am I clear? Am I clear? So therefore equals 16,000 into 90% into 2.42 gives you 34,848. But this is a present value payment or future value payment? Future value payment. I need my present value. To do the present value, we know the calculation. Present value equals future value over 1 plus r to the power n. However, your examiner has directly given you the discount factor, 0.901. When your examiner has directly given you the discount factor, 0.901, all what you have to do is equals this into 0.901, 31,398. 9091 31,680. Are we clear? Yes or no? Are we clear? Yes or no? Therefore, this is your present value for your investment cost. Therefore, your total investment that you will require for your goodwill calculation will be share exchange SC and DP deferred payment. Total investment cost is 69,120 plus 31,680 equals sum. Your total investment cost is 100,800. Are we clear? Yes or no? Are we clear? Yes or no, everyone? For goodwill calculation, you don't have to mention it, but I'm mentioning it. You have deferred payment. If you have deferred payment will result in what? If you have deferred payment, your deferred payment will result in finance cost. So working number 3, FC. In other words, I will keep on saying finance cost. I don't want to simplify it. Finance cost. Your finance cost will be on your deferred payment. How much is your deferred payment? Your deferred payment is 31,680. So 31,680 into how many percent? Into 10%. Am I done? Yes or no? Why? Into 9 over 12. Super, because I have it for 9 months. So equals 31,680 into 10% into 9 over 12 gives me 2376. Debit finance cost, credit interest payable. Go to the top. My finance cost. Already I have 672 equals plus 2376. Are we clear? Yes or no? I'm keeping it very simple. You got to make sure that you keep it very simple. To interest payable. You have to deduct it from retained earnings and then you'll have to go to interest payable. We will also look at a question where you have income statement, balance sheet both together. Don't worry. You can be tested with that also. Are we clear? Done. Now see guys, with that, I'm entirely done with this. I'm entirely done with this. In the exam, it's very simple. I will take the notes. Based on the notes, I will do my workings. I'll do my workings and I will never come to my notes ever again. My financial statements will be done based on my workings. So I'm done with this. I'm not going to come to that ever again. Okay? Super. The following information is relevant. At 1st of October 2011, the retained earnings of silver was 56 million. Why have they given that to us? Brilliant, Asna. Superb. Why have they given us this 56 million? Why? Because we want retained earnings at acquisition date. For what? Superb. There you go. Working number 4. Retained earnings on 1st October. On 1st October. Look here. I'll give you time to write. Look here. On 1st October is 1st October 2011 is 56 million. So 56,000. Can I directly take 56,000 to calculate goodwill? No, I can't. Because this is happening on 1st of October, but my acquisition happens on 1st of January. So October, November, December, I need to take 3 months profit. Students messed up with this question there. They were so interested to get this figure as their retained earnings at acquisition figure. So they did not go and check this date, 1st of October. They thought this was 1st of January. They simply copy pasted 56 million in the goodwill calculation. Wrong. Attention to detail is very important in the exam. So 56 million, but 3 months profits for goodwill. I will say at acquisition. This is required for my at acquisition. You understand my point? You can't mess up here. You have to be very careful. Are we clear, everyone? Yes or no? Yes? Yes, super. So I'm going to go forward. Done. At the date of acquisition, meaning relevant for my goodwill calculation. The moment you see at the date of acquisition, all at the date of acquisition figures are relevant for my goodwill calculation. The fair value of silver coast assets were equal to their carrying amounts, with the exception of 2 items. The fair value and your carrying amount was equal except for 2 items. An item of plant had a fair value of 2.6 million above its carrying amount. Meaning, what do you have? Working number 5, you have revaluation at acquisition. Wherever we say at acquisition, it becomes relevant for our goodwill calculation. Wherever we say at acquisition, it becomes relevant for our goodwill calculation. Are we clear? So what is happening? There is a revaluation of 2.6 million above its carrying amount. Okay, very simple. 2,600 revaluation. 2,600 revaluation. Superb. Let's go further. The remaining life of the plant at the date of acquisition was 3 years. Depreciation is charged to cost of sales. What do we have? additional depreciation after revaluation. W6 depreciation. How much is your depreciation? 2600 over how many years? 3 years into 9 over 12. Superb. So therefore 2600 over 3 into 9 over 12 gives me 650. Your examiner clearly says any depreciation, please charge where? To cost of sales. Now don't sit and argue, no, A-level teacher taught me admin expenses, distribution expenses, my A-level teacher, oh wait, your examiner is there as a part of the IASB's panel of standard development. That's your chief examiner. Your A-level teacher is not there. You understand? Neither me. So if your examiner says cost of sales, go and take it to cost of sales. Your examiner says set it off against revenue, do it. Don't try to question the examiner. Don't try to do things like that in the exam. You know, our students are good with that. You know, they come and argue, examiner doesn't know. He's a part of a standard setting board. Don't try to go and, argue with the examiner there. How much is that? 650. I'll go to the top. Cost of sales plus 650. Keep it simple. Plus 650. Keep it simple. Are we clear? Understood? Everybody? Are we clear? Okay. Done. Silver had a contingent liability. Okay, so our subsidiary had a contingent liability. Which Gold Co. contingent liability? IAS 37 provisions, contingent liability, contingent assets. Under that, we know a provision. We know what is a liability. A liability is a present obligation. Obligation can be contractual, constructive. A provision is a liability. Correct? So to recognize a provision, you have certain conditions: probability and measurability, probability of payment, virtually certain, probable, possible, remote. Yes, we studied, right? Don't give me that look. We studied. And then it can be a contingent liability. And if it's a contingent liability, if it is material, there is a mandatory disclosure. Now they say, silver had a contingent liability. That is, our subsidiary had a contingent liability. Gold estimated to have a fair value of 850. This has not changed. Silver has not incorporated these fair value changes into the financial statements. This fair value has not changed, meaning nothing to do. Only if it has changed, you have to take the adjustments. If from 850, if your liability has gone up to 1000, that means 150 liability you will recognize. That's an expense. From 850, if it has come down to 600, yes, it becomes an income you will go and recognize. But here they say no changes. Students thought, examiner wouldn't have just given no. There should be some adjustments, no. You went and recognized it again. Your examiner clearly says it has not changed. See the trick, you get caught. So if it is not changed, you're not going to do anything there. Just leave it. No impact in our P&L. But of course, our goodwill has to be recognized, shown in the goodwill calculation. So working number 7. Contingent payment happening at acquisition. Recognize 850. Now, if this 850 has gone up or come down, any fair value changes, you will take it. But right now, nothing, only for your goodwill calculation. Are we clear? Yes, no? So in working 6, they are saying date of acquisition. Working 6. Oh, Ashwa, look here, Ashwa. Depreciation happens after acquisition, my dear. Only revaluation happens at acquisition. After that, it's post-acquisition, so it's not relevant for your goodwill calculation. Guys, you understand, right? Depreciation happens after acquisition, right? You depreciate, you use the asset. So at acquisition, what is relevant is revaluation. After that, post acquisition, whatever happens is not relevant for us. Manisha, are we clear? Shan, Hajara, Hazik, Rishma, Chamudi, Naresh, Senuri, Zara, are we clear? Clear? Gold's policy is to value NCI interest at fair value at the date of acquisition. For this purpose, Silverco's share price at that date, can be deemed to be representative of the fair value of the shares held by the NCI interest. Why have they given that to us? Why have they given that to us? Brilliant. Superb. Why is that given? Why is that given? Well done, Ashwa. Superb. Others. What is the reason for them to give this? Gold's policy is to value NCI interest at fair value at the date of acquisition. For this purpose, Silverco's share price at the date of acquisition can be deemed to be representative of their fair value. Given to calculate NCI goodwill. This is NCI investments. We saw NCI investments can be either through fair value share price or proportionate net asset basis. If it's proportionate net assets basis, it is always 0. If it is fair value method, then you have to calculate NCI goodwill. So, coming back, working number 8, NCI fair value for NCI goodwill. Now it's not relevant for us. We will take it when we are calculating it. We know we have to use fair value. That's okay. Let's go further. Sales from gold to silver. Sales from gold to silver. Meaning, who is the seller? Parent is the seller. Gold is selling to silver in the post-acquisition period had consistently been 600,000 per month. What is it? How do you call it? Intergroup transaction. Okay, working number 9. If there is intergroup transactions, what should you do? Intergroup transactions has to be eliminated. Okay, how much are you going to eliminate, Hasna? Into 9 months. Per month it's 600,000. How many months do you have the subsidiary? 9 months. Now see, we are so used to dividing, we start dividing. We know the concept. It's just that, we are so used to a pattern, a routine, we go and divide. Mess up in the exam. And sometimes your examiner will give you the entire total amount. Sometimes he will twist and give you per month amount. If it's per month, you have to take it into the number of months. Goldco made a markup on cost of 25% on these sales and had 1.2 million of these goods in inventory as of 30th September 2012. Now, there are two things, intergroup transaction and then URP. Now, intergroup transaction will be 600 into 9. Therefore, equals 600 into 9 gives me 5,400. 5,400 has to be eliminated. Eliminated from revenue and cost of sales. I go to the top. From here, revenue minus 6,400. I come here. 5,400. Okay, sorry. 5,400. Equals 600 into 9. There you go. Yeah, 5,400. Done. And next, working number 10, URP. So the moment you come here, seller equals parent. If seller equals parent, no adjustment required when we do the NCI. If seller is a subsidiary, then when we do the NCI calculation, there will be an adjustment. Okay. Now what is happening? 1.2 million of the goods are still within the inventory. Markup 25%. So 1200 into 25 over. Okay, superb. So equals 1200 into 25 over 125 gives me 240. 240 has to be eliminated. Eliminated from. Superb. Eliminated from inventory. If I have to eliminate from inventory, what will I do to cost of sales? I add or deduct. I will add superb plus 240. Done. Are we clear? Guys online, are we clear? Guys online, everybody, are we clear? Guys online, everybody, are we clear? Everyone, keep on going, keep on going, keep on going. Keep going, keep going, keep going, keep going. Mujahid, this is the first time you are in my class. This is the first time I see you in my class. Is this your first class? Gold's investment income is a dividend received from its investment in a 40% owned associate. Hold on. What is happening? Group structure is going to change. So parent also has an associate. So parent has an associate. So let's quickly go to the top. Gold has 40% associate. So see, it's good that we put this, right? It's good that we put associate share of profits, right? You see, because the moment you see associate, if it's an associate, you know you have to take associate share of profits. They say here, Gold's investment income, okay, there is an investment income, is a dividend received from its investment in a 40% owned associate, which has been held for several years. The associate made a profit of 3 million for the year ended 30th September 2012. Now, there are two things. You have a dividend received. You have a dividend received, that is your investment income, 800. Correct. Any intragroup transaction between the associate and the parent has to be eliminated for dividends. Why? Because you're going to take the associate share of profits. Profits and dividends, same, no? So if you try to take dividends also, it's going to be double counting. Therefore, working number 11, eliminate dividends of associate 800. I go to the top. Where is it? 800 equals minus 800. That is out. Now what will I bring in? Associate share of profits. Now for me to get associate share of profits, they directly tell me associate made a profit of 3 million for the year ended 30th September 2012. So what you are going to do is 3000 into 40% equals 3000 into 40%. In the exam, my dear, you can directly take this. You don't have to put this. Once again, I'm telling you. 1200, you can directly take it. So I come to the bottom. I come here and I would say, I come to the top and I'll say associate share of profits equals, I will always try to connect it to my workings so that if I have to make any changes below, it's easy for me. Are we clear? Done. 1200 is the share of profits. Now, share of profits includes as dividends, right? So why do you have to double count it? Clear? Working number 13. Okay, it's a big question actually. It's a big question. Okay, favorite area. What is this? The moment you see this, you know it is IFRS 9. Examiner's favorite area. Examiner's favorite area. On 1st October 2011, Goldco issued $100,000 6% loan note at par value with interest payable annually in arrears over a 5-year term. The equivalent rate for non-convertible loan note was 8%. Gold has recorded the loan note as a liability at par value and charged annual 6% interest to finance cost. Your discount factor is given below. What's the standard? Eliminate loan interest. Aswa, what do you mean loan interest to be eliminated? What is the standard? IFRS 9. What has happened? Rishma, what has happened? What has happened? It's a financial liability. Superb. It's a financial liability. Superb. Financial liability for convertibles are recognized at financial liabilities for convertibles are recognized at superb, Naresh. Well done. It's recognized that present value. Is recognized that present value. Is recognized that present value. IFRS 9. There you go. Financial convertibles recorded at present value of cash flows. Look, we have done it. We have done it in the past. Now you can't look blank here. You can't look blank here. In the exam, you need to know what is happening. What is happening? Here, they are recognizing it. They are recognizing it at par value, but should have recognized that present value. So that means the treatment is correct or incorrect? Incorrect. So we are going to go back and say working 13. Convertibles recognized at present value. Okay, so you'll need your years, you'll need your cash flows, you'll need your discount factor, you'll need your present value. Let's go back. How many years? Issued with interest payable annually in arrears for 5-year term. So year 1, year 2, year 3, year 4, year 5. For 5 years, what are your cash flows? 100,000 into 6%. Correct? No. Then your cash flows will be 100,000 into 6%, but your discount factor is only 8%, my dear. So your discount factor is at 8%. Your cash flows, you'll have to take it at 6%. So that will be 100,000 into 6%. Correct? Correct. But there is a catch. There is a catch. Generally, your examiner will give you the value. But here, he says 100,000 $100 convertible loan notes. He's given you the number of loan notes. So that means the value of the loan note will be how much? 100,000 into 100. So equals 100,000 into 100. We are working for thousands divided by 1000. It will be 10,000. Because we're working for thousands, right? Everything. Entirely we are working for thousands, right? Look here. So what most of the students did was they took 100,000 and did the question. They messed it up. FR is the most difficult paper to fail. You can't fail the paper, but you have to think through. You have to think through. You understand? Even the first time I did this question, I took it as 100,000. And then, as I did the question, I saw, oh, no, there's a problem with it. See, we learn through our mistakes. We've got another 20-25 days to go. Now we know, okay, where we have to correct ourselves. Attention to detail is very important. Are we clear? Yes. Okay. Now coming back, cash flows will be equals 10,000 into how many percent? 6%. 600, 600, 600, 600. Last year, 10,600. My discount factor equals 1 over 1 plus 0.08 to the power 1. First year, second year, third year, fourth year, fifth year. Now there are different ways to do it. Okay, now in the exam you have different ways. They have given you the annuity factor. Okay, but we have studied in this pattern, so let's do this, no problem. So my present value will be equals this into this, 555, copy paste entirely. My loan recognition value is 9201. Loan recognition value, loan receipt is how much? 10,000. There is a difference, we take it to equity, but that's not relevant for us right now. What is relevant for us? We have a T account where, so we can come back, gold curve, we have a financial liability account. Brought forward will be 9201, and then we have finance cost and cash payment. Our finance cost first year will be how many percent? 8%, equals this into 8%. And then cash, how much are we paying? 600. So therefore our total should be 9937 minus 600. This is my carrying forward value. They say in the question that the equivalent rate for non-convertible loan was 8%. Goldco has recorded the loan note liability at par, meaning at 100,000, and charged annual 6% interest. So they have recorded at 10,000, charging 6% interest, meaning they have charged how much? 600. Technically, finance cost for this current year has to be how much? 736. Meaning additionally, how much should you charge? Equals this minus this. This was one challenging area in the question. This was one challenging area in the question where students were not able to identify it, where students were a bit stuck. But now you cannot get stuck. Are we clear? Are we clear? Yes or no? Yes. 136. So 136 additionally to be charged. So I'm going to go to the top and I'm going to say finance cost plus 136, 3184. Are we clear? Everybody, are we clear? Everybody, are we clear? At 30th September 2012, no impairment to goodwill is required and profits accrue evenly throughout the year unless otherwise stated. Meaning we are done with the question entirely. It's a matter of, for us, it's a matter of getting the calculations done. 143,560 minus 108610. 34,950 is my gross profit. Are we clear? And then guys, it's very simple. 34,950 minus distribution cost 4795 minus admin cost 8885 minus finance cost 3184 plus associate share of profits 1200 gives me 19,286. Now this is the reason why I'm not doing minus and addition here. It's very direct for me to do it here. Get my answers. Income tax expense equals 19,286 minus 6,400, 12,886 is my group profits. I have NCR share of profits to finally. I'll come down. I'll say working number 14. Working number 14. NCI share of profits. To calculate NCI share of profits, what do I need? Gold is issuing the loan note. Gold is issuing the loan note. Meaning gold is issuing the loan note to get cash. Gold is issuing the loan note to raise cash. It is not issuing the loan note, it is not giving a loan to the subsidiary. It is not an intergroup loan, my dear. Right, I was a bit confused. You can't get confused. It is not an intergroup loan. Are we clear? Right. Coming back, we have NCI share of profits. For NCI share of profits, what do I need? What do I need? Subsidiaries profits. Subsidiaries profits. How much is subsidiaries profits? Subsidiaries profits, I have how much? Hmm? 9920. Can I take 9920? Why? What is the percentage? 9920 into 9 over 12 into 9 over 12. Now see, again and again, you're making this mistake. Into 9 over 12. From this, you do any adjustments. Okay, what are the adjustments that is affecting our subsidiary? Convertibles out, associate out, dividends out, URP, parent is the seller, so out, intergroup transaction out, NCI fair value for NCI goodwill, contingent payment out, depreciation 650. Depreciation minus 650. Anything else? That's it. Therefore, equals sum total into 10%. So this into 10%, 679 will be NCI share of profits. So equals 679. Therefore, parent's profit is this minus this, 12207. Done and dusted.
So what about the profits that happened in the first 3 months?
What do you mean?
Like,
That will be taken to retain earnings, no? I'm acquiring that, no? So as a part of goodwill will be taken. That's it. We are done. What's next? Goodwill calculation. Can we do the goodwill calculation also together? Huh? Okay. So goodwill on acquisition. For goodwill, what do I need? Investment cost. I need the investment cost of parent and NCI. There are two players here, parent and NCI. Parent's investment cost we already calculated. Where is that? 100,800. Are we clear? Are we clear? For NCI investment, they asked me to use what? The share price. Total, how many shares? 16 million shares, correct? So equals 16 million shares. How much is NCI percentage? 10%. Every share, what will be the share price? 3.5 or 8? 3.5, because always subsidiaries. Because here NCI, subsidiary has NCI, therefore into 3.5. From this, acquired net assets. Acquired net assets. What are the acquired net assets? Share capital. How much share capital? How much share capital? How much share capital? Sorry? Yes, total share capital is 16 million shares at $1. 16 million. But if the value has changed, then you'll have to change it, $2 or $3 based on that. So here it's 16,000. Are we clear? And then I have retained earnings. Retained earnings at acquisition. So retained earnings, already I know I did an adjustment here. Retained earnings 56,000 plus 3 months acquisition profit. So I have already 56,000 with me plus 3 months profits. So for me to take my 3 months profits, Silverco has a total profit of 9,920. So equals 9,920 into 3 over 12, 2,480. Did we do any adjustments to retained earnings? Retained earnings. No, revaluation at acquisition. What else do we have? At acquisition only? Okay, there is a contingent payment, 850 to recognize. Okay, so we have a contingent payment. How much is that? Minus 850. Anything else at acquisition? At acquisition, revaluation is there at acquisition. I have to take revaluation. But any adjustments to retained earnings? No, that's it. Now I have revaluation. How much is the revaluation? So I can take this total. Done. Revaluation is 2,600. Done. That's it. I've taken everything. Total. How much? 76,230 into 90% equals this into 90%, 68607. Therefore 100,800 minus 68607, 32,193 is parent's goodwill. Now I have to calculate NCI goodwill. To calculate NCI goodwill, 76,230, but this time into 10% equals this into 10% gives me 7623. Therefore 5600 minus 7623 gives me minus 2023. Oh, okay. So what is happening? What is goodwill? Goodwill is the premium paid over and above subsidiaries net assets. Premium paid over and above subsidiaries net assets means, okay, when the premium is paid for unrecorded items. Like what? Like market share, like brand, like people. Okay, the company is doing really, really well. But let's say if the company is a loss-making company is not doing really, really well, like maybe Nokia, you know Nokia, right? Nokia is a mobile phone company which was there, which was the strongest, but like when Apple came in, they crashed. Now, if there is a company which is crashing, the value is coming down, not generating cash flows, do you think you will go and pay a premium or you'll buy it at a discount? Buy it at a discount. Meaning from the net asset value, you'll pay a lower value. If you pay a lower value, you call it a negative goodwill. The company doesn't have positive goodwill. You understand? In that case, you can set off and take your total goodwill, 3170. Therefore, total goodwill will be 30,170. Are we clear? There you go. Done and dusted.
Usually in the exam for section C, like, do you always get consolidation?
For section C, you will definitely get consolidation and ratio analysis. Sometimes you will also get income statement balance sheet also. It depends. So between income statement balance sheet, consolidation and ratio analysis, they can plug cash flows somewhere, like how they plugged yesterday with the question that we did yesterday. They can do that also.
So both of them will
definitely be tested. Now there's no two words about it.
So in both sections, 2 out of those 3 topics will be tested.
Definitely be tested. So look, this is my part B in the exam. I'll tell the examiner, look, I've answered part B first, and then I've come back to my part A. My examiner will know that, and he will know these are my workings. My presentation, my structure, everything is given. Are we clear? In the exam, for a requirement like this, which is for 20 marks, you can't take more than 40 minutes. Maximum 45 minutes. That's it. Maximum 45 minutes. That's it. Are we clear? Right. Let's take a break, come back and look at another past paper question. A 20 minutes break. Now it's 10:50. We are meeting at 11:10. Shall we? Okay, so we have our mock as planned at 2 o'clock today, and I'll be giving you basically it's it has to be done in 1.5 hours, but I'm giving you 2 hours. Okay, because we are giving only section C, we're going to do only section C, and I want you to work around your mocks properly. Okay, super. This is our starting point. Okay, as we know, we have a lot more sessions to cover, and we know we have more marathon sessions to cover. And by now, if you actually look, we have got to this point where right now we have covered 1, 2, 3, 4 today. Right now, fifth past paper we did gold. Okay, and now we are going to do another past paper question. We are directly, it's about past paper. From this point onwards, it's about past paper. Success lies at past papers. Doing enough and more past papers, and I have a lot of past papers planned for you. Are we clear? Super. Well, ratio analysis, I know most students, most of our students get stuck. Yesterday we looked at a ratio analysis with cash flows. Now we are gonna look back on another ratio analysis question. Analyzing financial statements. Yeah. Once you're done with your listing. Okay, let's do trade score. Let's do trade score. Trade score. So, first paper, trade score. Okay. So, trade score. Question by the name trade score. Okay. So, I'm going to go back. I'm going to take trade score. Trade score is a solid question. Page 1. This is page 141. Okay, we're going to keep it very simple, like how we did it yesterday, guys. Question like this is going to come. You are going to get something like this in the exam, so there's no two words about it. Okay, you are definitely going to get it. It's a matter of preparing for it. Okay, superb. Now if you come here, your requirement says calculate for trade score the equivalent ratios to those provided by the confectionery manufacturing sector. Okay, you are into confectionery manufacturing. So number one, you are going to calculate the equivalent ratios. That's the first part of the requirement. The second part of the requirement is analyze the performance and financial position. Okay, in the exam, we are keeping it very straightforward. Now, like yesterday, what we will be doing is we will be taking the ratios. First, we'll be talking about the ratios, whatever is possible, I'm going to cover. What is not captured by the ratios, I will take it separately. That's the same line format that we are going to do. Okay, now I'm going to come back. I'm going to say treats curve, and I'm sure my examiner would have given me some ratios to calculate. So I will have my ratios. There you go. My examiner has given me 2, 4, 6, 8, 9. 9, not 9, 8. 8 ratios to calculate. So based on these 8 ratios, first I'm gonna write my analysis, my comment. Anything that I want to cover extra, I'll cover it below. Understood? Easy, no? So we are not going to worry too much. We know exactly for these ratios how to work around it. Okay? Superb. So you know the ratios: ROCE, net asset turnover, GP margin, operating profit margin, current ratio, inventory turnover period, meaning inventory holding period, inventory turnover period, gearing, debt over equity, receivables collection period. Okay, we've looked into these ratios before. We know the ratios. Okay. Now what I want you to do is, I want you to read the question on your own. I want you to read the question on your own, and then we will see how we can do it together. Sir, in the real exam, we have to do the analysis in a Word document. No, please do it like this in the real exam. You can do it on the sheet itself, no problem. You can do it in the sheet itself, Naresh, no problem. You can do it in the sheet itself, no problem. The real exam sheet on the Excel itself, you can do it. Meaning, what you will have in the exam is your sector ratios, treats ratios, and then what I want you to do is keep it very simple, give your comments. Wherever possible, you can comment on your financial position and performance. That's the easiest way to go about it. This will be your ratios. Now we have ROCE, net asset turnover, and then GP margin, operating profit margin, gross profit margin, operating profit margin. Okay, thank you. Current ratio, inventory turnover period, gearing, debt over equity, receivable days, payable days. No, right? Okay, that's why those are my ratios. My sector averages are given. ROCE 28.8%, 2.4 times, 55%, 12%, 1.8 is to 1. Okay, 25 days, 43%, 15 days. Okay, now we got to calculate the same ratios, same set of ratios for trade score, and then we are going to start commenting. Now guys, the moment we work around it like this, it is easy for us because you will not miss points. You know what affects ROCE, you know what affects net asset turnover. You'll be easily able to get your points sorted in the exam. Okay, so you know the ratios that you have to calculate. Okay, before we do the question together, I want you to take a good 5 to 10 minutes. Okay, do the ratio calculation, go through the question on your own, and then let's answer together. Let's answer together. I want you to go through the question on your own. I'm giving you a 10 minutes. Okay. Read the entire question. Shall we answer? Shall we answer? Guys online? Can we look at the question together? Okay. Hello, Manisha, Naresh, Janadya, Hiroshi, Hazik. Now Naresh has a question. Naresh has a question, sir. Is the inventory holding period and inventory turnover ratio same? No. No, it's different. Inventory turnover ratio is cost of sales over inventory. Inventory holding period is inventory over cost of sales into 365. But the moment here they say inventory turnover period, right? Okay, there is a confusion. Are they talking about inventory turnover ratio or inventory holding period? Am I right? That's the problem, right, Naresh? That's the confusion that you have. Am I right? Here you have to go with inventory turnover period, means here your examiner is referring to inventory holding period. The moment they use period, you have to take the 365 days formula. Okay. Because here they are clearly giving it to you in days. They are saying it's days. Because inventory turnover ratio will not come in days. Are we clear? Understood? Okay, superb. Can we start answering? Can we start answering, everyone? Okay. Now let's go to the question. Tradeco manufactures confectionery. The following sector averages ratios have been obtained for the year ended 30th September 2016. Ratio return on capital employed 28.8%, net asset turnover, GP margin, operating profit margin, current ratio, inventory turnover period, gearing, debt over equity, receivables collection period. Okay, in the exam, you're in the exam, okay, you know, you've looked into the ratios. Okay, you know your requirement. Calculate the equivalent ratios, number one. Analyze the performance and position for trade score in comparison to its sector averages. Okay, now we are going to the question. Extract from the financial statements of trade score. Revenue looks good, cost of sales good, looks good, company is making profit. Profit from operations look good. There is finance cost, so I can think of interest cover. They're able to cover their interest. Yes, at least 2, 3, 4, 5 times interest cover can be done. Yes, interest cover is operating profits over finance cost. I can assume, okay, there's no problem there. Taxation, profit for the year, company has a profit for the year. Now guys, I know there is profit for the year, but now my problem is I do not have last year financial statements. If I have last year financial statements, I will know if the profit has gone up or come down. I will know if the revenue has gone up or come down. Now these are missing statements that I need. So always in your exam, you're going to do the analysis, you're going to give the conclusion. In the conclusion, there is missing information you have understood in the first inception itself. So you will say in the conclusion, you can always keep in mind, you're going to give a conclusion. Your conclusion will obviously say that what is missing. What is missing? You know what is missing? Previous financial statements. Missing. So you, because previous financial statements are missing, you are unable to understand what has happened. So in other words, additional information. Additional information required to make the analysis more conclusive. Now I have my analysis, but I need more information to make my financial statement, my analysis more conclusive. You can always have a set of things your examiner won't give normally. Like what? Macroeconomic factors, SWOT, competitive analysis. Now you look here. Yesterday, what did I say? Overall, to make the above analysis more conclusive, we need further information. What? Past financial statements, budgets and forecasts, competitive information, SWOT analysis, future management strategies. Copy paste, simple. Copy paste in the exam, simple. Always make sure you are going to copy paste this in the exam, because you need further information, and we know your examiner is not going to give you all the information. Macroeconomic policies, what is happening in the economy, taxation. A clown like Donald Trump comes in, he's going to bust the economy. All those unpredictable factors, right? Copy paste in the exam, very simple. If I'm you, I start off with my conclusion, very simple. There you go. There itself, I know I've got about 1 mark in the exam. That's how I plan my answers. I have to plan my answers. Exam is not about finishing one particular question. It's about finishing the entire paper. Entire paper has to be planned. Certain things, structure has to be planned. So I know it's going to look like this. And I know I've not got proper information. What is the issue here? Past financial statements. I want financial statements over the last 3 years to understand trend, movements. You understand my point? Okay. So you need to keep this in mind when working through a question like this. Okay. Fine. So statement of financial position, property, plant and equipment. Okay, they're giving me a note. Current assets, inventory, steady service, cash. Oh, no cash. That's a problem. Company doesn't have cash. Company doesn't have cash. That's a problem. I need to keep that in mind. Ordinary shares, other components of equity, share premium, retained earnings, total equity, borrowings, trade and other payables, companies operating with overdraft. Overdraft comes at a higher interest rate, meaning that is going to be a problem for the company. Current tax liabilities. Okay, done. The following information is also relevant. The property, plant and equipment relates to retail stores operated by trade. The property, plant and equipment that you have, where property, plant and equipment is all about your retail store. So you are a confectionery manufacturer, plus you have your retail stores. So you have a forward integration. So I manufacture and I sell it through my shops. For example, Ambewala farm. As you go to Ambewala farm, there is production in-house of milk, and outside you see sales outlet, Ambewalas. Something like that. So what can I think of? Okay, now if I think of Ambewala selling a milk packet outside for 150 rupees, just outside their production facility. Okay, I'm just thinking out. Okay, outside. So I do the manufacturing, I come outside, I sell it. That gives me more revenue, or more profit, or I send it to the supermarket, I distribute it, and through the distribution, I sell it to my customer. That gives me more profit margin. 1 or 2? Option 1 or 2? 1, I'm directly going to my customer, so my margin is high, I make a high profit. 100 rupees milk packet is 100 rupees in your area, Ambewala farm. It is going to be 100 rupees in the supermarket also. Correct? But the moment it comes to the supermarket, my dear, there is transport cost. You understand? There is labor cost. You get my point. So there is a lot of cost that I have to cover. But outside the store, when I sell, my margin is high. So the retail stores operated by me will give me higher profitability than my middle person. Just keeping in mind. You understand my point? That's how you have to think in the exam. Of which are depreciated on a straight line basis over 20 years. Okay, now your retail stores, you're depreciating over how long? 20 years. All of which are depreciated on a straight line basis over 20 years. The original cost of these assets was 637.84 million. Okay. And the directors are now considering replacing and updating much of the plant and equipment. Okay, now the directors want to replace, update your plant and equipment. Why would you want to update your plant and equipment? Why? Make the production more efficient, meaning your existing production probably is not capable enough to bring you the revenue that you want. Your existing production is not generating enough revenue. Your existing plant and equipment probably is damaged. I will not want to bring a new TV until this TV is damaged, no, my dear. If this TV is damaged, I have my repair cost. Correct? So, meaning either I can repair or I can replace. If I'm going to repair, my operating cost is going to go up. I will also charge impairment. My operating cost is going to go up. But if I replace, I bring in new assets. If I bring in new assets, where will it be affected? Which ratio gets affected, my dear? We spoke about this yesterday. Brilliant. My ROC is affected. I bring in new assets. My capital employed is affected because in the short run, my new assets will not generate cash inflows. It will generate in the future. In the short run, my ROC will come down or go up. In the short term, it will come down, meaning I have to keep in mind bringing in new assets, it's going to affect my ROCE. So here they are talking about replacing and updating much of the plant and equipment. I tell in the exam, hey, look, if you do that, ROCE will drop. Now we do not know. Now we do not know what is the status of our ROCE. Competitive or not competitive compared to the sector averages, I do not know, but these are my assumptions that is running in my mind. This is how you have to work through in the exams, my dear. This is tough. I know you will not be able to crack it today, but before exams I want you to crack it. After doing about 5, 6, 7, 10 questions, you will be able to crack it, but we have to do questions. This is just our second question. Are we clear? Super. Now this is your thinking. Okay. Now I can, in the exam, I can connect this. I can connect this to what? ROCE. Bringing in assets. I can connect it to ROCE. I should be able to connect it. Are we all clear, guys online? Are we all clear? Guys online, are we all clear? Super. Now my net asset turnover. Okay, now I'm just going to take you through my net asset turnover. My assets that I have, how much of cash they are generating. Correct. Are they generating enough cash? Okay, let's see. Let's go on. Treats paid a dividend of 7.14 million during the year, despite the concern raised by some directors over existing overdraft. Is it a reasonable request by the directors or not a reasonable request? Why reasonable?
So that means that there's an overdraft, but still they have paid a dividend. So it's reasonable.
Well, yeah, there you go. Your company is struggling with cash. You don't have cash, but still you have gone and paid a dividend. A question to answer. Okay, why did you even do that when you're struggling for cash? Well, to attract shareholders, but is it at the expense of bringing the company down? So that means, does it look like a good strategy? No, it doesn't look like a good strategy. Maybe they could have gone for a bonus share to attract shareholders, to keep shareholders happy. Now they say, Rian, let's go for a bonus share. That's an alternative strategy. Rian, if I'm there, I wouldn't bleed cash. I'm bleeding with cash. Why would I want to spend more cash? Because it is not finance cost. It's not a mandatory payment that I have to make annually. I can stop dividends. I can go for a bonus issue. I have options. When I have to bring in cash into the business, what I do, I'm bleeding even further. Not a good strategy. We are also going to go and question the strategy. Sometimes crystal state, you're going to say, hey, look, the strategy doesn't look good.
On the context of the business,
Why?
like say, growing very fast, they run out of cash because they have expanded too much. It's a very future cash flows. In that case, to maintain their market price and keep shareholders happy,
Come again, they have expanded so quickly they don't have cash.
they don't have cash. So to attract future cash inflows from investments,
To attract future cash flows from investments, you can always go and show your financials forecast. You can show your expansion strategy. So you want to bring in new investments, no? New people into your company. So existing people only are giving dividends, right?
so like say, it will be
So you could have gone for a rights issue, no? If you want cash.
if you pay more dividends, it will be attractive to external parts.
Okay, do you think shareholders, the moment they see, okay, high dividends, but my company is struggling without cash, they'll be happy? I give you 10 rupees now, but your company have invested in 100 rupees. Your 100 rupees is shrinking, but I am giving you 10 rupees. Are you happy? The overdraft is used for working capital management purposes and does not form a part of the long term health. So that means you are funding your business based on overdraft, high interest. Good or bad strategy? Bad strategy. Treat sells its products through the supermarket chains. Oh, there you go. They say Treat is selling the products to supermarket chains. In addition to its own retail stores, so you have a mix. You have your own retail store, you have your supermarket. So where will you probably make higher revenue? Own retail. So we need to understand the sales mix also. Most companies in the sector exclusively say, oh, okay, so your sector people are selling through your retail stores, but you are selling through supermarket and retail stores. Now the problem is few. We've got few problems here. The first problem I can think of is the revenue of your sector. Almost most of the company, the revenue, the GP margin that you get is derived from retail store sale. But yours as a mix of retail stores plus supermarket. So in terms of comparison, it doesn't look a great comparison for me. Do you understand? Because the sector average is primarily based on retail stores, meaning the profit margin is high. Yours has both supermarket and retail stores. You have a combination of both. So here when you try to compare both, I don't think that is a reasonable comparison. Why will there be a price discrimination, Naresh? So number one, I have a problem there in terms of comparison. So I can always go and say, hey, look, as a part of my conclusion, you've given me sector averages, but benchmarking doesn't look that great. Number one. Number two, since I'm using my supermarket chains, I feel my distribution cost can be high. My operating cost will be high. So right now itself, I think when I compare it with my sector cost, my operating profit margin has to be low. My GP margin has to be low. I have not even calculated it, do you see? But it has to be low. Logically, it has to be low. No? If not, then there is a problem with the question. Have you calculated it already? No. GP margin, operating profit margin, lower than sector. There you go. I've not even done the ratios. I know it has to be low. Why? Because of these reasons. Okay. Can we start answering? Okay. Now, I know you know to do the calculations. Okay. Right. Guys online, start off. Give me figures. ROCE. Guys online. Rishma. ROCE. How much is ROCE? Rishma. Quick. Offline. Guys. ROCE. 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 For treats. ROCE. 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 What do we need? ROCE. Rishma, quick. Ashfa, quick. Janudya. Rishma says 12.5%. Is it correct? Okay. How do we get our 12.5%? Operating profits 7466 over capital employed. My capital employed, I come right down. My capital employed is my equity plus long term liabilities, which is 33,621. Okay. So there you go. I'm gonna take my 7466 in the exam equals 7466 in the exam over open brackets 25968 plus 33621 close brackets 12.5. You can take it as a percentage. I'm happy with this. I'm happy. Net asset turnover. Okay, start. How many times? Net asset turnover. What do you need? Your revenue and capital, your non-current assets and your capital employed. Your revenue and capital employed. Your revenue over capital employed. So how much is your revenue? 214,553, correct? 214,553 equals 214,553 over capital employed. We already got it, right? 25,968 plus 33,621. 3.6 times. Are we clear? 3.6 times. 3.6 times. Are we clear? Yes or no? Are you getting it? GP margin, straightforward. GP margin, my gross profit is 106,544 over 214,553, correct? Equals 106,544 over 214,553 gives me 49.50%. I told you it has to be lower, but not a major drop. There should be state formulas in the exam, not required. You don't have to show the formulas in the exam. Rishma, very simple. You do this in the cell, you get the answer. Now your examiner is supposed to go to the cell. And check what you have included it. So you don't have to do it, Rishma. Out. Let's not waste time there. My operating profit margin, my operating profits are 7466 over 214,533. 7466 over 214,533 as a percentage. That gives me, oh, where's my equals? Oh, that's a significant drop. That also explains all our arguments. But depreciation, replacement cost, repair cost, distribution cost, impairment. Look at the number of points I have to talk about. You understand my point? Current ratio, my current assets over current liabilities. My current assets are at 47,996. 47,996 over current liabilities is at 5391, meaning there is a problem. 5391, there is a problem. 0.95, there is a problem. 0.95, there is a problem. Are we clear? Are we clear? Inventory turnover period. So your inventory is at 3393 over cost of sales 108,009. 3393 equals 3393 over 108,009 into 365. 102 days. Okay, that's massive. 103 days, that's massive. Okay, what could be the reason for my inventory turnover to be high? Why do you think my inventory turnover is this high? Because we sell through supermarkets. One reason. Because we are selling through supermarkets. Probably they're holding our inventory for a very long time. Now you have Ambewala, you have whatever the brands, Kotmale. You have about 10 brands right in the supermarket. If it's a retail store, you have only one brand. So compared to the industry, you can have a problem there. And because of that also what can happen? They can go expired. Because your turnover days are so high, you can have expired products. If you have inventory expired, then you have to bring down the value, write down inventory. That will have an impact on my operating cost. Because the inventory is supposed to be carried at cost or NRV, whichever is lower. Because of a longer number of days that we are holding on to the inventory write-off could be very high. Slow moving inventory, so less demand. So Ashwa says, Zian, look, slow moving inventory. We have slow moving inventory. So probably our demand is also less. Could be. So I would want to understand why my operating profit margin is so less. I would want to go and check what is happening with my operating profits. Operating expenses. Okay. Have they given us the operating expenses breakdown? No. Okay. That's a problem. I need past financial statements, budgets. Yes. Number 6. More details on operating cost, breakdown of operating cost, because I do not know, okay, what is it made up of, right? These are my assumptions. You understand my point? See, how am I connecting all this? I do not know the sales mix. Number 7. More details of sales mix by between the percentage sold through the supermarket and the retail stores. More details of sales mix between sales through supermarket and retail outlets. Now, do you see how I'm connecting all this? Okay, let's go further. Gearing, they say debt over equity, right? Okay, how much my total debt? Borrowings is 33,621 over 25,961. Equals 33,621 over 25,968. 129%. Okay. Debt over debt plus equity. Here I saw somewhere they're saying debt over equity. Now here, there you go. They say debt over equity. So follow that. Alright, that's quite high. 129%. So it looks like they have borrowed this year. Do we have a borrowing? Yes, 33,621. Looks like this year there has been significant borrowing. The company is borrowing also. No, because OD is not coming as long-term debt, they say, right? You don't have to. Looks concerning, isn't it? And then receivable days. Receivable days will be trade receivables over sales into 365 equals 17,603 over 214,553 into 365. Once again, it's twice the this thing. Why? Receivable days. Why is it high? Who are our customers? Credit to supermarket. Naresh Velda. We are giving high credit terms to supermarket. So look, I have placed my ratios. I have thought through it, and now for me, what is it? It's a matter of me answering. If I properly answer this, then I get my proper 20 marks easily without a problem. Are we clear? Are we clear? Okay, first of all, let's start answering. Is ROCE a concern for us? Yes or no? ROCE is a concern for us. Okay. Now, in the exam, we are here. I told you 1 mark, always keep in mind 1 mark equals 1 point. 1 mark equals 1 point. 1 point is a sentence. A sentence is nothing more than 1 line. 1 mark equals 1 point. 1 point equals 1 sentence. 1 sentence is nothing more than 1 or maximum 2 lines. That's it, maximum. But that doesn't mean you keep on repeating your points. Okay, don't repeat 5 same points and say, okay, give me 5 marks. No, you don't get it in the exam. Let's strategically see how to answer this particular area. ROCE. ROCE is primary shareholder ratio, correct? ROCE is primary shareholder ratio. Are we clear? Are we clear? This is significantly lower compared to the industry sector. Look here, I'll give you time to write. Look here, industry sector. Okay, why do you think it's significantly lower? It's lower. ROCE, what do you need for ROCE? Operating profits. So your operating profits are lower. ROCE is a primary shareholder ratio. This is significantly lower compared to the industry sector. And this could be due to lower operating profits generated by treats. From this point onwards, I will say T. That is enough for me to get my 1 mark. That is enough to get my 1 mark. Okay. So my 1 mark got, okay, that then I do my second point. Very easy. My second point. Now look how I'm structuring my answer. Look here. I've spoken about the comparison. It is less. It could be due to this. But in the future, we are planning to bring in more assets. Will it bring it down or will it increase in the short run? It will further reduce in the short run. So we are going to say T is planning to invest in assets. Correct? Am I clear? In the short run, this could further deteriorate or decrease, deteriorate ROCE. However, However, if proper investments are made in the long run, if profits are generated, this would increase ROC. Now look at the way I'm bringing in. You're planning to invest in assets. In the short run, this will have an impact. But in the long run, this is how it will change. But if it is a proper investment, if you don't make proper investment, you are busted. Am I clear? Okay. Now, if you are going to invest in assets, number one, do you have enough cash to invest in assets? You don't have enough cash to invest in asset. So probably you have to go and borrow. Looking at the situation, already you're broken. Already you're running on overdraft. Do you think you will be able to borrow? No. Even if you borrow in the short run, even if someone comes and gives you, they are going to give it to you at a higher interest rate. Number one, correct? Because your default risk is very high. Number two, if you borrow long-term liability, further impacts your capital employed, your ROCE will come down. Correct? So, number three, investments in assets require significant cash flows. T is struggling with cash flows. Therefore, T will have to either borrow or issue shares. Correct? You have only two choices. Borrow or issue shares. When I say borrow, under this I'm also talking about leases. Leasing is also borrowing, right? So even if you lease, your liability is going to go up. Either way, this will further impact ROCE, and ROCE will fall. Now, do you see how I'm connecting my ratios? Do you see how I'm connecting my ratios? You should be able to connect your ratios. I'm telling my examiner, look, my examiner, I'm clearly giving an indication to the examiner. Look, 1, 2, 3, my 3 points, 3 different points, give me my 3 marks. I've justified. 3 points, give me my 3 marks. In the exam, already out of this 20, I've got 3 here, I've got 4 here. For the ratio calculation, how much? 4, right? 5 is it? Okay, for the ratio calculations, I'm getting 5, 4, 9 marks. I've already got it with my structure. I've already got my 9 marks with my structure. Plus, I'm getting 1 mark here, 10. 50% of my question is answered. I'm strategically thinking. Let's say you start writing into paragraph, you will not know where to stop. Therefore, points. It has to be points. You take Kaplan would have run into lengthy pages, but no, I don't want you to do that. That's out. I don't want you to do that. That's out. You understand my point? So don't run into lengthy pages. That's out. I don't want you to do that. Keep it very simple like this. Are we clear? Are we clear? Understood? Okay. Now, okay, I've got about good 3 points. I'm happy with my good 3 points. I don't want to go even further because I've spoken enough, right? Yes or no? Okay. Now, what are you comfortable with these two? Okay, always choose the comfortable areas. ROCE, you are comfortable. Okay, now with this, what are you comfortable? Net asset turnover, you are very comfortable. Okay, net asset turnover. If you think net asset turnover, you are very comfortable, you can go ahead and speak about net asset turnover. Okay, what can you speak about in terms of net asset turnover? Your net asset turnover has increased from last year to this year. Correct. So for your net asset turnover, what did you take? You took your turnover and you took your capital employed. Now that you're going to further invest, your net asset turnover, although looks positive, will in the future will increase or decrease? Decrease in the short term once again. Why? Because you are planning to bring in investments. So comparatively, comparatively, net asset turnover look much better to sector average. However, with with plans to invest in assets, this will fall. Correct? This will fall. But if you make the proper investments in the future, you will start making revenue. How many marks I have got already? 11 marks. Why do you think if you sell to supermarket, your net asset turnover is high?
When you sell it to the retail outlet, then the market is limited to customers.
Okay, so he is saying, Zian, our net asset turnover is high because our revenue is high. Our revenue is high because we are using the supermarket chain. Okay, now then I have another question. Okay, because we have a supermarket chain, he is saying, Zian, we have a larger customer base. But when you take the supermarket compared to retail outlet, in your retail outlet, you have only your product. In the supermarket, you have about 20-30 products. So my question is, what is the assurance that your product is being sold? So maybe I am thinking out of the box. You are big. Are you a big or a small company? You're a big company. Correct. You're manufacturing and you have retail, you have supermarket contacts. So you are a big company. Probably because you're big, you're able to buy materials at a cheaper price. Bargaining power, discounts. It also brings down to my next argument. My gross profit margin looks slightly better because there is a lot of cost savings in terms of acquisition prices. You understand? Because you're big. That's something that you can talk about. Clear? Okay. Gross profit margin is a major area we have to speak about in the exam. Gross profit margin is a major area that you need to speak about in the exam. Are we clear? So, number one, what can we talk about? Gross profit margin has not reduced, my dear. Gross profit margin is below the sector average. So, for you to say it has reduced, you don't have enough information. Am I clear? So, it has, I wouldn't say it has reduced. There's nothing to say that it has reduced. Guys, can you give me 5 minutes? I have to take a call. I'll be back. Okay. Just go through it. Okay. I'll be back. Okay, done. Are we clear? Are we clear? Okay. Now your GP margin is quite okay. Is quite okay. But we are trying to compare the sector which is entirely made up of retail sales with you who who has both retail sales and supermarket sales. So our margin is a bit low. So this comparison itself is not a great comparison. Okay. So we can say GP margin of T looks quite okay compared to the market, to the sector. T operates through retail outlets and supermarkets. Correct. Therefore, 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 revenue, therefore, the margin, the profit margin through the supermarket, through the supermarket could be or market will be lower compared through compared to retail outlets. Therefore, lesser GP margin is justifiable. So now you see that is my first point. GP margin of T looks quite okay compared to the sector. T operates through retail outlets, and supermarkets. Therefore, profit margins through supermarket will be low compared to the retail outlets. However, the sector primarily operates through retail outlets. Oh, yes, it's a bit of a bigger point, but it's okay. Sometimes, yeah, it can go beyond one line, two lines, it's okay. But you have to communicate your point. But that is one point.
Margin is high because they are inventory sale.
Your GP margin is high because
Inventory sale.
if your inventory is high, what is happening?
Inventory is high.
Your closing inventory is high.
Will increase.
Yeah, but how do you know their closing inventory is high? Because of inventory holding period.
So other company must be having like low levels of inventory.
Yeah, obviously, no, because that's what the inventory turnover period also states, no. So he's saying they are holding high level of inventory. Because they are holding high level of inventory, your GP margin could be affected. So number two, further GP margin could also be overstated due to high level of inventory being held, therefore reducing cost of sales. Correct? Okay, taken. Okay. Number three, your purchase price can be very less because you are big. Number three, it appears that trade is a big company. Therefore, it could also have high cost savings with purchase prices. In other words, high bargaining power with your suppliers. This could have contributed to higher GP margin. Having said that, these comparisons are not reasonable. I would say the comparisons are not reasonable. Further, the comparisons are not reasonable to understand a proper picture of GP margin due to the sales mix. You understand my point? So already 1, 2, 3, 4, 5, 6, 7. I've got 7 here, 5, 12 plus 1, 13 points. I have 13 marks. I have another 7 points to give in the exam. Are we clear? Are we clear? Okay. Operating profit margin, obviously I have to speak about it because I've got a lot of points to talk about on operating profit margin. So there itself, with operating profit margin itself, I can crack about 15 to 16 marks in the exam. That's how you plan your answers, my dear. You have to plan your answers. You can't be all over the place. Okay, number one, operating profit margin looks way too lower than the industry. This could be due to several factors. PPE, property, plant and equipment, repairs and maintenance costs could be very high. PPE, T is looking to replace its property, plant and equipment. Therefore, there could be high repairs and maintenance cost for the existing PPE. That is one reason. Number two, we can talk about we can talk about what can we talk about? Higher depreciation. I'm not buying that. Higher depreciation, I'm not gonna take that right now, because higher depreciation will come, my dear, if you start purchasing assets now. You have not purchased assets. So distribution cost, I'm happy to take distribution cost. Okay, so another reason for operating profit margin to fall could be due to the distribution cost. The distribution cost, as T is distributing to the supermarkets. These costs could be killing the operating profits. Are we clear? And then you have old assets. Number three, you have old assets. Now, if you have old assets, what's the problem? Your wastage is high. So therefore, what do you have to charge? Therefore, you have to charge impairment. You have assets probably which are damaged, so impairment cost also could be high. Another further with assets it appears with operating cost it appears there could be impairment which is affecting the operating profit margin even further. Okay. Hmm. Hmm. The original cost of these assets, original cost was 637. Right now we have 61,984. It also speaks about depreciation, impairment. We do not know if there were any disposals, revaluation loss. There could be so many reasons. You understand? Are we clear? Super. Okay. So how many marks have I got so far? How many marks have I got so far? So for how many marks? 16 marks. Now in the exam, I have to make sure I immediately get my 4 points sorted, 4 marks sorted and finish it off. I should not give too much of information also. Okay, I got to make sure I've given 16 points. Immediately give some points, get my 4 marks some way. Okay, so I can come back to current ratio, but remember current ratio, I have a lot to talk about current ratio. Current ratio is low, my working capital is financed by overdraft. There's a lot of problems. My payments, my receivable days are also affected. I know that my payments are affected. So I don't want to give too much of information to the examiner, because under exam conditions, I might have about 40, 45, 30, 35 points. No, I don't want to give everything. I want to immediately cut down on my points, get my marks, go further. Okay. But since I'm doing it, I'm going to give you some good points so that you will keep everything in your mind. Okay. Current ratio. Now, look, when you look at current ratio, is it low or high? Low. So, is it a problem or not a problem? It is a problem. Current ratio is quite high, quite low. Okay, right. So, let's start saying current ratio. Now, I'll be giving points like 1, 2, 3, 4 for examiner to know. Okay, look, I'm exactly talking about my marks. Instructing the examiner, hey, look, this is my point, this is my mark, give me. We are cornering the examiner. I'm properly cornering the examiner. I'm telling you 1 point, you have to give me 1 mark, because that's what you say in the examiner's article. Give a point, I'll give you 1 mark. So I'm making sure I tell the examiner, hey, look, I'm giving you this point, you have to give me my mark. Okay. Current ratio is quite low compared to the sector. In other words, T is struggling to meet its liabilities on time. Because of that, if you're struggling to meet your liabilities on time, are you creating a positive goodwill or a negative goodwill? Therefore, among stakeholders, T is creating a negative goodwill. That is number 1. Number 2, payments to our suppliers. If it doesn't go on time, that means we might lose out on bulk discounts. We might lose out on disruptions. There can be supply disruptions. I can talk about that. With the current ratio being too low, this can impact supplier payments, bulk discounts, and 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 disruption to supply of goods. Correct? Of goods by the suppliers. This has to be immediately resolved. This has to be immediately resolved. Are we clear? Are we clear? Duty on payments. Number 2 done. Number 3, what else can I think of? Cash is a major concern. With cash being a major concern, what did we do? We opted for a dividend payment. With cash bleeding, T has opted for a significant dividend payment. This doesn't look justifiable, and reasons for this has to be identified. Now I know in the exam how many points I've got. I've already got my 18-19 points. Correct? I've already got my 18-19 points. I've given good information. I've spoken about financial performance. I've spoken about financial position. Okay, at this point in the exam, nothing doing for me. I will immediately go off. I don't want to make it look beautiful. Examiner can find the points, give me the answer. I'm wasting time now. No, I'm giving too much of information. Now information overload. In the exam, at this point, no, nothing doing. I'll go back. I'll finish off my rest of the paper. Because I know solid 18-19 marks I'm getting here. I don't want 20 marks in the exam. Correct? The moment I know I'm getting more than 15 here, I'm done. I want to land in my 51st, then 95. Correct? I've landed in my 50 already. Now I don't want to mess up. I don't want to take more time. Oh, I want to look it beautiful. I want the structure to be nice. I want to bold this. I want italic. No. All those don't bloody matter. Here, my focus is 50. I've landed in 50. Now I've got more than 50 because I've explained it really well. Inventory turnover. Quickly, if you want 1 or 2 points, you can write in the exam. Out. You understand? Okay, here, inventory turnover. We already know is quite high. Why? Because we are selling to the supermarket. Because of that, what is happening? Probably there is a lot of inventory. So I might have to do inventory write-off. Once again, affecting my GP margin. Operating profit margin. Okay. Inventory turnover is quite high due to high volumes of inventory being held in supermarket. This could result in high inventory write-offs and could further impact profits. Correct. That's it. I don't want to go further because my points have already covered. I'm simply trying to do the patchwork. Gearing, very high. Gearing looks very high due to a borrowing this year, probably. Yes, it looks like they have borrowed this year. Correct? It's a concern. What's a concern? Your finance cost, can you actually cover it? With the profit, you can cover it. It shows about 4 to 5 times we saw earlier. Yes, it looks like they can cover, but still there will be problem with liquidity. Although there is problem with liquidity, interest cover of trade looks fine currently. Therefore, therefore, it's okay. Fine. I don't have to go further. My receivable days are quite high. Why? Because I'm selling it to the supermarket. Now I need to make sure that I speak about credit control, finish it off. Okay. Trade receivable days are quite high. Trade receivable days are quite high due to uh, high credit terms with with supermarket. Risk of bad debts is high, correct? Therefore, more credit control management to be implemented, and high level of cash is stuck. So if this can be resolved, liquidity can be improved further with inventory. So if you can push and sell the inventory, high level of cash is stuck with inventory. High level of cash is stuck with inventory. If this can be shortened, the liquidity issue can be resolved. That's it. I have my conclusion. Okay, so what I can do is I can bring the conclusion up. Overall, to make the above analysis more conclusive, we need the following information. So before that, I can say, now I have entirely analyzed, right? I can say, treat, although making profits and revenue, looks like they are struggling with cash. Questions to be raised regarding the dividends paid when cash is bleeding. Further, more, okay, further, in terms of comparison, the sector and T has different mechanism, making the comparison not really comparable. Overall, to make the above analysis more conclusive, we need the following information, and I'm asking for this information. In the exam, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Here, how many marks? 5, 21, 22, 23. I've given 23 points, but no, you have to make it to 20. You have to make sure that within the stipulated time period. Now I've given 3 points, no? So I could have worked out there. But for you here, you have to make sure that for the purpose of teaching, I've given you more points. So what you need to do is you need to properly structure your answers like this to get your marks in the exam. If you are able to do this, you can crack your entire 20 marks in the exam. But the thing is, this has to be your starting point, the structure. With this structure, it's easier to answer. But if you try to write in paragraphs, you're going to mess it up, my dear. Are we clear? Understood? Everyone, take few minutes, go through the answers, please. Go through the answers.
So in the exam, they give only this table, right?
Huh?
The exam,
Yeah. You have to work through this table.
the answer,
You can answer it. Yeah, itself, on the table itself. No problem.
let's say in the calculation, we should type.
Yeah, you can. Start working on the real ACCA platform and you will know it. Rishma, how's it? Did you understand, Rishma? Mock is at 2 o'clock. Yes, today we have the mock at 2 o'clock. Okay. I want everybody to do the mock. Only if everybody do the mock, my next marathon, you'll be a part of it. The mock is not here. We are not here to judge you. Okay. I am here to understand where you need help. So overall, I will be taking and I will be checking where I can help you. That's the reason for the mock. Okay. Rishma, you can follow entirely everything. Okay, anybody who has come first time for my marathon, you have not followed classes with me, but give me an A, please. I'll give you the link for the mock. Okay, give me an A if you have never followed classes with me, but you are here for the marathon only. I want an A. Okay, is it only Rishma? Okay, others have followed classes with me. Okay, the thing is, we have about 3 or 4 tutors for FR here. Okay, in PPIM. My methods are very different. Okay, by now you know it's very, I take steps, I give you steps, I get the answers. Okay, after logically teaching you. Rishma, you can follow my everything. If you have followed with another tutor, if you can follow everything except for consolidation. Consolidated balance sheet, mine is entirely different to other tutors, to Kaplan. My students know I give them about 4-5 steps, I get the answer. And taxes you can't follow because taxes mine is different to other tutors. I'll tell you that. I put 3 T accounts and get the answer. You know that. And leases mine is different. I put a T account, I get the answer. And construction costing, I put a T account, I get the answer. Put 2 T accounts, I get the answer. Yeah, I did. I feel in the difference in relation to consolidation. Yeah, you will feel a difference, Rishma. My methods are different, but you will get the same answer. Their methods are different. Okay, so each and every tutor has their own way of doing it, but the content can't go wrong. Now, if you look here, probably other tutors will recommend you to take it on a PDF, on a Word document. I don't know, probably, because when I see other tutors, that's what they do from other countries also. But I do it like this to make sure that it's easier, you don't miss out the points. I don't run into paragraphs because when you run into paragraphs, you will not know how much to write. It will go on like essays. So a point will give you a mark. A mark equals a point. A point is a sentence. A sentence is not anything more than 2 lines. You have to keep that in your mind. So Rishma, when you're coming here, probably you'll see differences in method. Don't get confused. The content is the same. The content is the same, no changes there. But if you get confused anywhere, just drop me a message. I will guide you as to how to get the answer. I know Kaplan method, I know my other tutors method, and I know my method. So if you are confused, I'll show you all 3 and I will connect and show you this is how you get the answer. Don't worry. But guys, right now, all of you, we have a good lot sitting for exams for this September. Okay. Now, 2 tutors, Shafi and myself. From Shafi's class is about 15 or 20. My class is about 20. I think about 40 students. Thing is, we have to run the race for a prize also. Okay, we know how to crack the answers. Now we should know how to get the prize. Now, right now, this is my, how many questions? This is my 6th question. 6th past paper question, street score. And I am not stopping there. I have a lot more to do. I'm telling you, I have another 20-25 days. I will be with you until the last moment of the exam. Okay? Super. Keep going. At 2 o'clock, we have the mock. Sharp 2, we will start. And at 4 o'clock, we are done with the mock. Okay. And I will be doing the mock with you in one of my marathon session. There are 11 here, 12, 13, 14, 15, 16, except for Hajira. Hajira has got a funeral. So all 16 will have to do the mock so that you can be a part of the next marathon. The mock is not to judge you. The mock is to understand where I have to improve with you, where I should give you more attention. That's it. Right. With that said, we can finish off the session. Okay, by the way, I know that, I have, in terms of my syllabus completion, I have IFRS 13 to do, which is about 5 to 10 minutes, which I will do it as a part of my marathon sessions. Okay. And conceptual framework, a few pages to run through. I'll do it parallelly. Okay. Superb. Good afternoon, everyone. You okay? How's it going? I'll bring my water bottle. Give me a second. Hi guys, hope you're okay. And let's start. I thought of we can start off with a full paper, let's start off with a full paper, right? So as a part of marathon, what I'm going to do is I'm going to work with two things, right? I'm going to work on two things. Number one, I'm going to do a paper, plus while doing the paper, I'm going to come back, cover the theory as well. So we cover both. Okay, super. Just give me a few minutes so that I can put up what I have on screen. Sorry, all okay? Yeah, why? The complaint is normally it's
cold, but it's
cold.
like 26. That's
Yeah, can't we change it? Fan is gonna generate a lot of sound, so it affects the sound quality.
So consider 24 usually.
Yeah, okay. Give me a moment. Guys online, how are you? You okay? Everybody? How are you? Strong. You okay, everyone? How's it going? Everybody, can you hear me? Everybody, can you hear me? Hello? Can you hear me now? Can you hear me now? Everyone, can you hear me now? Can you hear me now, everyone? Okay, brilliant. A very good afternoon, everyone, and welcome to our marathon session that we are looking at. We started off last weekend. We started off and we practiced some questions, and today here we are. We are going to complete an entire paper together. So I'm gonna do section A and B now, and tomorrow I'm gonna do section C. That's the plan for the day. And when I'm doing this mock, I will also go back, cover theory. I'll also go back, cover theory, take you through the theory so that you understand exactly theory as well as practice questions. Okay, super. Brilliant. So your exam is going to look something like this, right? You're gonna by now you would have obviously gone through papers, questions. So which of the following items does not, number one, does not represent the correct accounting treatment in accordance with IFRS 15, revenue from contracts with customers? Which of the following does not represent the correct accounting treatment in accordance with IFRS 15, revenue from contracts with customers? Okay, we know revenue is one of our primary standards, and revenue is obviously, like I told you earlier, is the backbone of any business. Revenue is important. So for us to make sure that revenue is recognized properly, we've been given guidelines on how we can recognize revenue. Well, revenue being one of the primary standards will be tested in every exam session, and you got to be very vigilant in the types of revenue. You got to be very careful in the types of revenue. Now, revenue, IFRS 15 gives us guidelines on revenue recognition, and IFRS 15 gives us 5 steps. IFRS 15 gives us 5 steps to recognize revenue. 5 steps to recognize revenue. If you have to recognize revenue, you have to make sure all these 5 steps have to be satisfied. Step number 1, identify the contract. Step number 2, hello. Step number 1, identify the contract. Step number 2, step number 1, identify the contract. Step number 2, identify performance obligation. Performance obligations are promises, what you are going to deliver. It can be a service, it can be a sale of goods. I need to understand that. Number 3, determine the transaction price for the goods and for the service or together. Number 3, allocate the transaction price between your performance obligation. Number 5, recognize revenue when a performance obligation is satisfied. Only when a performance obligation is satisfied. So we've got 5 steps. These 5 steps, after you complete, only you can recognize revenue. Number 1. Number 2, identifying performance obligation. If performance obligation is settled at a point in time, then recognize revenue at that point. If a performance obligation is satisfied over a period of time, then you are going to recognize revenue over a period of time. Are we clear? That is number 1. Number 2, agency sales. We would have studied agency sales. Agency sales is where one party is trying to get a product from another party and sell it. So you have an agent. If there is an agency sale, you are going to recognize revenue commissions only in revenue. So if there is agency sale, you are going to recognize commission only in revenue. Commissions only. So there can't be a sale, a total sale. You will only have a portion which is your commissions. That's it. Are we clear? And in cost of sales, you don't have anything. Sale or return. Sale or return means you either sell, they sell, or they can return it back. So if control over the goods does not pass to the buyer, meaning risk and reward is not passed to the buyer, then do not record any revenue. Okay, so sale and repurchase. Sale and repurchase means you are selling right now, but you are agreeing to repurchase. In a sale and repurchase agreement, if control over the goods does not pass to the buyer, once again, do not record any revenue. Treat the proceeds as a loan and charge interest to the date of repurchase. If obligation is satisfied over a period of time, like construction cost, over a period of time, record revenue and expenses based on progress. For loss-making contracts, provide full provisions immediately. If it's a loss-making contract, onerous contract, in line with IAS 37, immediately provide. If the progress is not known, if we do not know the progress, then recognize revenue to the level of how much cost you can recover. In the statement of financial statements, record receivable if revenue exceeds the amount received. Record work in progress, work in progress construction cost if cash spent exceeds cost of sales. Record liability if cash received exceeds revenue. Record provision if contract is loss making. So basically you need to know these transactions. You need to know what is an agency sale. You need to know what is sale or return. You need to know what is sale and repurchase. And at least you need to know what is sale and lease back. Are we clear? Done? Super. Which of the following items does not represent the correct accounting treatment in accordance with IFRS 15 revenue from contracts with customers? Quickly, give me the answer. I will, but right now you want it?
Yes, let me do it.
Okay. Can't you see the screen? Okay, I've shared it also with you. Answer. Okay, Zamin says D, Naresh says D. Treating a sale and purchase as a loan rather than a sale. If control over the goods has not passed to the buyer. Treating a sale and repurchase as a loan rather than a sale if control over the goods has not passed to the buyer. Does it represent the correct accounting period or does not represent the correct accounting period? Okay. Where a sale agreement has a significant financing component, recognize the initial sale at the present value. Represent or does not represent? Significant financing component, if there is, then you have to recognize it at present value. It represents. When a package of goods are sold together at a discount, recognize applying the discount to all the parts if none are ever sold separately at a discount. It represents or does not represent? Okay. Recognizing no revenue in relation to a 3-year service contract until the service is completed at the end of the 3rd year. Represents or does not represent? Does not represent. Answer D. But you can have surprises in the exam. When a package of goods, okay, you have package of goods 5, 10 together, you can't sell them separately. So when you have to apply discount, obviously you have to apply for everything because you can't sell it separately. Answer D. In what order should the assets in a CGU be impaired? CGU, what is the accounting standard? Coming back, what is the accounting standard? CGU, what is the accounting standard? IAS, CGU, IAS 36, impairment of assets. Now don't give me the wrong standards, okay? No, please make sure that you know the accounting standard, okay? IAS 36, impairment of assets is intended. Why do you need impairment? Why are you studying impairment? You are studying impairment of assets to make sure that you are in line with prudence concept. You are not overstating your assets. So to be in line with prudence concept, we calculate impairment. Impairment means what? Impairment means loss. Impairment of assets means loss in value of an asset. So to calculate the loss in value of the asset, the standard provides us guidelines. IAS 36 impairment of assets. IAS 36 impairment of assets is intended to avoid the possibility that non-current assets, whether tangible or non-tangible, are carried at excessive amounts in the statement of financial position. They are not carried beyond what we can recover. So their recoverable value is compared to their net book value. Their recoverable value is compared to their net book value. So I'll take the recoverable value and I'll take the net book value. Net book value is cost minus accumulated depreciation. Recoverable value is the higher of value in use of NRV. NRV is my selling price minus cost to sell, like your inventory. We know that. Indicators of impairment. Okay, when can you have impairment? You can have impairment if the asset has a problem, damage, operating losses, technological advancement, obsolescence, physical damages, anything can cause an impairment. Impairment losses are charged to P&L. We know that. Impairment losses we take it to P&L unless otherwise the asset has been previously revalued, except to the extent that they have been a reversal. Recognized gain or revaluation, in which case that part will go to the revaluation reserve. We know that. Summary of accounting treatment. Debit impairment, credit the asset. If it's previously revalued, then you debit your revaluation, and then if there is any excess, you take it to the P&L and then you credit the asset. A cash generating unit. What is a cash generating unit? A cash generating unit is a combination of assets which generates cash flows. For a cash generating unit, what you can do? You can charge impairment. So a cash generating unit is the smallest group of identifiable assets that can generate independent cash flows. An impairment loss on CGU occurs when revenue stream is damaged for the entire CGU. In that case, what do? Allocate impairment loss with the following write-down rules. What is the write-down rules? First, you, if there is a loss, any losses, you go and allocate. Goodwill allocated to CGU. Remaining assets on a pro rata basis. Are we clear? Yes or no? Super. In what order should the assets in a CGU unit be impaired? Answer. 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 Guys online answer? Guys online answer? Guys online answer? Number one, obviously any impaired assets. Obviously any impaired assets. After that, goodwill. Then all other assets on pro rata basis. Answer A. Anyway, if you are going with B, right, Naresh, this can't come second, right? This has to come last, obviously. Correct? So that is wrong. So any obviously impaired asset, purchase goodwill, all of the assets on a pro rata basis. Which of the following conditions must be met in order to capitalize borrowing cost? Borrowing cost. What is borrowing cost? Borrowing cost means cost of financing. The finance cost is borrowing cost. Now, if you are going to construct an asset, or for a qualifying, if it's a qualifying asset, a qualifying asset is an asset which takes a substantial time period to be put into use, minimum 1 year. Now, if you have a qualifying asset and if you have taken money for a qualifying asset, for this particular asset that you are building, finance cost can be capitalized. Generally, finance cost is expense, but for this particular asset, you can capitalize. Okay. Now let's go back. Borrowing cost. What is borrowing cost? IAS 23, borrowing cost, deals with the question of whether the finance cost incurred in the construction of a building can be capitalized or not. For an asset can be capitalized or not. Borrowing cost must be capitalized as a part of the cost of the asset if that asset is one which necessarily takes a substantial time period. Substantial time period means minimum 1 year for its intended use or sale. That is, in other words, a qualifying asset. Commencement of capitalization. You can capitalize when the conditions are satisfied. What are the conditions? Expenditure being incurred. Your expenditure, you have started the construction. Borrowing being incurred. I have borrowed. Because I have borrowed, then there is finance cost. Work has commenced. The work of constructing has started. Now, if the conditions are satisfied, then you have to. Capitalization should be stopped when the asset is ready for use or the construction is suspended. Are we clear? Yes or no? Superb. Why am I going there always? Okay. Which of the following conditions must be met in order to capitalize borrowing costs per IAS 23? Quick. Hiroshi, answer. Janudya, answer. Lashita, answer. Shan, answer. Naresh. Asma. Oh, where's Rishma today? Is it Mohammed's iPhone is Rishma? Answer. Expenditure for the asset is being incurred, yes or no? Yes. The loan to finance the construction of the asset has been taken out, yes or no? The loan to take out to finance the construction, that means you have taken money, borrowing cost is incurred. Borrowing costs are being incurred. The loan is taken. Loan is taken means obviously I have taken the loan for the asset. Activity is necessary to prepare the asset for its intended use. It is not prepared for intended use. You are still preparing for its intended use. Or sale in progress is happened. Yes or no? Yes, all four. Answer D. Are we clear? Frog purchased an asset on 1st of January 2017 at a cost of 90,000. Frog received a grant in relation to the cost of this asset of 15,000. Okay, you are receiving a grant. IAS 20, accounting for government grants, disclosure of government assistance. So IAS 20 gives us guidelines on what? IAS 20 gives us guidelines on. Now, if we basically what happens is if we if there is a government grant, meaning we are going to put up something, or we are going to we are starting a new factory, the government is giving us a grant. Now this grant can be either a revenue grant or it can be a capital grant. If it is a capital grant, we have been given guidelines as to how to account for it. If it's a revenue grant, we've been given guidelines as to how to account for it. So the standard has given us guidelines. IAS 20 accounting for government grants and disclosure of government assistance deals with grants which are provided by government in respect of capital or revenue expenditure. Super. Now if it's a revenue grant, we are getting some income. If it's a capital grant, we have been getting some money to purchase an asset. Correct. So if it's a revenue grant, what we can do, we can set it off against an expenditure. We can show it as an income. We can set it off as an expenditure or show it as an income. So a government contribution towards the cost of wages, for example, for wages, can be presented as a credit income in the statement of P&L or deducted from a related expense. If it's a capital grant, there are two accounting treatments: either set off against the asset or show it as deferred income. A government contribution towards the cost of a new piece of a machinery. Now if it's a capital grant, you have two presentation choices. Number one, net grant off against the asset, set off against the asset, reduce the depreciation amount. Number two, if it is a capital grant, you can show it as a deferred income. In that case, what do? Capitalize the normal value of the asset and depreciate as normal. Treat the grant as deferred income over the useful life of the asset, set it off. You understand my point? So release the grant income statement over the asset's useful life. What is this concept known as matching concept? Are we clear? Now in this case, what is the grant that you are doing? It's the capital grant or revenue grant? What is the grant, capital or revenue? In this case, it's the capital grant or revenue grant? It's a capital grant. So capital grant, you have two choices. One, set off against the asset or treat it as a deferred income. What are they doing here? Are they doing the set off? Okay, it's a set off. Super. They are doing the set off method. Okay, fine. They want to know what is the carrying amount of the asset as at 31st December 2017. Carrying amount of the asset as at 31st December 2017. I'm giving you, okay, for this particular question, you can't take more than 2 minutes in the exam. 2 minutes, give me the answer. 2 minutes, give me the answer. 2 minutes, give me the answer. I've already got an answer. Naresh says answer D. Asma says answer D. Chamudi says answer D. Superb. Guys online, you're doing a brilliant job. Oh, Rishma is here. Hi Rishma, you okay? Go on. Rishma, answer. Hazik, answer. Janodia, answer. Lashita, answer. Superb. Answer. Answer D. E is not there. Okay. D is there. Okay. D is there. Answer. But what do you have? You got 80,000. Answer B. I've got one B. I've got several D's. Okay. Shall we? Superb. Frogco purchased an asset on 1st of January, but your year end is 31st December 2017 at a cost of 90,000. Frog received a grant in relation. Okay, you know the cost of the asset. The cost of the asset is 90,000. And you are receiving a grant. How much is the grant value, my dear? Grant value is 15,000. Superb. So therefore, if you are setting it off, you have 75,000 remaining. Yes, the standard says yes, take 75,000 and calculate depreciation. How long has it been? 1 year. 1st of January, 31st December, my dear, it's 1 year. Correct? So what's the useful life of the asset? The useful life of the asset is 9 years. So 75,000 divided by 9 gives you 8 point I just started the session. I just started the session. So basically what I'm doing is I'm doing my marathon. Basically I'm doing the question. While doing the question, I'm going back to the standard. I'm taking you through the standard and coming back to the question. So you understand both. It's been about 20 minutes since I started. I've done 4 questions. I'm doing a paper entirely. Okay. So basically how much is it? 8,333. 8,333. By the way, I have marked your marks, entirely done. I have your marks with me also, don't worry. I'm discussing the question tomorrow with you, the mock with you, and then I'll give you the marks also. Okay. Most of you all are in your border. Okay. I've shared my overall feedback. Most of you are in your border. Some of you have scored pretty okay. I don't have a wow marks from anyone. So I will do the past paper with you tomorrow. I'll do the entire question with you, and after that I'll also share your script with you. I'm entirely marked, don't worry. Okay, 8,333. Therefore, your netbook value, they want to know your netbook value. Your netbook value will be, my dear, your netbook value will be 75,000 minus 8,333 gives you 66,667. Answer D. Are we clear? Answer D. Guys online, everybody, are we clear? Superb. Let's get going. What is the diluted EPS to be disclosed in Coral's financial statements for the year ended 30th September 2015? Diluted. The word diluted means in the future, if things change, how will your EPS be affected? EPS is one of the primary shareholder ratio. Earnings per share is one of the primary shareholder ratio. Generally, earnings per share is calculated as your total earnings over number of shares. But when you take this EPS as a figure, your earnings and your number of shares, they can be affected. They can be affected if you have issued any convertible loan notes. If you have issued convertibles means right now it is a liability, in the future it can become a share. You can convert it into shares. Or if there's any share warrants where you have told your employees, hey, look, I am giving you shares, in about 5 years time you can convert the shares. When it comes to a diluted EPS, we are assuming everything that we have right now in the future will be converted. We are giving a warning to our shareholders. Say, look, this will be converted. If this is converted, this is going to be the impact in your EPS. Are we clear? Okay. Basically, it's very straightforward if you understand what will have an impact on our profits. So we are going to understand what is going to have an impact on our profits. Okay. C course net profit for the year ended 30th September 2015 was 10,500,000. So we have a company, the net profit is 10,500,000. C has 6 million shares in issue for many years. So already you have 6 million and this is your profit. Now you know your basic EPS will be your earnings, that is 6 million over your, your earnings 10.5 million over your 6 million. That is going to be your basic EPS. But then again, what is happening? Very simply, in the future there is going to be a dilution. That is the reason they are talking about diluted EPS. Okay, what is going to be the dilution? On 1st of October 2014, Coral issued 3 million convertible bond. Okay, you are issuing a convertible bond. Meaning it's going to be converted into shares. Although your examiner might not say, you assume it will be converted. Are we clear? The liability element was initially calculated at 2.5 million and the market rate for bonds with no conversion is 8%. They say they have calculated the liability 2.5 million. You know how we calculate present value of future cash flows is for convertible loan notes, and there is no conversion option. So with a conversion option of 8%. The bond is convertible in 5 years time with 50 shares issued for every 100 nominal value of convertible bond. C pays taxes at a rate of 40%. All what you have to do is you have to take your earnings and you are going to see what will impact your earnings. Your earnings, now right now you have a liability, no my dear. In the future this liability will change into equity. In the future if this liability changes into an equity, meaning you will not have to pay finance cost. Correct? Meaning your net profit in the future will go up or come down? Go up. So,
But there is another problem. Right now you are paying interest, no? Because you are paying interest, your taxes will be lower. Why? Because your interest will bring down your profit before tax. So in the future you are going to lose that benefit because there is no interest. So primarily there will be two impacts. Number one, your interest will come down. Correct. Number two, your tax savings will be reduced. So two impacts will be there. So we are going to calculate these two impacts and then your number of shares will also go up. Are we clear? Understood? Super. Now let's try to do it on Excel itself so that it's easier for us. Okay, I'm going to just do the marathon on a separate worksheet, okay? So let me call it. Anybody with the answers? Anybody with the answers? So far? Anybody with the answers? Marathon. This is diluted EPS. Anybody with the answer? Anybody with the answer? Anybody with the answer? Okay, I've got an answer already. Anybody? Okay, so for us to calculate our diluted EPS, first thing that we need to know is, okay, how our profits is affected. Okay, Lashita has given me an answer as well. So basically I have my earnings. My earnings is given as 10.5 million, 10,500. So my earnings is going to be affected. If I convert my liability into shares, my earnings is going to be affected. Okay, now how will my earnings be affected? I'll have a positive impact because I'm going to save on interest, correct? So that's going to be interest saved. I'm going to add. How much will be my interest saved? I have a liability of 2.5 million for which I'm paying 8% interest, correct? So 2,500,000 into 8% will be my interest paid. So equals 2,500 into 8% will be my interest paid. Am I clear? I will lose my tax benefit. So tax benefit lost. My tax benefit lost will always be my 200 into my tax percentage. My 200, that is my interest into tax percentage. If you want to know the formula in the exam, in other words, loan into tax percentage, loan into interest percentage, loan into interest percentage, number one. After that your tax benefit will be interest into tax percentage. Are we clear? Which is equals 200 into how many percent, my dear? Into 40%, which is going to be 80. So this 80 I am going to lose it, right? So equals 10,500 plus 200 minus 80. So 10,620, I call it my adjusted profits. Now, not only profits, no, my dear, my equity will also have an impact. My share capital will also have an impact. Why? Because loan is being converted as equity. So basically, what will happen is I have to do adjusted share calculation. Adjusted shares. Now, already how many shares do I have? Already I have 6 million shares, correct? Now I have 6 million shares. So existing shares 6,000, and there are convertibles. Now my convertibles are going to be, my dear, 50 shares for every 100 nominal value, correct? So basically I have how many shares? I have 6 million shares, correct? I'm gonna go my convertibles are 3 million. My 3 million convertible bonds, I am going to 3 million convertible bonds, I am going to convert it into shares, correct? From loan, it's going to become shares. In other words, my 3 million bond value will go down by 50 over 50. For every 50 shares, it will be 100 into 100. Therefore, 3000 over 50 into value 100, it will go up by hold on. It's not 3000. 3000 over 100 for every 100. For every 100 nominal value, I am giving 50. For every 100, I am giving 50. I'm sorry. Every 100, I am giving 50. Why is there a problem with the formula? For every 100, I am giving 50. So that's 1500. So existing shares is 6000. In the future, I am going to convert my loan into 1500 new shares. So therefore, my adjusted shares will be 6000 plus 1500, which is 7500. Therefore, my diluted EPS will be equals 10,620 over 7500, which will be 1.4. 1.42. Answer D. I think some of you all got the answer. 1.42. Correct. Are we clear? Taxation. Our most interesting area. For taxation, I have given you a simple shortcut. The moment you come into tax, the moment you get to tax, the moment you come to tax, all what you have to do is you have to put up 3 T accounts. If you see taxes in the exam, you have to put 3 T accounts in the exam. That's it. 3 T accounts, you get the answer. Okay? That's the formula. Okay. How are we going to do it? Let's see. In the exam, for taxes, what do we do? Draw 3 T accounts. How do you call the T accounts? Income tax account, tax payable account, and deferred tax account. You put up 3 T accounts, very simple steps for taxes. You put up 3 T accounts, take brought forward figures. Take brought forward directly. Step number 2, account for current year taxes. Step number 3, account for deferred tax using a formula. What is the formula? Formula will be accounting written down value minus tax written down value into tax percentage. That's it. So let's put up 3 T accounts, okay? So in the exam, it's a matter of me putting up 3 T accounts. So I have my T account number 1, my T account number 2, and then I have my T account number 3. Okay, how do I call it? Income tax account, tax payable account, and deferred tax account. Now see, I have not even read the question, okay? The moment I see taxes, all what I will do is I will put up 3 T accounts. That's it. That will make my life very, very, very easier. Okay? Once I put up my T accounts, I will take the brought forward figures. My brought forward figures, okay. DCO has the following balances included on its trial balance on 30th June. Tax credit 6,000, deferred tax 24,000 credit. Okay, brought forward. Income tax how much? 6,000. Deferred tax how much? Debit or credit? Credit. How much? 24,000. Guys, was that difficult? That's not difficult, right? I mean, don't come and tell me that is difficult, okay? Put 3 T accounts and take the opening figures, brought forward figures. That's it. Once you're done with that, what do? You have to account for now step number 1 done. Step number 2, what is it? Account for current year taxes. Okay, are they talking about current year taxes? Let's go. The balance on the taxation relates to an over provision at 30th June 2014. The directors estimate that the provision necessary for the current year profit taxes is 30,000. Okay, how to account for current year tax? Debit taxes, credit tax payable. Debit taxes, credit tax payable. If it's a refund, credit taxes, debit your tax receivable, that is your refund. So here your step 2 will simply be debit income taxes and credit tax payable. So I come here, how much is my income taxes? They say 30,000. So I will debit here saying TP tax payable. I'll credit here saying IT, how much? 30,000. That's it. And then finally, what do they say? The carrying amount of L's non-current assets at this date exceeded the tax written down value. Accounting written down value exceeded the tax written down value, meaning accounting written down minus tax written down value, that is the tax basis given to us already. They have given us how much is it? 60,000. Tax rate is 30%. So they say directly our carried forward is how much? Equals 60,000 into 30%. If they have not given you that directly, they would have said accounting written down value and tax written down value, they have given you the figures. If they have given you, you have to just simply deduct it and get the tax percentage. Are we clear? Super. So I have how much here? 24,000 equals 24,000. 24,000 minus 18,000 gives me 6,000. Where do I take this 6,000? Income tax. Income tax. I take the 6,000 to my income tax. Yes or no? I debited my deferred tax. I credit my income tax. I'll say DT. How much is that? Equals 6,000. So therefore equals sum. Okay. On my. Oops. So 30,000 equals 30,000. You have a difference of 30,000 minus 12,000. Correct? Where do you take it? To your P&L. This goes to your P&L. 30,000 equals 30,000. Carried forward to your balance sheet, how much? 30,000. Exactly what I taught you. I'm not deviating any way from what I taught you. Yes or no? Simply we are getting the answer. Okay, what is the requirement? The requirement is what are the balances that will appear in the statement of financial position as at 30th June. What are the balances? Answer. For deferred tax and taxation. But it's for statement of financial position. Statement of financial position means is this account relevant for me? No. Okay. Carried forward. Tax payable how much? 30,000. Deferred tax how much? 18,000. 30 and 80, where do we have it? Answer B. Are we clear? Yes or no? There you go. Guys online, everyone, guys online, everyone, are we clear? Guys online, everyone, are we clear? Guys online, everyone, are we clear? Okay, probably if you have not come for classes with me, this might look a bit different. Okay, how I get my answer is by simply putting 3 T accounts, I get the answer. But if you followed the classes with another tutor, they would have followed a different pattern. That is also fine, this is also fine, whatever you are comfortable with. Okay. What provision should be made for the cost of the repairs? Provision. What is the accounting standard? IAS 37. Provisions for accounting for provisions, contingent liabilities and contingent assets. Okay, let's go to IAS 37. IAS 37. Okay, let's go to IAS 37. Where is IAS 37? Okay, IAS 37, provisions, contingent liabilities and contingent assets. Okay, IAS 37 gives us guidelines on what, how to account for a provision. Provision has been a major problem in terms of how we account it, because with provisions you can smoothen your profits. Provisions can help you smoothen your profits. So it's a bit of a problem in terms of accounting. So Provision. The accounting treatment for provision is dealt mainly by IAS 37 provisions, contingent liabilities and contingent assets. This is an area where there have been a lot of abuses, confusions in the past. This means that the rules are complicated. A provision is a liability. A liability is a contractual or constructive obligation. A provision is a liability. Liability is a contractual or constructive obligation for cash flows. So, but when you take a provision, it's a liability which is uncertain, with uncertain timing or amount. You are not sure of the timing when you are going to pay or amount. You will only recognize a provision if you have a present obligation, legal or constructive. As a result of past event, it is probable, it is going to be a cash outflow. Probability, we have been given guidelines: virtually certain, probable, possible, remote. So based on these criteria, what you will be doing, you will be recognizing a provision. So in a provision, there is an outflow of economic resources, economic benefits. A reliable estimate has to be made for the amount of the obligation. Provision cannot be recognized in the absence of a present obligation. You require an obligation, contractual or constructive, because companies in the past have recognized provision in order to smoothen their reported profits. Large provisions might be made in good years and then cancelled in bad years to make sure that they create a steady trend in profit. This is particularly true in case of provisions for reorganization. Provision for reorganization. Now you are going to do a reorganization of your staffs. If there is a reorganization cost, all what you have to do is, if you are going to do a reorganization, you have to make it public. Reorganization costs can be provided if there is a detailed plan for reorganization by the company, which with a valid expectation, and those who are affected will have to be notified. An important aspect of IAS 37 provision is overhaul cost. Overall cost means major repair cost. Major repair cost that you are going to that you have a repair cost in the future. Maybe if you are an airline, if you are Sri Lankan Airlines, for example, okay. Now when you take Sri Lankan Airlines, every 30 years you have to repair your engine. With Sri Lankan Airlines, every 2 years you have to do it. Now, if you're talking about something like Emirates, a proper airline, you're talking about every 30-35 years you have to do an overhaul expenditure, a major repair expenditure. But you're going to do it in every 30 years, no, for example, 25-30 years, no. You can't go and provide a provision now. Standard does not allow it. You can't do it now. Are we clear? Some companies, they will try to charge overall cost every year. Now probably in the question that you did, Huston had overall cost, the ratio question for the mock that you did, and you did not know how to account for it. Yes or no? So overall cost cannot be provided, the standard does not permit. The amount recognized as provision has to be a realistic estimate. You should be able to arrive at an estimate. It has to be a prudent estimate of the expenditure, need to settle the obligation existing as of the reporting date, and you have to discount back to net present value if the value goes beyond 1 year and if it is material. Contingent liability and contingent asset. A contingent liability is a present obligation. Once again, it's an obligation. It has to be disclosed. Generally, it is disclosed. A contingent asset, on the other hand, for one party it is a provision, for another party it is a contingent. For example, insurance claim. Insurance claims are contingent assets. Okay. So coming back here, what provision should be made for the cost of the repairs? Okay, there is a cost of repairs on top. What is the amount of provision you should make is the requirement. Okay, I'll give you 2 minutes. Give me the answer. I'll give you 2 minutes. Give me the answer. Today is the 15th or 16th of August? 16th. Okay, guys, I'll quickly pray and come. Please do this. I haven't prayed yet. I'll be back. Give me about 5 minutes. So sorry. So for major defects it's 2%, 2% of 80,000, minor defects 3%, 3% of 12,000. So total put together 1,960. 1,960 is your provision. Answer B. Are we clear? Are we clear everyone? Yes or no? Are we clear everyone? Are we clear everyone? Yes or no? Am I clear? Okay, superb. Let's get going. Number 8. In the consolidated statement of financial position, as of 31st December 2015, what amount should appear for non-controlling interest, NCI interest? Meaning NCI share of net assets, entire NCI share of net assets. Okay. W acquired 70% of the share capital of P on 1st of January 2012. On 1st of January 2012, your year end is 31st December 2015. So, is it a mid-year acquisition? It's not a mid-year acquisition. For how much did you acquire? For 300,000. The goodwill arising on the consolidation has been impaired by 50,000. They say the goodwill has been impaired by 50,000. The share capital and reserves of the two companies as at the year end is given below. At the date of acquisition, P had a retained earnings of 125,000. W measures the NCI interest as the proportion of net assets of the subsidiary. Proportion of the net assets of the subsidiary means NCI goodwill will be how much? NCI goodwill will be how much? Proportionate net asset basis. 0. So that means basically what you need to do is calculate share of net assets and then you have to calculate goodwill because there is goodwill impairment. Do you understand my point? Okay, super. Therefore, share of net assets we have to calculate and then we have to calculate goodwill. So for goodwill, what do I need? Investment cost or fair value of consideration paid. How much is your investment cost? How much is your investment cost? Your investment cost they say is 300,000. So you can take your investment cost equals 300,000. From this, less acquired net assets. What are the acquired net assets? What are you acquiring? You are acquiring share capital. Your share capital is how much that you are acquiring? Share capital is 150,000. So share capital is 150,000. Share capital is 150,000 and no share premium. You have retained earnings. How much your retained earnings at acquisition? Retained earnings at acquisition is 125,000. Okay, 125,000. Therefore, your total will be no fair value adjustments, right? So 275,000 into how many percent are you acquiring? Into 70%. Therefore, 275 into 70% gives you 192,500. Therefore, your goodwill is 300 minus 192,500, 107,500. Did everybody get 107,500? Yes or no? Did everybody get 107,500? Yes or no for your goodwill calculation? Everybody? Yes or no? Okay. They say your goodwill has been impaired. Your goodwill is impaired by how many percent? Oh, they have directly given us 50,000, no? Sure. They have given us 50,000 directly. They have directly given us 50,000. Okay. Okay, they have directly given us 50,000. So basically what we have to do is share of net assets only. Your share capital. How much is your share capital? Subsidiary share capital is 150,000. 150,000 subsidiary share capital. And then retained earnings. How much is the retained earnings? 200,000. So equals 200,000. Okay, small thing we missed out. Okay. Now see, basically there is no NCI goodwill. We know that there is no NCI goodwill. So there won't be any impairment relevant for NCI. So there is no NCI goodwill. So there is no NCI relevant NCI impairment relevant for NCI. So that is entirely out. So basically all what we will do is we will take the share capital retained earnings total, share capital retained earnings total into how many percent? 30%. So see, we have been misled. Sometimes we are misled. What do? The moment we see, okay, there is goodwill, we think, okay, fine, there is a portion for NCI, and we start calculating NCI goodwill. But no, basically no, because they say proportionate net asset basis, right? So NCI goodwill is not relevant. Answer will be how much? Directly 105,000. 105,000. See, small things we can get confused in the exam. Small areas we can get confused in the exam. We were trying to calculate goodwill right here, taking all the information and trying to calculate goodwill, but that's not even relevant for us. Too many information given just to confuse us. So we have to be very careful in the exam. Understood? Are we clear? Superb. So answer 105,000 done. Here, what will be the balance on the consolidated retained earnings as at 31st October 2018? What will be the balance on the consolidated retained earnings? Parents' retained earnings and subsidiaries' retained earnings together. So to calculate consolidated retained earnings in the exam, what will I need to calculate consolidated retained earnings in the exam? I'll require parents' retained earnings, and then I'll require subsidiaries' retained earnings. Okay, this will have an impact. If there is any impairment. I'll adjust. Okay, so subsidiaries retained earnings, I require subsidiary retained earnings today at acquisition. Superb. This is all I need. These are my figures in the exam I need for consolidated retained earnings. Now we know, okay, fine, we have to be much more careful. Examiner can confuse us. Correct? So now we are going to be much more careful. B acquired 90% of A's $200,000 one ordinary shares for 800,000 on 1st of July 2014, when the balance on A's retained earnings stood at 460,000. So you acquired 1st of July 2014, your year end is 31st October 2018. We know it's not a mid-year acquisition. Let's go further. B measures NCI interest using fair value method. Now it's not proportionate net asset method, it's fair value method. In that case, if there is impairment, it will have an impact. Correct? Super. At 1st of July 2014, the fair value of NCI not owned by B was 60,000. Not owned by B. Immediately your examiner is trying to confuse us with grammar. Not owned by B. Generally they will directly say, no, the NCI interest for 10% is this amount. Now they are saying, no, not owned by B. Now see the way they are confusing you. You sit and think, what the hell is this in the exam? Meaning they are given us directly the NCI investment cost. At 31st October 2018, the balances of retained earnings of two companies were as follows. Meaning, as at the year end, they are given us the balance of both the companies. An impairment review at 31st October 2018 indicated that 30% of the goodwill on acquisition was impaired. Now you have to calculate goodwill, my dear. No choice now. Now you have to calculate goodwill. Why? Because my consolidated retained earnings will be affected. Are we clear?
So this is mid-year, right?
This is not mid-year, my dear. 1st of July 2014, they are acquiring. Your year end is 31st October 2018. It's about 3.5-4 years. A mid-year acquisition occurs when the parent acquires a subsidiary during the current year. This is not my current year. You got it? Okay, I'm giving you 2 minutes. Calculate goodwill, calculate consolidated retained earnings, give me the figure. Let's see. Done, 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 done. Okay, fine. I've got one answer, so I'm going to start doing. So I need to calculate my consolidated retained earnings, but there is goodwill impairment. Okay, so first I'm going to go calculate my goodwill. So for my goodwill, what do I need? I need my investment cost of the parent. Investment cost of the parent. How much is the investment cost of the parent? Investment cost is 800,000. I require 800,000. I need 800,000. From this minus acquired net assets. What are the acquired net assets? I need share capital. How much is share capital? Share capital they say is, huh? What are you talking? A bought 90% of B bought 90% of A's $200,000 on ordinary shares. Come on, my dear. How much? 200,000 share capital. No share premium. Am I right? No share premium. However, they are given us retained earnings. Retained earnings. How much is retained earnings? Retained earnings at acquisition is 460,000. So directly given equals 460,000. Anything else? Any fair value adjustments? No. No revaluation, nothing. I don't see anything. So I take my total. There you go. So that's going to be 660. How many percent am I acquiring? 90% parents acquisition. There you go. Equals this into 90% gives me 594,000. 809,000 minus this gives me 206,000. 206,000 is going to be my goodwill. From this goodwill, what is happening? There is a 30% impairment. So impairment, how much will the impairment be? 30%. Correct? Correct? But they clearly say, if you look at the question, they clearly say that 30% of the goodwill on acquisition, no, we have only calculated parents goodwill, but we have not calculated NCI goodwill. So basically we have to go here, it's not proportionate net asset basis, correct? We have to go ahead, calculate NCI goodwill also. NCI investments, they have directly given me how much? 60,000. So equals 60,000. But how many percent here? 10%. Students, common mistakes, what they do, they take 594 into 10%. No, it has to be 660 into 10%. Therefore, NCI goodwill is negative. NCI goodwill is negative. If parents goodwill is positive and NCI goodwill is negative, you can set it off with the parents goodwill. But in reality, IFRS 10 doesn't allow you. For the purpose of FR, you can do it. For the purpose of FR, what you are going to do? You are going to set it off like this. How much do you have? 200,000. And in this, what do they say? There is impairment. How much is your total impairment? Impairment is 30%. Impairment is 30%. Therefore, how much is your goodwill? Goodwill is 200,000. And now we are going to do our impairment calculation. Okay, let's do the impairment calculation. How much are you getting impairment? How is your impairment? How is your impairment? 200,000 into 30%. How much is your 200,000 into 30%? That's going to be 60,000. So equals 200,000 into 30%, 60,000. So that's my impairment. So I wanted my impairment Y to understand how much I should deduct here, correct? What is parent share of impairment? Parent share of impairment will be how much? How much? Everybody, I want everybody to answer. How much? Parent share of impairment is how much? Parent share of impairment will be 60,000. Parent has how many percent? 90%. Therefore, equal 60,000 into 90%. Okay. Now, that's my primary thing I wanted. No. Now that I have calculated that, I've got my impairment. Now what can I do? I can do my consolidated retained earnings. Now for my consolidated retained earnings, I need parents retained earnings. Parents retained earnings at when do I need it? Reporting date. How much is it? 1,072,000. So I'm going to take my 1,072,000. From here I have 54,000 to reduce. So minus 54,000. Don't forget. Subsidiary retained earnings today. Subsidiary retained earnings today is 900,000. When you acquired 460,000. So today 900,000. When you acquired 460,000. Therefore, this minus this 440,000 into how many percent? Into 90% will go to the parent. Correct. Therefore, my consolidated retained earnings will be 1414,000. 1414,000. Answer C. Answer C. Are we clear? Yes or no? Are we clear? Yes or no? Are we clear? Yes or no? Understood? Understood? Everybody, are we clear? Everybody, are we clear? Superb. Number 10. Which of the following will be the immediate effect of changing to the breakup basis? Breakup basis means now when you prepare financial statements, you prepare financial statements on a going concern basis. Going concern basis means you are going to continue the business even after 1 year. You are going to continue the business even after 1 year. But if the company is not sure of its survival, if there are problems with its cash flows, if there are problems within the management, meaning the company is not going to continue after 1 year. If a company is not going to continue after the 1 year after the reporting period, that means the company is not a going concern. It is going to be prepared, the financial statements are going to be prepared on a liquidated basis. Liquidated basis or breakup basis means you will not be operating the company after 1 year from the reporting period. You are going to shut down your company. If you are going to shut down the company, you can't have non-current assets, no my dear. You will reclassify them as current assets. You can't have non-current liabilities. You will reclassify them as current liabilities. And there will be a detailed disclosure as to why you can't continue. You are going to inform the shareholders. Which of the following will be the immediate effect of changing to the breakup basis? W is a retailer whose only non-current assets are fixtures and fittings. The company has been experiencing trading problems for some time. The directors have concluded that the company is no longer a going concern and have changed the basis of preparation to breakup basis. Now, if you move to breakup basis, what is going to happen? All fixtures and fittings are transferred from non-current assets to current assets. Correct or incorrect? Correct or incorrect? Correct. Fixtures and fittings are revalued to their replacement cost. Correct or not correct? Fixtures and fittings are revalued to their replacement cost. No, they are revalued to their sales price. They are revalued to their sales values. Are we clear? Fixtures and fittings are revalued to their value in use. No, that's out. Wrong. No impact on fixtures and fittings. That's out. Answer A. Are we clear? Are we clear? Superb. Let's take. Okay. Until then, we are done. Until then, we are done. Okay. Shall we get back? Shall we get back? Negative goodwill covered by IFRS 10. IFRS 10 consolidated, separate financial statements, revise, covers goodwill. So let's go back, do a quick revision on IFRS 10. Okay, the concept of group accounts. Okay, consolidation will be tested in every exam session, will be tested for minimum 15 marks. You can get it in section A, section B, section C, anywhere from the syllabus. Okay, so basically what will happen, if it's a group, you have a parent acquiring a subsidiary. It can be one subsidiary or two subsidiaries. We have looked at two subsidiary scenarios also in the past. We follow the concept called substance over legal form. In substance, we prepare one set of consolidated financial statements. In legality, you can have more than one companies. Are we clear? Okay. Now, when you look at consolidation, applicable accounting standards would be obviously IFRS 3, business combinations, goodwill, business combining together, consolidated financial statements, investment in associate. Subsidiary. We know subsidiary is an entity that is controlled by the parent. So for the purpose of FR, if the control is more than 50%, voting shares, ordinary shares only, we will consolidate. The investor has control over an investee when they have power. Power means you have control. You have exposure or rights to variable returns from the involvement with the investee. Your returns, you have exposure to the returns. Number 3, ability to use this power over the investee to affect the amount of investors' return. 30%, 40%, 50%, whatever the return that you want, you have the ability to work around it. Exemptions from preparing group financial statements. Some companies you don't have to prepare group financial statements. For some companies, although you can have more than 50%, you don't have to prepare group financial statements. Why you don't have to prepare group financial statements? Because your parent is a wholly owned subsidiary or partially owned subsidiary. Because your parent as a subsidiary, the parent is owned by another parent. Then you don't have to prepare. Number 2, parents' debt or equity instruments are not traded in the public market. It's not in the public market. Then you don't have to do it. Number 3, the parent did not file its financial statements in the Securities Commission. That is, there's a commission. In the commission, if you are going to file your financial statement, it is mandatory by the Securities Commission to consolidate. Now, because if you are not filing to Security Commissions, then you don't have to, or any other regulatory body. Or the ultimate parent company produces a consolidated financial statement that comply with IFRS. Meaning, we have a parent, the parent has a parent, the parent has a parent. And we have two subsidiaries. So, ultimate parent is going to consolidate. So, we don't have to consolidate. So, in these cases, it is exempted. Guys, it is tested. You can get 1 or 2 MCQs here. You have to be prepared with the theory as well. I got a question, Zian, right now, can I go back? Can I go back and study Kaplan? Can I go back to study hub and will I be able to get through the exams? Now it's a bit too much dear, too late dear. Now right now if you want to get theory properly covered, you have to go to my chart notes. In my notes, everything that is relevant for you to pass the exams, it is there. See how I'm connecting. I'm going to a question, the question I'm trying to connect it here. Correct? No. I'm not struggling with connection. No. It is generally, okay, excluded subsidiaries. There are certain times you can exclude a subsidiary. Generally, you don't do that. Generally, you don't exclude a subsidiary from consolidated financial statements. But sometimes you can. When on the basis of materiality, subsidiary is not material at all. A small volume of transactions. Number 2, you have a subsidiary but you're having it for sale. Only in these two scenarios, you can decide not to include your subsidiary. So consolidated financial statements, basic, your workings. I've taken you through the workings, and primarily, in terms of consolidation, you have intergroup transactions. Loans between the parent and subsidiary has to be eliminated. If there's current accounts, URP has to be eliminated. Any transactions between the parent and subsidiary like dividends, loans, interest has to be eliminated, removed. URP, you have to look into the seller, who is the seller, and based on that you have to eliminate. Superb. Finally, coming back to goodwill. Goodwill, positive and negative. If it is positive goodwill, you capitalize, you take it to the financial position, you do an annual impairment test. Every year you do an impairment test. Number 2, if it is negative goodwill, we call it a bargain purchase. A bargain purchase means the value of the net assets that is there at the value, let's say it's 1 million, below the value you make a payment, meaning the company's reputation is spoiled, the company has no proper market in the value in the market, people are looking at the brand very negatively. So let's say okay, today right now we know PPIM has about 1490 active students right now studying with us, 1490 active ACCA students. And April, May, June, 3 months, June, July, 4 months, you would have seen 4 months we had a record 500 students. You would have seen our Instagram. 500 students in a record 4 months period. I have to tell you, 2023-24 put together, 2 years put together, we had only 260 students. Here within 4 months we had 500 students. That is the growth, meaning students are happy about our progress. Students are coming here, correct? Now let's say no, August, September, October, November, we don't have any enrollments, meaning negative goodwill, people are not trusting the brand, there is a problem, a big mess up happens. You understand my point? So in that case, okay, we don't have anything to do, we have to sell the brand. We are selling at a lower value, a bargain purchase. The seller has an advantage. So the moment it is a negative goodwill, we call it negative goodwill. We call it a bargain purchase, or we can call it bad will. All three are same meaning. Generally it won't happen. If it is happening, if it happens in the exam, it could be a calculation mistake. Or in reality, there could be a calculation mistake. So the standard says, if it is a negative goodwill, go and check the calculations. Go check the calculations. Never capitalize. You can't have a negative figure at the end of the day. Never capitalize. But you are having a gain, right? You make a gain, right? Credit the gain to the P&L. You take the difference, the gain to the P&L. Are we clear? Are we clear? Okay, super. Now coming back. Negative goodwill, in other words, gain on bargain purchase, arises when the acquirer's interest in the fair value of the acquirer's identified net assets exceeds the cost of the business combination. Which of the following does IFRS 3 business combination state must be carried out when this arises? Answer. Everybody. Answer. C. A. Zara. Answer. Negative goodwill arises when the acquirer's interest in the fair value of acquirer's identified net assets exceeds the cost of the business combination. Which of the following does IFRS 3 business combination state must be carried out when this arises? Reassess the amount at which consideration has been measured. My dear, I just asked you to check the calculation. Check the calculation means reassess the value. Reassess the value of your consideration. Come on. Number 1, yes, correct. Reassess the amount at which acquirer's identifiable net assets have been measured. Once again, check the calculation. Check the calculation of your consideration, your investment. Check the calculation of the net assets. That's exactly what we just saw. Take any excess immediately to the statement of P&L. Yes or no? Yes. Recognize the excess in the statement of P&L over the life of the non-monetary asset. Did we ever talk about any non-monetary asset? No. Out. 1, 2, 3. Answer C. Superb, guys. Online. Guys online, some of you are doing an amazing job. Okay. Guys online, you have to push. You have to push yourself even further. Guys offline, I need more support. Okay. You can see I'm going back to the theory. After showing you the theory also, you are struggling. I need more support. I need more focus. Guys online, to a major extent, you all are fine. But not enough. If you have to go to that 90-95, you have to work even further. We aim for 90-95, only then we'll land in 60. I'll tell you that. If you aim for 50, you'll only land in 40. Are we clear? Okay. What figure should be shown for the purchase of plant and machinery in sales statement of cash flows for the year ended 31st March 2015? What figure should be shown for the purchase of plant and machinery? The moment I know purchase of plant and machinery and cash flows, I have told you working for cash flows. Yes or no? What is the working? Very simple. We know if it's the moment we see property, plant and equipment for cash flows, we have a formula. What is the formula? Opening net book value will go up by with any additions, will go up or down by revaluation gain or loss, correct, will go up or come down by any transfers from investment property or transfers to investment property, will come down due to depreciation, will come down due to disposal, will come down due to impairment. Gives you my closing net book value. Okay, that's it. I've got my answer. During the year to 31st March 2015, the depreciation charge for plant and machinery was 52,000. Depreciation 52,000 minus 52,000. And machinery with a carrying amount of 45,000 was sold at a profit of 4,000. Carrying amount was 45,000. So I have a disposal minus 45,000. There you go. At 31st March 2015, a 20,000 payable existed in relation to the purchase of plant and machinery. Okay, so my opening carrying amount was 425,000. My closing carrying amount, they say carrying amount was 425,000 at 31st March 2015. Comparative figure on 31st March 2014 was 350. So my opening was 350. My closing was 425. My closing was 425. Are we clear? Yes or no? Therefore, they need to know what figure should be shown for the purchase of plant and machinery, meaning additions. They say there is a 20,000 payable. I have to make a payment of 20,000. Correct. That payable is still there. So I have to make a payment of 20,000. Okay. Now, I don't have any figures for impairment. Transfers, nothing. Revaluation gain or loss, nothing. Correct. Therefore, basically if you take my total, it has to be 425 equals sum 425, but how much is it? 253. Because it is 253, I have made purchases of 172, but out of this 172, 20,000 I have to still pay. So 20,000 I have to pay means, correct, my actual cash purchases would have been 152,000. Are we clear? So basically this will become how much? 172,000, meaning I make this 0. You understand my point? So from 172 I have to make a 20,000 means how much have I actually paid? 152,000 cash paid. Answer 152. Answer B. Are we clear? Are we clear, everyone? Are we clear? Are we clear? Are we clear? Guys, simple. Past papers, revision kit, platform, mocks, all those only. Now that is where we are going to pass the exams. Past papers. Okay? Superb. Let's get going. 13. Cash generated from operations in the statement of cash flows is considerably lower than the profit from operations recorded in the statement of profit or loss. Cash generated from statement of cash flows. Cash generated from operations in statement of cash flows. Operations in statement of cash flows is lower than the profit from operations recorded in the statement of profit or loss. Meaning, I have my statement of profit or loss. Now, it is not statement of profit or loss. Now, it is known as statement of performance. IFRS 18. I will be doing a session with you. Okay, most likely tomorrow I should be covering IFRS 18 also with you. Okay, it is known as statement of performance. They say statement of profit or loss. You have your cash generated from operations, you have your statement of cash flows also, no my dear. Okay, now when you take your statement of cash flows and statement of profit or loss, you have your operating profit and cash flows from operations, correct? They say cash generated from operations is a statement of cash flows. This value is very lower than this. If this is 100,000, this is maybe about 40,000. Are we clear? Oh no. Statement of cash flows is lower than statement of profit or loss. Maybe this is 100,000. It's the other way, right? This is 40,000. What they are trying to say is statement of cash flows value is lower than statement of profit or loss operations value. And they have given us some reasons. Now we are going to see what are the reasons this could have possibly happened. A, B, C, D. Answer. A, B, C, D. Answer. We did a question like this under ratios, statement of cash flows and ratios, and under that I spoke about operation cash flows and statement of profit or loss operating profits having a major component. We did a question. Which of the following could possibly be the reasons for this? A non-current asset has been sold during the year at a larger profit. Yes or no? Yes or no? Yes, if you had sold a non-current asset during the year at a larger profit, this could be a bit overstated. However, on the statement of cash flows, we don't consider it. A large payable was paid off just before the year end. A large payable was paid off just before the year end. A large payable paid off will result, a payable paid off will result in decrease in payables, correct? A decrease in payables, when it comes to statement of cash flows, a decrease in payable is good for my cash or bad for my cash? My cash balance is going to come down or go up? Come down. If my cash balance comes down, this is going to significantly come down. Correct? A large sale was made just before the year end, resulting in many lines being out of stock. So basically many lines are being out of stock means cash coming in. So good for my cash flows or bad for my cash flows? Good, so that will not have an impact. So basically all of them can't be the answer in the exam. Correct? So apart from that I have to give only two answers. So technically what could be the answer? Answer will be, then why did he say C? Answer is D. Now see, you know the answer sometimes, but you select the wrong answer. That is, you won't actually go and say, no, examiner, I want to fail this paper. Don't try to pass me. That's the indication you give to the examiner. Are we clear? Purchase of new premises during the year has led to an increase in depreciation charge. Increase in depreciation charge is added back to the profit. So an increase charge will increase the amount added, correct? So that is also out basically. Number 14. Which one of the following would not normally explain an increase in receivable days? Which one of the following would not normally explain an increase in receivable days? So, increase in receivable days. Your receivable days have gone up. Meaning, is it a problem for you or not a problem for you? It's a problem for you. So, which one of the following would not normally explain? Okay. negotiating a contract extension with a major customer making up 75% of company's revenue and who had threatened to go elsewhere. You have negotiated the extension with a major customer. Does that explain an increase in receivable days? Yes or no? Does that yes, exactly. High staff turnover in the credit control department. New people are coming into the credit control department. Therefore, will that increase my receivable days? Yes or no?
Because
Poor credit control. Poor credit control, so probably it will increase my receivable days because there is a high staff turnover. Entity enters into an overseas market for the first time. We did a question exactly. You're going into a new market. When you go into a new market, you will try to attract customers by giving more credit period. Starting up a new website, meaning products are now sold directly to the public, so it's like an e-commerce website. You are going to pay immediately, therefore that will not increase our receivable days, meaning it's cash sales. Are we clear? Yes or no? Which one of the following would not usually explain a fall in ROCE? ROCE is going down. ROCE, operating profits over capital employed. A dividend has been paid to the shareholders would not usually explain a fall in the return on capital employed. Profit has fallen in the year. Properties have been revalued upwards during the year. Assets have been acquired under a lease during the year. Answer? Why?
because the other three options will result in a fall, so I do the elimination.
The other three options will result in a fall. A dividend has been paid to the shareholders, meaning your capital employed is coming down. If your capital employed, your denominator is coming down, your ROCE is going to go up. So A, that's right. Naresh, properties have been revalued upwards during the year.
So they can increase.
Here, Naresh, your capital employed is going to come down. If your capital employed comes down, your ROCE is going to go up. So it would not usually explain a fall in the ROCE, meaning there's a growth in your ROCE. Answer A. Understood, Naresh? You have to be very, very careful, my dear. Okay? Now you see where you're going wrong. You see where you're going wrong. And when it comes to ratios, I sat and I gave you for each and every ratios, I told you an increase, a decrease, how it's affecting. What will affect. So you need to know all those and you need to know how to apply it. Paper is technical. It will get difficult. You need to start working on it. Put your heart and soul into it. 7-8 hours of minimum studying has to happen per day. Next 20 days, that's it. Next 20 days, you have to give about 8 hours of minimum 8 hours of study time. That's how you'll be able to improve it. Because there's a lot more that I want you to start doing. I feel you're not still enough. Everybody, but are we clear with whatever we have done? We can. It's not that we can't. It's just that you need to push yourself even further. We can. We are all passing. We are all giving our 100%. Okay? Super. I'm going to give you a quick few minutes to quickly go through whatever we've covered, and then we're going to go to section B. Okay? I'm going to give you maximum about 5 minutes for you to quickly go through, and then we're going to go to section B.
Sir, I'm bad in theory questions. How can I find your chart notes? My chart notes is there on the platform. On the app itself, it's there. Yes, please go to my chart notes. These chart notes, I have summarized and kept everything that is relevant for you. So please make sure you go back to this. This will help you a lot. Right now, it's about this only. If you take the ratios, I've given you how the ratios are, what needs to be done, how to sound professional, how to analyze financial statements. Please make sure whatever I've given you, you go check. Question approach, what to do. So please make sure you go through this, my dear. It's not in the group, it's in the app, it's in my recordings. It's a part of my recordings, my PPIM LMS. You'll have it in PPIM LMS. So if you go to that, you'll be able to get it. Okay, for that you have to be PPIM student. If you're not PPIM student, then you won't be able to get it. Okay. Are you PPIM student? Okay, if any of you are not PPIM student, also there is a offer going on for FR. All my recordings, marathon, chart notes, notebooks, everything, it's going at 6,900. Normally it's 34 or 35,000, it's going at 6,900. Valid for about 2 or 3 weeks if I'm not wrong. That is also there if you want. You have to immediately contact the management, ask from the management. Okay, last 5 questions, quickly. Done? 2 more minutes, 2 more minutes. Is that all okay? Understood? Have you started studying? How's it going? Okay. You understand the session that we are doing now? Everyone, guys online? Can we start? Everybody, can I get a yes? Can we start? Okay, this is section B. Section B can look like this. Okay, in section B, your examiner can give you a scenario. Your examiner can give you a scenario like this, a question, and test you with multiple accounting standards. So here, 16, part 16, which if any of the following statements regarding agency sale is or are correct. The moment your examiner gives something like this, it is usually connected to one particular note. Okay, you can connect it to a particular note. Okay, take few minutes, read the question on your own, familiarize yourself with the question, and then we will do it together. Familiarize with the question, take 1 or 2 minutes, that's enough. Done? You have to be quick. You have to be quick in the exam. Okay. Let's go to the question. The following is an extract from Miller's trial balance at 30th September 2014. What do you have? Freehold property carrying amount. Carrying amount 38,000, investment property 32, convertible loan note, revenue, cost of sales, taxation, deferred tax. Following information is relevant. Revenue includes 10 million of goods sold by M acting as an agent for Thomas. M earned a commission of 15%. 10,000 into 15% is 1,500 on these sales and remitted the difference of 8.5 million, which is included in the cost of sales to Thomas. Revenue includes 10 million and it is included in cost of sales. Okay, point. Which if any of the following statements regarding the agency sale is or are correct? Statement 1. Revenue should be reduced by 10 million, correct or incorrect? Ashwa, correct or incorrect? So how much? That's what I'm asking. Incorrect. It's correct. Revenue should be reduced by 10 million. Correct or incorrect? Why? Superb. It should be reduced only by 8.5 million. I told you today we started off with that only. Because 10 million is not yours. 1.5 million is yours. That is your income. It has to be reduced by how much? 8.5 million. So statement revenue should be reduced by 10 million, correct or incorrect? It's incorrect. Statement number 2, cost of sales should be reduced by 8.5 million. Correct or incorrect? Correct. So statement 2 is only correct. Statement 1 is wrong. Guys, you have to be confident with your answers. Are we clear? We covered it today, correct? Okay. Number 2, what should be recorded in other comprehensive income in relation to property revaluation? Okay, probably I think it's the second note. At 30th September 2014, freehold property has a fair value of 41 million from 38 million to 41 million. An investment property is considered to have a fair value of 31.5 million. Okay, so from 32.5 it's 31.5. M uses fair values to value properties wherever permitted. They are asking you what amount should be recorded in other comprehensive income in relation to the property revaluation. How much? How much should you include? $2 million gain. Why? My dear, investment property gain, we don't take it to other comprehensive income. We take it to property P&L. Any fair value increase or decrease in investment property is realized, likely to be realized. Therefore, we take it to P&L. The difference between proper IAS 16 and IAS 40 is under IAS 40 you take it to P&L, under IAS 16 you take it to other comprehensive income. Therefore, here they are asking you, in relation to other comprehensive income, it has to be only IAS 16, which is freehold property, which is 38,000, is now 41,000, meaning 3 million. My dear, you can't be making mistakes there. This is just 5 seconds, 10 seconds, you can give the answer. We have covered word to word, point to point, I have covered all this. You have to think through, don't make silly mistakes, my dear. Be careful. Look at the question. In other comprehensive income, no. Are we clear? Yes or no? Because investment property valuation gain or loss goes to P&L. We know that, correct? Yes or no? Yes. Guys, we did questions like this under investment property. We did questions where there is a transfer between property, plant and equipment to investment property, 40%. Remember? What should be recorded as initial liability in relation to convertible loan note? Convertible loan note. Okay, let's go back. Convertible loan note. There you go. There is a convertible loan note. On 1st of October 2013, M issued a 10 million 4% convertible loan note, which is repayable on 30th September 2017. M chose to issue the convertible loan note as it meant that there would be a lower finance cost than the 8% interest rate charged on similar loan note, with no conversion option. The present value of $1 payable at the end of each year based on discount rates of 4% and 8% are given below. Even last week, we did a convertible loan note question as a part of income statement. Remember, I did Gold PLC. Convertible loan notes, how are you going to value them? You're going to value at present value of future cash flows, amortized cost. Okay, what is happening? Convertible loan note. Okay, let's start doing. How many years? Oh, where are you? Okay. Convertible loan notes. Okay, how long? How many years? 4 years. Year 1, 2, 3, 4. Cash flows. What are your cash flows? They say 10,000 at 4%. So therefore 10,000 into 4%. First year 400, second year 400, first year 400, second year 400, third year 400, last year 10,400. My discount factor. What are my discount factor? Discount factor at 8%. Have they given me? Yes, 0.93, 0.93, 0.86, 0.79, 0.735. Now I can calculate my present value. My present value equals 400 into 0.93, 372. Take the total, drag and drop. There you go. My loan recognition value is 8676. Loan recognition value, loan receipt value. How much am I getting? I'm getting 10,000. Therefore, 10,000 minus 8676 will go to equity, other components of equity. Are we clear? Therefore, what will be my recognition value? They want to know the recognition value, which is B. You have to be quick. You understand? How should the convertible loan note liability be accounted in subsequent period? In subsequent period, how are you going to account it? A, B, C, D. Answer quick, 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 quick. Quick. Quick, 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 quick. Well done, Rishma. Well done, Zameen. Answer C, amortized cost. We've studied this. Well done, Naresh. Super. Amortized cost. Subsequent period, you're going to recognize that, measure it at amortized cost. What tax expense should be recorded in the statement of profit or loss? What tax expense should be recorded in the statement of profit or loss? Meaning, I think that's going to be my next adjustment. What tax adjustment? My dear, tax adjustment is one of your favorite adjustments, okay? Easy. I'll give you about 2 minutes. Do it on your own. Tax, do it on your own. What tax adjustment will be recorded in the statement of profit or loss, okay? In the statement of profit or loss. Okay, go on, go on, go on. Give me the answer. Go on. We know the steps. Apply the steps and give me the answer. We know the steps. Apply the steps and give me the answer. Very simple. You know the steps. 3D accounts. How to do it from there. Where to take it. Quick, 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 quick. Quick, quick, quick. Who's going to give me the answer first? Answer. Okay, let's forget everything. Let's go back. What are we going to do? 3T accounts. Now see how simple I'm making my life easier. 3T accounts. Come down. Okay, I put my 3T accounts. I take my brought forward figures. What are my brought forward figures? My brought forward figures 125 credit, 10,500 credit, correct? So, brought forward 125 and then 10,500. 10,500. Keep it very simple, don't worry. After that, what is happening? The directors have estimated the provision required for income tax for the year to 30th September 2014 at 5.7 million. So your income tax, current year income tax is given at 5.7 million. Debit income tax, credit tax payable. I go here. TP, how much is that? 5,000? 5,700. I come here. IT, 5,700. And then the taxation benefit trial balance relates to over under provision. The required deferred tax is 7 million. They are directly given us the deferred tax that is required. So carried forward, deferred tax is how much? 7 million. Done and dusted. That's it. 10,500. 10,500. And then I have a difference of how much? 10,500 minus 7,000. 3,500. I take it to my income tax account. I debit this means I credit my income tax account equals 3,500. Therefore 5,700 minus 3,500 minus 125 2,075. I take it to the P&L. I have answer C. Are we clear? Well done, Zamin. Well done. Superb. I'm not deviating anywhere from my steps. I am with my steps. Are we clear? Are we clear? Now, sometimes your examiner can come and ask you that your examiner wants to know the cash paid. So if that's the case, your tax payable account comes into place. And how you work through your tax payable account is very important, because movement in deferred tax will not have an impact on my cash. It's just a provision. You need to keep that in mind. Okay, 20 done. Okay, there you go. We have another 10 questions to finish off section B entirely. I'll finish off section B entirely today, and then section C will start tomorrow. Okay, superb. The following scenario relates to question number 21 to 25. Extracts from the statement of financial position of SECO are given below. SECO is given below. Okay, current assets, inventory, receivables, cash at bank, deferred tax, trade payables, overdraft, taxation, statement of profit or loss for the year ended 31st March, profit from operations minus taxation. Additional information. An item of plant was sold for 915,000 during the year, resulting in a loss of 50,000. Depreciation for the year was 93,000. Are we clear? Yes or no? Okay. So, can we start answering? Okay. Let's go. Which of the following items should be added to profit from operations in order to calculate cash generated from operations? Number 1, movement in inventories, movement in receivables, movement in payables. What is good for cash should be added to cash. Superb. Answer, movement in payables is good for cash. Well done, Senuri. Good job. Answer C. Movement in payables should be added and it is very good for cash. The increase in inventories or receivables will mean that we have a negative impact to our cash. Correct? Yes or no? Correct? Yes or no? Which if any of the following statements are correct? Which if any of the statement of the following is correct? So, but don't we have to see that in statement of finance? No, it's a direct question, my dear. You don't even have to go. It's a theory question. Just because they've given you a cash flow here, that does not mean always you have to go up. No. It's a direct theoretical question. Okay, but anyway, we take movements. What is happening? Well, movement. Okay, fine. Take your, okay, fine. He's saying, okay, he has a point. He's saying, okay, shouldn't we go and check with the balance sheet? A theory question, there are theory questions, you don't have to. But he's saying, so, well, it's better to go and check the balance sheet. Okay, super. What is happening to inventory? Okay, we'll go with what he says. It's correct. To a point, yes. What he says also makes sense. Okay, let's go and see what is happening. Movement can be an increase or decrease. Okay, your inventory movement is increasing. Your receivable movement is increasing. Your payable movement is increasing. So basically, these two have a negative impact. This has a positive impact. Now also, it justifies. Naresh accepted, agreed Naresh. Not going against it. Now is it fine? Can we go with that answer? Are you happy? If you're happy, I'm happy. Superb. I like when students come up and say, hey, Zian, let's do this. It's a different way of looking at it. It's nice. Which if any of the statements below are correct? Depreciation should be added back to profit from operations in calculating cash generated from operations. Yes or no? Yes. Loss on disposal should be added back to the profit from operations in calculating cash generated from operations. Yes. D. Both statements are correct. Superb. 22 done. Next 23. What amount should be recorded in the statement of cash flows in relation to tax paid? We just spoke about tax paid. What amount should be recorded in the statement of cash flows in relation to tax paid? Okay, your time. Taxes, your favorite area. Answer. They want in relation to tax paid, money paid. Okay, so you're going to give me that. $622. I've already got an answer. $622. Anybody else? You can put my T accounts, you can get the answer. But here you'll have to work it backwards. Answer C. 622. Anybody? Anybody? A. Answers. Naresh, answer. Asma, Hazik, Chamudi, Janadya, Shan, Rishma. I want answers, I want answers. Asna, Zara. C. Any other answers? Asna, what's the answer? C. Okay. Rishma, answer Rishma. Rishma, answer. Rishma, answer C. Okay. Keep your pens down. Look here. Look here. I want more focus here. I want more focus, okay? Answer. You got C? Okay. Let's see. Okay. Let's see if it is C, okay? You have taxation and you have deferred tax, correct? So obviously we are going to take our brought forward and carried forward, no? Okay, brought forward deferred tax is how much, my dear? Brought forward deferred tax is 108, correct? Carried forward, 234, okay. Income tax brought forward and carried forward. Income tax brought forward is 250. Brought forward brought forward 250. Carried forward how much? 300. Are we clear, everybody? Are we clear, everybody? Yes or no? Okay. Now, if you go to the question, they say they want to know what amount should be recorded in the statement of cash flows in relation to tax paid. That is actual cash paid. Correct. During the year, how much are you charging? You are charging 672. Correct. You are charging 672. So you have, technically you will debit taxes 672, credit tax payable 672, correct? So you will come here, you would have said 672. Are we clear? That's how, oh, I'm sorry. My income tax is my tax payable, right? My taxation is this, right? My brought forward should be, my brought forward should be 250 here, right? Correct? There is a problem with this screen for some odd reasons. It should be this, right? Brought forward 250, right? Tax payable, right? I'm taking from my balance sheet, right? You understood? And carried forward should be 300. It has to be like this, right? You understood? This is directly from the balance sheet. These are from the balance sheet, right? So it's payable and deferred tax. It can't come to income tax, correct? You understood? That you understood, right? No problem. During the year, you are charging 672, correct? So basically, I am going to debit my income tax account, correct? I am going to take a part to TP, tax payable, and I am going to debit this. How much? 672. Meaning equals 672 to to my P&L equals 672. But now I have a problem here. This 672 here, does it include my movement in deferred tax, yes or no? Yes or no? Does it include my movement in deferred tax, yes or no? Let me come to the top. Previous question. You see, I'm taking my P&L. When I'm coming to my P&L, my deferred tax 3,500 is taken, yes or no? After that only I'm getting the net figure, no? So basically when I'm taking my P&L, my movement in deferred tax is captured. What is my movement in deferred tax? My movement in deferred tax will be equals to 34 minus 108, which is 126, correct? I'm saying this 672 has this 126, correct? So basically this 126 will come here. So technically my income tax for this year should be 672 minus 126, correct? Yes or no? So equals, I have a very bad keyboard. Correct. Is it 546? It has to be 546, yes or no? That value and this DT put together basically will give me my total 672, and to my P&L I would take my 672, correct? That's how we do know. So basically what I take to my trade payables should be 546 and not 672. Because the 672 includes my deferred tax movement, which does not capture for cash, correct? So I will debit my income tax, I'll credit my tax payable, saying what? IT. How much is that? 546. Therefore, if you take the total, what will happen? You will take this total 796. 796 minus 300 will be the cash paid, which is equals 796 minus 300, 496. Because this includes movement in deferred tax. Now I told you have to rework the question backwards. You have to think through. It's not okay, Zian gave me the steps, I will do according to Zian's steps. No. Yes, steps are your guidance. With the steps, you need to have your common sense. Therefore, 496 means your answer will be A. What amount should be recorded in statement of cash flows in relation to cash paid? Answer A. Are we all clear, everybody? Are we all clear, everybody? Okay. I want to do tough questions with you. Okay. Now it's okay to do tough questions here. It's okay to make mistakes here. It's okay to fail here. We fail together, you and I. When we pass, we are passing together. Are we clear? Okay. That's okay. It's a learning point. It's a learning point. I mean, I understand. Okay. Not many students have been able to give me that answer in the past also. So it's okay. But now you understand where you're going wrong. No? We are not going to make these mistakes ever again. If it's cash paid, deferred tax movement, we have to separately take it, identify it, put it to our income tax separately. And only we are going to look at the movements. Are we clear? Super. What should be shown in the statement of cash flows as the net increase or decrease in cash and cash equivalents for the year? As the net increase or decrease in cash equivalents, in cash and cash equivalents for the year. Okay. Before you jump into writing, okay. Let's try to work around. Okay. Net increase or decrease in cash equivalents, meaning we are coming right to the bottom or right to the top. Bottom. Now, if you take your right to the bottom, if you go right to the bottom, what happens?
You take your net increase in cash, increase or decrease in cash. You have a figure. To that, what will happen? You will take your opening cash and cash equivalents, and then you will get your closing cash and cash equivalents. Correct? They want to know the net increase or decrease in cash. Okay. On to you. Naresh has given me answer C. 7983 decrease. 7983 decrease, everybody. Chamudi has given me 7983. Okay. My opening cash is 7518, correct? So fill in the blanks. Opening cash 7518 positive. I'm happy. Correct? My closing cash is 1658 minus there is an overdraft of 2123. Correct? So equals 1658 minus how much is the overdraft? 2123 minus 465. So if I am getting a minus figure here, basically I would have had a decrease or an increase on top. Decrease equals this minus this 7983 minus 7983 minus 7518 would give me minus 465. Correct? So therefore my answer would be answer C. Superb. Good job. 7983. Where should the proceeds from the sale of plant be shown? Where should the proceeds from the sale of plant be shown? Answer? Investing activity. Answer C. Done. Are we clear? How are the questions? Good or not good? Don't be worried. Are we good? Okay. We are moving on to the last part of our section B. Having said that, tomorrow we are starting at 11 a.m. and we are going on till 4 p.m. and we are looking at marathon session tomorrow once again. We are looking at a proper marathon session. Once again, past papers that I'll be doing with you. Very simple. The more past papers, the better for us. Which, if any of the following statements below regarding lease of plant is or are correct. So there are some leases happening. So they are asking which, if any of the statement below regarding the lease of plant is or are correct. Okay. You can take few minutes, read the scenario on your own. Read the scenario on your own. Take about few minutes, read the scenario on your own.
Okay. P leased an item of plant on 1st of April 2015 at a cost of 100,000 per annum with rentals payable in advance. The primary lease term is for 5 years and the machine is expected to have a useful life of 7 years with no residual value. The interest rate implicit within the lease agreement is 8% per annum and the present value of the total minimum lease payment is 431,200. Which, if any of the following statements regarding lease of plant is or are correct? Statement 1. If the plant was only to be leased for 2 years, there would be no need to capitalize the right of use. Correct or incorrect? Why? If ownership of the plant transfers to P at the end of the lease, the plant should be depreciated over 7 years. If the plant was only to be leased for 2 years, there would be no need to capitalize the right of the use asset. No need, no, you have to capitalize, unless otherwise you make an exemption call that the asset value is immaterial or if the lease is less than 1 year. So that statement is wrong. If ownership of the plant is transferred to P at the end of the lease, the plant should be depreciated over 7 years. Correct or incorrect? That is correct. If the ownership is transferred, then you can depreciate over 7 years. If not, you have to depreciate over 5 years. I have given you this point under my IFRS 16 note. It is given, clearly given. You can't be in two minds. So statement 2 is only correct. Answer B. What will be the non-current liability in relation to the leased plant at 31st March 2016? Okay, when I acquiring the plant 1st of April 2015, 31st March means 1 year. Correct. Very simple. I've asked you to put up a T account. T account, you will directly get the answer. T account will give you the answer. T account, and you're going to put up the lease liability. Very simple. So I'm going to put up a T account. Very simple. I call this a lease payable account. If you take my lease payable account, I'm going to take my brought forward figure. How much my brought forward? My brought forward figure is how much? For my lease, how much am I paying? Brought forward is how much? What is my present value of my minimum lease payment is 431,200. Guys, you have to go back to my videos. Please go back to my videos. Watch my videos. 431,200. Go back to my videos. Watch my videos. Brought forward is this, and then I make my annual cash payment installments, and then I'll have my finance cost. How much is my annual cash payment? 100,000 every month, and my finance cost rate is going to be 8%. Okay, advance or in arrears? In advance. Therefore, equals open brackets 431,200 minus 100,000 into 8%. Therefore, first year done. How many years should I do? How many years should I do? This is for how many years is this? 5 years. But how long? How long is over? My carried forward is 37357,696. Okay. When did you acquire the plant? 1st of April 2015. What's your year end? 31st March 2016. How long has it been? 1 year. So for how many years should you do? For 2 years. Then why did you say 6 years? There's no thinking there. Don't make assumptions, my dear. Go check the question. See how many mistakes you are making. Cost is 100,000. an item of plant, lease an item of plant on 1st of April 2015 at a cost of 100,000 per annum with rentals payable in advance. 100,000 per annum with rentals payable in advance is your present value. $100,000 per annum. So first year gone means you will go on till second year. First year gone means you will go on till second year. Understood? So if it is advance, you will deduct your cash payment and only calculate your finance cost. Yes or no? You will go on till second year means now first year is over. First year is over, right? Now first year is over. Now I'm moving on to my second year. I'm second year. In my second year, my brought forward will be how much? In my second year, my brought forward will be equals 356696. After that, if I put my formula correct, it's a matter of copy, paste. It's a matter of copy, paste. Are we clear? Yes or no? Done? Not done? Done. Yes? Until second year done. What do they want? They want what will be the non-current liability. Remember, in the exam, what will I have? I will have A, B, I will have A, B, C. Correct. If it is in advance, my answer would be B minus C. B equals 273,278,311. C equals 2615. Answer 257696. I gave you the steps. There you go, Zamin. I gave you the steps. I gave you the shortcut in the exam. How to get it? This is how you have to get it. Correct? I gave you, right? If it is in arrears, it is the other way. 257696. 257696. Answer A. Are we clear, everyone? Yes or no? Super. What is the value of the right of use asset to be recognized by PICO immediately following the sale and leaseback agreement? Okay, do they have any sale and leaseback agreement? I think that's going to be the next note. PICO also entered into a sale and leaseback transaction for a machine at the beginning of the year. At the rate of transaction, the machine had a carrying amount of 2.4 million and was sold for its fair value of 6.0 million. The sale represents the satisfaction of a performance obligation. It is a sale. If it is a sale, the standard requires you to calculate what? Rights of use asset. The rights of use asset in line with IFRS 16. Rights of use equals what? Book value over fair value into minimum lease payment. My dear, we have covered this under sale and leaseback. I covered it, yes or no? Formula given, but you look very blank. You look blank, as if you have no idea of what this is. Book value over fair value into MLP gives me my rights of use. So book value, how much is the book value? The machine had a carrying amount of 2.4 million and was sold for 6 million. The sale represents a satisfaction of performance obligation in accordance with IFRS 15. So there is a sale. So it meets the criteria of sale. So basically you have to recognize rights of use. The machine was leased back for 5 years. At the present value of annual lease payment amounted to 4 million. So they have given us the three figures that we want. It's a matter of copy and paste. So my carrying value, book value is given. My fair value is given. My MLP is given. My carrying value is given as 2400. My fair value is given at 6 million and then 4 million. Correct? Therefore, my rights of use would be equals carrying value 2400 over open brackets 6000 into 4000, which 2000 over 6000 into 4000. Okay, I think my brackets is wrong. Equals open brackets, my book value is 2400 over fair value is 6000, close brackets, to the power to the power 4000. 1600. See, just because I made an arithmetical error, my answer goes for a 6. So my division, multiplication has to be clear. We call it bottomless, is it? There you go. I failed in mathematics, so I'm not very sure. Are you clear? 1600, do we have the answer? Yes, answer number 28, 1600B. 29. What is the impact on the statement of profit or loss for the year ended 31st March 2016 of the lease of office furniture? Okay, I think that's going to be the next item. On 1st of October 2015, P entered into a 5-year lease for some items of office furniture with a 10-year life. Under the terms of the lease, P will pay 5,000 annually in arrears, and the present value of the lease payment with an implicit interest rate of 8% was 20,000. P has applied the exemption available under IFRS 16 leases. You can do it if the value is immaterial or if the lease period is less than 1 year. Here the lease period is less than 5 years, but if you look at the value, they say they have applied means obviously it has to be based on value, immaterial. So I can think of it is for it to be yes accepted, because this is 20,000, this is 5,000, but here you're talking about 4 million, 2.4 million. So the value has to be very, very, very immaterial. So in this case, the standard allows you to make an annual expense. So here their annual expense is 5,000, correct? So what would be the expense for the current year? How much? Obviously you are not going to capitalize, means are you going to depreciate? Answer B, no, out. Will your answer be D? No, it has to be A or C. What is the answer? C. A. See, once again, you are acquiring on, you're going for an agreement, lease agreement on 1st of October means 2015. Now you are in 2016 March. It's been 6 months for the current year. 5,000 into 6 over 12, 2,500. Answer A. You're cornered, man. Which, if any of the statement below regarding the lease of assets are correct? All leases will result in recognition of a rights of use. Yes or no? Okay, if there are exemptions, that means it's not going to have a rights of use. Not all leases will result in rights of use, so that is out. If a sale and leaseback arrangement does not meet the definition of a satisfaction of a performance obligation, the receipt of cash should be accounted for as the receipt of a loan. Correct or incorrect? If a sale and leaseback is not a sale, you have not sold, but you have taken money, means what is it? It's a loan. So that means statement 2 is correct. Answer B. Answer B. We have successfully completed the entire mock paper. Well, guys, a lot of practice, a lot of theory has to be covered. Go back, check my chart notes, start doing it. You have to cover these areas. There are primary areas which I feel you need more improvements. IFRS 16, you're horrible in it. Okay, just know that. I mean, let me be very upfront. IFRS 16, I'm not happy with you. You need to work around IFRS 16 really, really well. And certain transactions, you did not give me good answers. You got stuck. I saw you getting stuck with taxes, cash flows. Yeah, you have to go back, rework the entire paper, come back tomorrow. We are meeting sharp at 11 o'clock and we are meeting until 4 p.m. It's going to be our section B and section C, where where you did the mock. I'm going to do this with you and this with you tomorrow. That's the plan, plus more questions for you tomorrow. I'm targeting some questions and I'm doing, and I will be also doing the pre-mock that has come. The pre-mock is released. I'll be doing the questions from pre-mock as a recorded session and be releasing it for you. Okay, from this point onwards it is practice, 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 more questions, better performance in the exam. With that, let me wind up for the day. I'll see you tomorrow sharp at 11 a.m. Thanks guys, bye bye.
Good morning, everyone. And we were discussing the mock paper, right? So I'm sure from where we left, we are going to continue like I told you. So we have a ratio analysis question to complete. So we'll be completing the ratio analysis question as the first thing today. I know ratio analysis is a bit of challenging area for y'all. You've been finding it a bit tough, I know. So I thought, if possible, we will work on more ratio analysis questions today, right? And also we will keep going with more practice as we go on. Okay, the plan is very simple. We are meeting today. Hopefully we are meeting on Saturday and Sunday, but before that also I'm trying to see if I can meet you all. Okay, brilliant. There you go. We are here. We have entirely completed this section A. When we completed this section A, we went back to theory. We understood what the theory is. We did a quick recap on the theory, and then we entirely completed section A and section B. Okay, and that's where we are. And now we are moving on to section C. Section C is a ratio analysis plus a consolidation. I know to a certain extent you're fine with consolidation, but as much as possible, I'm trying to see if I can do consolidation and ratio analysis together, at least 2 ratio analysis questions today. Okay, brilliant. Let's get going. We've seen this before. This is not the first time we are looking at this scenario. We've seen this before, and here the requirement is, number 1, obviously, calculate the missing ratios in relation to H curve. You're gonna do the calculation of missing ratios. So you're gonna calculate the missing ratios. That is number 1. Write a report for the directors to assess the financial performance and position. Financial performance and position, the P&L and financial positions, financial position for the year ended 31st March 2015 compared to the previous year. Your answer should refer to the information above and the impact that Sparks has had during the year. Okay, as we know, Sparks is a consultancy firm. Consultancy firm has come in and has provided some information, has provided some guidance on certain issues that the company has been facing. So they also want to understand what is the impact of Sparks on the financial statements. So that's what it is about. Okay, you have gone through the scenario before. I'm going to quickly go through again with you so that we can see what really is happening. Okay, right, before that we have some ratios to calculate. The ratios are here, straightforward. The following ratios were provided by Sparks. Okay, in the exam we are gonna have a sheet like this, an Excel sheet like this, and okay, we will be having an Excel sheet like this, and we will be answering in this Excel sheet. Okay, are we clear? All right. Okay, superb. And kindly help us as to how to write interpretation. I've been helping you how to write interpretation. right? It's just that, you know, sometimes I don't see you in class. You have to be consistent so that you know what is happening exactly, because last class I entirely took you through how to write ratio analysis, but that's okay. We're going to do it again. Don't worry. We're going to do it again. But please make sure that you give me a lot of focus. Coming back, we have ROCE, return on capital employed, ROCE. Number 2, GP margin, gross profit margin. Number 3, net profit margin. Number 4, current ratio, quick ratio, inventory holding period, inventory holding period, receivable days, payable days, and gearing. Okay, this is going to be a mandatory requirement in the exam. Guys, you are going to get ratios. There's no two words about it in the exam. You are definitely getting it. So there we don't have any arguments. We are getting it. Okay, and we have to handle it rightly. That's the most important part. Okay, super. Now this is how my ratios are going to look like, and then I'll try to, what I will be doing is, okay, I will have my 2014 figure and 2015 figure, and then I will be giving my comments. Okay, superb. I'll be giving my comments. I have marked your scripts. I can share the scripts with you today. So during the class or right after I'm done with the class, I'll share the scripts with you. So you can also have a look at how you have performed. Okay, super. Now guys, you need to understand here this requirement says write a report to the directors. Write a report. You are a financial analyst. You are going to write a report. So what is this report about? This report is about financial performance and position. So obviously, to whom are you going to write the report? You are going to write the report to the directors of Huston, correct? So, to directors of Huston, H. Subject, but before subject, let's have from financial analyst. Subject, they want an assessment of the financial performance and position. Assessment of financial performance and position. Date 17th of August 2025. There you go. Dear sirs, it's a report, right? So we have to sound like a report. Please find below an assessment of the financial performance and position done by us. This report is solely for the use of the management of Huston of H, and we take no third party responsibility. Please do let us know if you have any concerns, or not conference, it's concerns or queries. And then, kind regards, financial analyst. Guys, in the exam, it's about planning your answers. In the exam, it's about planning your answers. Planning your answers means how to get your 20 marks in the exam. You need to find a way as to how you're going to achieve this 20 marks in the exam. That's the most important thing, correct? Okay, now here I know this gives me entirely 20 marks. My calculation gives me 7 marks and I have to make sure I know my ratios. Okay, I can't go to the exam without knowing the ratios. Now this 7 marks is an easy 7 marks. When you take this 20 marks, since you're writing a report, for the report writing, for the structure you get 1 mark, for a conclusion you get 1 mark. So 2 marks you got to make sure you don't forget. You have primarily put up a nice introduction, a report writing format, and then you're going to give a conclusion. So here you have already got your 2 marks. Correct. That's how you plan. That's how you plan. Planning is about how to get your 20 marks in the exam. So already you know how to get your 2 marks. Plus your ratios, if you calculate it properly, you get your 7 marks. So your 9 marks, you know you have got it. From here, you have to get your 11 marks to get your 20 marks successfully. 11 marks is about 11 points. 11 marks is about 11 points. A point, 1 point will give you 1 mark. 1 mark, to get your 1 mark, you have to write a sentence. A sentence can be 1 line or maximum 2 lines. Meaning you're going to write 11 sentences to get your 11 marks. Are we clear? That's how you have to plan your answer. You get my point? Super. Brilliant. Let's go back. Let's go back. During the year ended 31st March 2014, H had been subject to much press concerns, much press interest concerning its poor performance. H has been having a poor performance, and as a result, its share price had fallen considerably. Are we clear? As a result, its share price had fallen considerably, very, very, very low. Are we clear? Yes or no? Super. To remedy this situation and help improve share price and market confidence, H employed Sparks, a firm of strategic consultants to recommend the best course of action. Okay, superb. And then the board of H were quick to act on many of Sparks' recommendation and are pleased with the effect that it has had on performance during the year to 31st March 2015. The draft financial statements are shown below. Are we clear? Are we clear? Super. Now what do you have? You have your revenue. Your revenue has dropped. Your revenue has dropped from last year to this year. Your cost of sales have also dropped. Your GP margin has gone up. Your gross profit has gone up. Well, if your revenue is dropping and if your GP is increasing, the only reason why I could think this is happening is because of your cost control, direct cost control. Meaning your cost of sales have fallen significantly. Because your cost of sales have fallen significantly, your GP has gone up, because your only way your GP can go up is by an increase in revenue or decrease in cost of sales. So if your cost of sales have gone down, it explains an increase in GP margin. Are we clear? Are we clear? Meaning your direct cost has come down. If your direct cost is coming down, maybe your purchase cost is coming down, your manufacturing cost is coming down. You understand my point? Or under exam condition, your cost of sales means your depreciation could have had an impact. You understand my point? So you have to think through like that in those lines. Or probably you would have done an outsourcing. You could have outsourced something. You understand? So those could be some reasons that I can think of as to why your cost of sales can come down. Are we clear? Yes. Now your distribution cost is going up. Your distribution cost is going up. Your cost of distribution is going up. Okay? Your admin is also going up in a very big scale.
So the moment you see distribution cost, admin cost going up, probably I need more information on this cost. Why is there an increase in this cost? I want to understand why the costs have gone up. Profit from operations, profit on sale of plant. Okay, you have sold the plant, you have disposed the plant. You got to keep that in mind. Your finance costs have fallen down. Your profit before tax have slightly fallen down. Actually, it is fallen down. Your taxation has come down, and overall, your profit has increased, but your revenue has decreased. Your profit increasing, your revenue decreasing. Some of the reasons that I could see is there could have been better cost control. There could be any other items affecting our incomes, like this profit on sale of the plant, or some investment income, or something not connected to our operating income, primary operating income, primary business activity. That could be the reasons as to why this is going up. So these are all assumptions, because I do not know, I have not read the scenario properly. These are all my assumptions. Only when I read my notes, I will understand, okay, how and where to connect. But this is my analysis. I'm starting to analyze in the exam. These are things I have to think through. You okay? Non-current assets. When you take my non-current assets, my property, plant and equipment is coming down. It also explains that we have done a disposal. Connected. My goodwill is staying the same. My development cost that I had is not there anymore. So probably I've capitalized development cost and I don't see the development cost anymore. What I am assuming is a project has not been qualified. Because the project has not been qualified, it was capitalized, but now it's not there anymore. I'm assuming, I'm thinking. My inventory has come down significantly, meaning it has to improve my cash flows. That's where I think my nil has become a bank positive, meaning my working capital should have improved. Well, my trade receivables have come down, meaning obviously my cash inflows are becoming positive. So decrease in inventory, decrease in trade and other receivables will simply mean that my cash flow should become positive. Meaning I could have been in an overdraft position last year. There you go, from 1340, now I have a positive cash flows of 840, which mentions that my cash flows are becoming positive. I've not issued shares. My retained earnings have gone up. I've gone for a convertible loan note. A convertible loan note is a loan note which can be converted into equity shares in the future. We know how to account for it. We've done so many questions in terms of convertible loan notes. My 12% loan, which I had last year, probably I have settled. I've settled my loan and now I have a convertible loan note. So I don't have a loan anymore. Now I have a convertible loan. You understand? Provision for overall expenses, 1480. Provision for overall expenses. Overall expenses are any major inspection cost that we have in the future. We have covered during our theoretical sessions that overall cost cannot be included in line with IAS 37. But probably they have included this as a part of our financial statements. They would have debited P&L and credited our liability, meaning our expenses are a bit higher. Trade and other payables have come down, meaning we are paying our suppliers quicker. Taxation has slightly gone up and bank overdraft has become positive. I'm giving you another few minutes to go through the notes on your own. Go through the notes on your own and then I'm going to connect it to the scenario with you. Okay? I'm going to give you about 3 to 4 minutes to quickly go through the scenario on your own.
Okay, guys, these notes I've told you are the heart to our comments. Our comments should revolve around these notes. It can't be general answers in the exam. You need to think through, these are your points. Based on this soul, based on this skeleton is where you're going to build the flesh. So you have to think through. Your examiner would have given a lot of points in terms of indications as to how you can connect, like how I'm going to show you right now. During the year, the development expenditure was written off to administrative expenses in the statement of profit or loss, as the recognition criteria in IAS 38 intangible assets were no longer met. Now, when going through the question itself, we know there's a problem like this. See, if you think through while reading the question, you will be able to identify it. What is happening during the year? The development expenditure was written off to administrative expenses. So that means your administrative expense going up this year. The reason for this to go up is due to a development cost, release of development cost. So that is something I can definitely go and speak about. So that will affect my net profit margin, release of development cost. Correct? So it's going to be a one-off thing. It's not going to happen always. It's going to be a one-off thing. Correct? It's going to be a one-off thing. I'm not going to develop products every year and capitalize and keep it, right? So it's going to be a one-off thing. So yes, probably, okay, our expenses could have gone up. Our expenses could have gone up because of this, because the criteria was not met. Overall, our profitability is also affected because of this. Next year, we will not have it. Are we clear? Yes or no? Are we clear? Everyone, guys online? Now I'm building my points, okay? I'm building my points. It's very important that I build my points in the exam. And how I connect it. And what is this point about? The point of releasing of development cost is, I'm going to tell the examiner, it is affecting profit, but it is one-off. So I'm going to tell the examiner, hey, look, my profit is affected because of this, but this is one-off. You want to wash your face and come? Please. In addition, following on from one of the recommendations of Spark, that is our consultancy firm, H is outsourcing the manufacturing of one of its products. That explains your cost of sales going down. So outsourcing, because you are outsourcing reduces cost of sales. Now we know why our cost of sales is going down. Our cost of sales is going down because you have outsourced. Based on whose recommendation? Spark's recommendation. Because your answer should include what your consultancy firm is telling you. Because they say that Spark's recommendation has to be taken seriously. It has to be included as a part of our analysis. So outsourcing reduces cost of sales. Are we clear? Okay, let's go further. This has enabled the company to dispose of some surplus plant. You had some plant which you're using for your production, but you don't need it anymore because you're outsourcing it. Why do you have it? You don't need it. That's why you have a disposal gain. Correct. So basically, I have two things that I can talk about. Number one, I'm disposing the plant. Because I'm disposing the plant, what is the impact to my cost of sales? No more depreciation. Because I'm disposing, there's no more depreciation. Correct. So that could temporarily build up my GP, gross profits. So coming back,
here. Number one, outsourcing reduces cost of sales. And number two, my second point, disposal of plant. Disposal of plant. Reduce depreciation cost. Meaning increases what? Increases my GP, gross profits. And next point, my net profit is not just affected by release of development cost, also disposal of plant. Once again, disposal of plant, one-off gain. Are we clear? 4 points. Correct. Cash is also, I'll come to that. We will nourish. What we will do is we'll finish this off. We'll take these points, and then what we are going to do is we are going to look at the overall picture, so we can connect it to our cash. Correct? Are we clear? Are we clear? They say this has enabled the company to dispose some of the surplus plant. The plant has been due for an overhaul in 2015. Overhaul cost. Number one, overall cost. Can you take it as a part of your cost? No, that is wrong. They say H had been accruing a provision for the overall cost over a 4-year period, but due to disposal, this was no longer required, and the provision was released to cost of sales. Meaning from cost of sales right now, you remove it. So that also explains we have a wrong accounting treatment. Correct? Last year, our accounting treatment was wrong. This year, our accounting treatment is correct, right? It's not correct because we thought about it and we corrected it. Because we disposed the plant, by default, it got corrected. You understand my point? But the problem here is your overall cost. Your overall cost is 1,480. Are we clear? Now this 1,480 basically is a wrong accounting treatment. It's not included here. But it is included here. Am I right? So technically in this, should you include or it shouldn't be there? It shouldn't be there. Technically the accounting treatment is wrong. No? So 7,200 minus 1,460 will give you a higher gross profit or a lower gross profit. Your gross profit will go up by 1,460, correct? So basically what I have to go and tell the examiner, hey, look, if the gross profit margin has gone up, it's okay. But last year's accounting treatment is wrong. Basically my gross profit has to go up by 1,460, gives me how much? 2,800 plus 1,460 gives me 4,260. So basically, if you ask me, my gross profit has not gone up, instead it has gone down. It has only gone up because we saw an incorrect accounting treatment. So next point, I'll tell the examiner, hey, look, GP margin in the current year is inflated due to incorrect treatment. How many points? I've got 3 points here. I've got 2 points here. I want 11 marks. I've got my 5. I want 11 marks. I've got my 5. Now, if I want to give 1, 2, 3, 4, 5, 6 and finish off 1 point, even then I'm done. I've got my 11 points. But let's make it 12 points. Let's make sure that we fill everything. But that's my planning in the exam. You understand? You can't write like Kaplan. I can't write like Kaplan. What we have to do is we have to get a rhythm where we find a balance. And this is the perfect way to get our balance for the exam. We want 11 marks. We have given 5 good points, 5 solid points. I get my 5 points. And now I have another 6 points to talk about.
So why do we do that from cost of sales?
Because it cannot be a part of a cost of sales. It's wrong. Overall cost cannot be charged to cost of sales. Overall cost cannot be provided in the first place. IAS 37 directly comes and says, yesterday that's what I told you, right?
IAS 37 directly comes and says overall cost, future cost. You cannot take it in the current year. You cannot provide a provision at all. So you have been doing the wrong accounting treatment all these years. All these years, for the last 4 years, your cost of sales is more high. But this year also you did not correct your treatment. It's just that you disposed the plant, so you thought you will release it. If you had the plant with you, you would have still shown the overall cost. You understand my point? Are we clear? So that's how I build my points in the exam. That's how I build my points in the exam. Okay. Since we are here, okay. Where are we? Okay. That's it. That's all your examiner has given. But also, since we are here, we are talking about net profit. I know distribution cost will also have an impact on my net profit. Correct? Why do you think the distribution costs have gone up? We are outsourcing. Because we are outsourcing, probably our distribution cost could go up. So next point could be big increase in distribution cost due to outsourcing. Are we clear? Are we clear? Understood? What is this 42.6%? What is this 42.6%? Last year's GP margin. Okay, last year's GP margin, I've got it as 42.6%. Okay, that is adjusted GP margin, is it? Is it adjusted GP margin? Asking, is it adjusted GP margin? Okay. So he says, okay, last year's GP margin, which is adjusted for your provisions, is 42.6%. Okay. Perfect. Cool for me. ROCE. My ROCE. Okay, now guys, I've not even calculated the ratios. I do not know what's happening. So only now, based on the scenarios, I've got the figures. We have to calculate the ratios. Okay. I know you have already calculated the ratios because I corrected your mocks. Okay, I know you have corrected it, done it. Okay, so fine. Let's quickly do our ratio calculations. Okay, now starting off with the GP margin, right? Let's start off with the GP margin because ROCE was given 31 and 37%. So 37% and 31%. Okay. GP margin. Can you give me the 2014 figures one by one? 28%, 14%, 1.1 is to 1, 0.4 is to 1, 162 days, 160, 169 days, just 69. Oh, I'm not good with it. Go on. 138 days. Sorry, 42 days. 42%. Okay. Okay. GP margin. Did we calculate? Shall we calculate? Okay. My gross profit margin, my dear, will be 3,840 over 9,600. Correct? So equals 3,840 over 9,600. As a percentage, I have 40%. Are we clear? So I'm gonna have 40%. Net profit margin. However, they say for net profit before tax, Your examiner is clearly saying net profit before tax. You don't go and say no, net profit means after tax only we have to take. No, don't try to be the examiner here. You are testing the examiner is trying to test you. Some of you, what net profit after tax time? No, this is not how it is. It's wrong. Examiner is making a mistake. You go and try to correct the examiner. What nonsense are you trying to do? If your examiner says net profit is before, come on. Your examiner is directly monitored by the person, SBR examiner, chief examiner, who is a part of the standards board. Okay. Who are we? We just completed F3, FA, and we are coming to F7. That's it. So if your examiner says charge depreciation to cost of sales, go and charge it. No. In my school, they said distribution cost only you have to charge. Who's your teacher? And who's your examiner? You understand my point? Okay, net profit before tax means please take net profit before tax. That's what your examiner wants. Why do you have to confuse yourself? I see some of you have just taken net profit after tax. Wrong. What your examiner wants only you have to do. Correct. Super. So net profit before tax. Okay, let me go to net profit before tax. So my profit before tax is 1,280 over 9,600. Am I right? So I'm gonna say equals 1,280 over 9,600, which is 13.3%. Current ratio. My current ratio is going to be my current assets over my current liabilities. Okay. My current ratio is given. Okay. 1.1 and 1.3:1. It's given. My quick ratio is not given. Meaning I have to calculate my quick ratio. Are we clear? (0.4:1), correct? Last year. This year my quick ratio will be my current assets minus inventory over my current liabilities, correct? My current assets is 5,080 minus 3,200. No. I have to take it for 2015. No. 3,400 minus 1,800. So equals open brackets 3,400 minus 1,800 over current liabilities, which is 2,520. 2,520. 0.6:1. So 0.6:1. Meaning it has improved. My current ratio and my quick ratio has improved. My inventory holding period. My inventory holding period will be my closing stocks over cost of sales into 365 equals 1,800 over my cost of sales. 1,800 over my cost of sales is 5,760. Close brackets into 365 days. 114 days. Are we clear? My receivable days. My trade receivables over my revenue into 365. Meaning 760 equals open bracket 760 over 760 over 9,600 close brackets into 365. Trade payable days. My trade payables are running at 1,680. 1,680 equals open bracket 1,680 divided by my cost of sales, which is 5,760 into 365. And gearing, they say gearing is debt over debt as a percentage of debt plus equity. Now debt, my total debt is how much, my dear? My debt is 4,680. Am I going to take 2,040? Am I going to take 2,040?
when I do my debt calculation, I can't include my deferred tax, that is out. Only my loan note, 1600. My 1600 over 1600 plus 3440. Deferred tax is not a debt, no, technically. You understand? It's a provision. So equals 1600 over 1600 plus 3440. But this as a percentage, 31.7%. No, it is an non-current liability, but it doesn't. Are you going to pay anything? It's just an accounting treatment, right? Okay, what do you want me to show? Can you show the quick ratio cell? Quick ratio cell. Okay, this is what I calculated. Okay, this is what I didn't calculate. I directly took it. I took current assets minus inventory over current liabilities. Deferred tax cannot be included as a part of my debt over equity calculation because obviously it's just a provision, right? We are not what is the purpose of debt technically how much I'm going to pay as a part of my equity. So here I'm not going to pay anything, correct? It's just a movement that I capture. My provisions, my movements I capture. So there's nothing that I have to show. So inventory days also. Okay, whoever got your days wrong, please make sure you get it right now. Quickly take it if you want to. Rubini, you had sent me a question, right? You want me to do it or you want me to correct it? Rubini, are you fast asleep? Oh, here, wait, correct it. Okay, I'll correct it. By tomorrow? Superb. Now, in the exam, you're copying it. You're done or you're copying it still? In the exam, if I've got my ratios correctly, I get my 7 marks. Some of you honestly messed up with the ratios. Okay. And now I'm moving on to my comment section. Wherever I can provide a comment, I need to start giving my comment in the exam. Quickly, I have to give my comment so that you know. Basically, oh, I'm getting a lot of calls on WhatsApp from Indian students. I think they've not got the link. Everybody's in the group, right? Indian students, everybody's in the group, right? Okay, they're asking for the link. Give me a moment. I've sent it. Okay. Now, what is happening? I see my gross profit margin. By looking at the financial statements, I see my gross profit margin has gone up. But is it due to a genuine operational movement? No, it's not. So I can start on talking about this. Okay. Number one. During the year, GP margin has rose. Oh no, has increased by 12%, indicating a strong performance of H. All right. A closer analysis will reveal that the increase is due to
The increase is inflated. So I'm starting off very strongly. Hey, look, it looks like there is an increase, but technically there is no increase. It looks like it is inflated. It is actually inflated. So basically inflated through what? Number one, it is inflated through cost of sales, disposal of plant, reducing depreciation cost, and also incorrect accounting treatment. Number one. Number two, based on Spark's recommendation, Huston has outsourced. It's what has it outsourced? It has outsourced its manufacturing of one of the products. Based on Spark's recommendation, Huston has outsourced its outsourced one of the products. This has caused a decrease in cost of sales, leading to an increase in GP margin. Now see, I've taken a point, I'm talking about the point, but here I have a problem. Now when you take my cost of sales will have my, it will have my direct cost and my outsourcing cost, correct? Now I'm outsourcing, no, that will also be there, but do I have the breakdown of it here? No. So in other words, I need more information on breakdown of cost of sales and product lines and admin expenses, like we earlier discussed, correct? Now these are my value addition. As I read itself, I'm trying to build my answer. You understand my point? Are we clear? Okay. Second point, disposal has resulted in a reduction in cost, correct? So H has disposed some of its plant during the year. Therefore, depreciation is not charged, and this has further resulted in GP margin improving. That is enough. We don't have to write paragraphs. That's not the requirement. Let's keep it very simple. I'm telling the examiner, hey, look, I'm giving you 1 point, 1 mark, give me my 1 mark. I want my 1 mark. So examiner knows, okay, this guy has given the point that I want. I'm not messed up. I'm exactly showing what I need in the exam. Are we clear? Number 3, GP margin in the current year is inflated due to incorrect accounting treatment. IAS 37 prohibits the recognition for overall costs. Therefore, by charging this in the last year, the GP margin would have been low, correct? However, if this is removed from last year's cost of sales, GP margin will go up by, somebody gave me the figure, 40, go up to 42.6%. Asim told me it is 42.6%. Okay, how am I getting the 42.6%? I'm getting it like this. 4,260 over 10,000. Yes, 42.6%. So therefore, if you actually look at it, from last year to this year, last year is 42.6, this year it is 40. So therefore, GP margin has fallen down. So I'd say, therefore, in fact, if the wrong accounting treatment did not exist, overall GP margin has fallen compared to 2014. Now see, I've given a nice way. I've just connected everything. 4 points, my 4 marks in the exam, with a slight conclusion here, with a small conclusion here. Do you get my point, my dear? Do you get how we can improve our answers? This is how we have to start writing our answers. Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Are we clear? Everybody. Now, release of development cost, disposal of plant, and there is a big increase in distribution cost. If I want, I can connect it as 1 point and I can write, or I can overall write it as 3 points. If you connect it and write, provided you give proper information, you can get your 3 marks. But I'll show you how to get your 3 marks individually. Okay. So, release of development cost. Number 1. During the year, one of the development cost capitalized was released to admin expenses due to recognition criteria not being met. So therefore, the accounting treatment is correct or not correct? Accounting treatment is correct. As such, there is an increase in admin expenses in the current year, affecting profit margins, net profit margins. However, this is a one-off expense. Are we clear? Now, basically, your development cost was 1,920, which is also offset by profit on sale of plant. It's a gain. Further, number 2, further, plant was disposed during the year. This has resulted in a gain of 200. This has positively impacted the profits. However, this is also one-off. Are we clear? There's a big increase in distribution cost.
So I want to understand the reason why, because it is due to outsourcing. So distribution cost during the year significantly increased. I think almost doubled, right? Yeah, almost increased, almost doubled. Almost doubled. This could be due to primarily the outsourcing, the outsourcing of a product. Further details are required to understand if outsourcing is actually beneficial or not. Now, outsourcing, why do you outsource? You outsource to get a benefit out of it. But we do not have enough information to understand if outsourcing is beneficial or not. So, a cost or benefit analysis, cost or benefit analysis on outsourcing is required. Are we clear? Are we clear? How many points I have covered so far? I have covered my 7 points I have covered. Now, right now, what I can do is I can directly go and speak about my ROCE. ROCE overall, what is happening? ROCE is falling. ROCE is shareholders' primary ratio. Our return on capital employed is falling down. Now we are going to go and talk to the examiner. Hey, look, ROCE is falling down, and as to why it is falling down, we need to understand. Okay, take few minutes. Try to understand why ROCE is falling down. Try to understand why ROCE is falling down. Why ROCE is falling down? Why do you think ROCE is falling down? Why? Why is ROCE falling down? ROCE is made up of what? ROCE is made up of your profits and your capital employed. So if your ROCE is falling down, we need to understand why. What is happening to our operating profits? Obviously, our operating profit is falling down. So we can understand that. We know our operating profit is falling down. So basically, we understand our ROCE is falling down. Yes. But what is happening to our capital employed? If our capital employed is reducing, that means basically ROCE can come up, right? So tell me what is happening to capital employed. Okay, do the calculation and tell me what is happening to capital employed. Capital employed. Capital employed. What is happening to capital employed? Do the capital employed if you can give it to me. Do the capital employed if you can give it to me. Give me 2 minutes. I'll be back. Okay, so Akifa says operating profit is falling down, capital employed could be reducing due to the release of overhaul provision, settlement of loan, and significant decrease in deferred tax.
Income liability is going down because of that. Capital employed will go down.
If capital employed is going down, our ROCE should go up or come down? Go up. So here our ROCE is coming down. That's my question. Our ROCE is coming down. Operating profit is falling down and capital employed could be reducing. Okay. Akifa, you're saying could be reducing. Is it reducing? A capital employed, is it reducing or going up? Okay. How did you calculate your capital employed? Equity? How do you calculate your this thing? How do you calculate your not ROCE? How do you calculate your capital employed? Equity plus non-current liabilities. Yes. Everybody? Everybody with me? Equity plus non-current liability? Equity plus non-current liability. Okay. Superb. Okay, somebody has played with my ratio calculations. So, going back, where was I doing? Custom. Equity plus non-current liability. As a whole, what is happening to my equity plus non-current liability? My equity is 2,800 plus 4,680 the last year. Current year 3,440 plus 2,040. So if you take the total, how much is it? 2014, how much is it? 2015, how much is it? For 2015, 5,480, and over here 7,480. Okay, so basically my capital employed is falling. If my capital employed is falling, my ROCE technically should go up. Correct? But my ROCE is also falling. If my ROCE is falling and my capital employed is falling, that simply means the percentage of fall on my profit is higher than the percentage of fall on my capital employed. My profits are falling at a very higher rate than my capital employed. You understand my point? So it's not setting off. It's not equal. It is higher.
The previous year's capital like the ROCE was understated
Our previous year ROCE is understated.
due to overhaul.
Yes, our previous year ROCE has been affected by our overall cost. I'm with you. I'm not denying. All those have had an effect. So my ROCE has had an impact through multiple things. My ROCE is affected through multiple things, like Akifa said, including deferred tax. Because deferred tax have also fallen significantly, if I'm not wrong, because we have disposed assets. So ROCE has been affected by multiple things. It is got affected because it is a primary ratio. It has a lot of things that can be causing its decline. We can start off, we can think. I know you've given me the points. Okay. Primary ratio has declined. And the reason for this is reduced profits. Correct. And impact on our capital employed.
So let's start answering. Let's see how it's working. So ROCE is a shareholders primary ratio. Always go with that. Okay, primary ratio. Reduction in ROCE will be a bit worrying to the shareholders. A detailed analysis will reveal that ROCE has been affected by both profits and capital employed. That's my first point. Okay, let me wrap it. That's my first point. Okay. Number 2. The effect on ROCE, for your effect on ROCE, for your profits to go down, right? For your profits to go down, you have an impact. You have an impact on multiple areas in your P&L. You can slowly start to talk about the multiple areas that has affected a crash in your ROCE. So obviously what we can talk about is you have disposed your plant. You have written off your development cost. That could obviously have an impact in your capital employed. And your inventory levels, what is happening to your inventory levels? Your inventory levels are going down. Your inventory levels are going down and your receivables are also going down, creating an impact on your ROCE. The overall provision, like we spoke about, has been written off and there has been reduced level of payables. Your payables have also come down and provision for deferred tax has fallen significantly because of the reduction in non-current assets. So you can combine everything and have talk to the examiner about what has happened. So let's go further. Let's go and talk about it.
So is this shared?
Hmm?
Is this document shared?
Yeah. The document is shared, right? I'll share it to you once I'm done also. It's there on the disposal of plant. The disposal of plant and the development cost write-off. Cost write-off has contributed significantly to Gazanlan, can you hear me? Gazanlan, am I audible? Am I audible? Okay, someone has messaged me. Okay, audible, no problem. The disposal of plant and development cost write-off has contributed significantly to the fall in capital employed. Correct? Your development cost that you wrote off and the disposal of plant, you disposed the asset, will obviously have contributed to the fall in your capital employed. No? Your capital employed. Correct? Okay. That means your capital employed is coming down technically because of this. And therefore, there are multiple reasons like I told you. And therefore, an increased return. However, that is also being offset by other items. So it's multiple factors that is affecting. Further,
Further, there have been major decrease in inventory and receivables, further impacting capital employed. Now, there have been reduction in liabilities also, correct? There have been reduction in liabilities also. So that's not it. I have more points to talk about. In addition, liabilities have decreased significantly. Although your total of the assets was positive, there was affected, your decrease in liabilities have taken a bigger leap, making ROCE falling down. In addition, liabilities have decreased significantly, which have offset more than the asset reduction. Your reduction in liabilities is higher than your asset reduction, meaning your capital employed technically is being affected where your ROC is going up. The write-off of overall costs, the write-off of overall costs, the reduction in trade payables, and the provision reducing significantly have all contributed in the drop of ROC. So basically ROCE has been affected by multiple things, and all these things have had a significant impact, making it coming down. The write-off of overall cost, the reduction in trade payables, and the provisions, which is I'm talking about the deferred tax and deferred tax provisions reducing significantly, have all contributed to the drop of ROCE. Yes, your asset base has come down, but your liabilities base is further affected. I know it's a bit technical here. ROCE honestly was not very well explained by you in your answers. ROCE was not properly explained by you in your answers. Understood? So now you know ROCE, when I say it's a primary ratio from first, ROCE is affected by multiple factors, has been affected by multiple factors, and you got to make sure that in the exam you should be able to touch all the factors. Now what I'm giving you is a bit more than you can do in the exam, but try as much as possible to cover these areas. So here 1 2 3 4 5 6 7 8 9 10, I've got 10 points already. I have to give 1 point, but in the exam I will see in the exam the best way to do a question is, okay, well, I feel ROCE I've given 3 points is a bit too much. I'll try to make it 2. Here 2, 4. Here 2, 6. I need 11 now. 7, 8, 9, 10, 11. I'll try to give 1 point below and try to give an overall answer. Now, what I'm giving you right now, is a lot, so that I can cover the points with you. But in the exam, it can't work like this, because if you write like this, you'll take more time. But I'm giving you the points. You should be able to understand that
My points are there, the points is there, but what point to write? You can probably go with 2 ROCE, 2 GP margin, 2 net profit margin, gives you 6 marks. Current ratio, quick ratio, together you can talk about it maybe. Inventory holding period, receivable days, payable days, and gearing separately you can give points and you can finish it off. Because in the exam it's not about how much I write, it's about what I write, number one, to the point, and making sure that I do it within the stipulated time period. Are we clear? Understood? Guys, online, everybody understood? Yes or no? Are we clear? Yes or no? Okay. If you ask me current and quick ratio, I can connect it together. What do you think when looking at it? Okay, have a look at it. First, have a look at it. What do you think overall? What is happening with my current and quick ratio? What do you think? Akif, I'll come. Sorry? Okay.
because maybe they had an overdraft and now it's the positive cash.
Okay. Go on. Go on. More points, please. More points, please.
That's the issue because the inventory is on the fallen. Trade receivables also has decreased.
Okay.
And even trade payables also have decreased. They have paid off.
So capital employed equals assets minus all liabilities or current liabilities. Assets minus current liabilities. So technically both operating. Akifa, guys, okay, you all do. Akifa, my question is, when I'm trying to calculate this, am I including this? Am I including this 200? Mm-hmm. Have they included it and calculated it? I'll give you a study plan today. Can I give you the study plan today? Technically, Akifa, what is happening is when you take your total assets is falling down. Correct. Your total assets is falling down. Akifa, your total assets is falling down. Okay. Correct. Your total assets are falling down. Correct. Your total current liabilities is also falling down. My total assets minus my total current liabilities, no. Correct. As a percentage, what is happening? You have to go and look into that. As a percentage, what is happening? My fall in my profits as a percentage of my fall in liabilities with my fall in current assets. Overall, what is happening? Operating profit is decreasing by 22.7% when including profit on disposal. And capital employed is decreasing by 26.7%. So that means, okay, I have to do my calculation. Give me a moment. I want to verify your figures. Okay. By the end of the class, by the end of the session, I'll come to that. Okay, Akiba, just keep that on note. By the end of the session, I'll come to that. Okay, we'll finish this off. Whatever we are doing, let's finish it off. Okay, what's happening to your current ratio? What's happening to your current ratio? Your current ratio is becoming a bit stronger, meaning your short-term liquidity is better. Overall, your short-term liquidity is better. More than your short-term liquidity, you have also have enough current assets to cover your current liabilities. Okay, so short-term, your problems are short. So first thing, the current ratio in 2015 looks much better than 2014. It has increased, and currently H is able to cover its current liabilities comfortably. Okay, why did this happen? Because you came out of overdraft. Okay, now I'm giving it as a point because in the exam I know, okay, fine, I need my 11 points, so I'm gonna just give it as a point. Okay, this was possible due to the elimination of overdraft in the current year. Are we clear? Further, surplus cash from disposal could have contributed to the positive cash. Are we clear? But where's my wrapping? Okay, I've given that point. That is enough for me. Now, if you try to also work on quick ratio will also have a similar answer, similar way of answering it. And let me give you a point so that you can keep that in mind for the exam. But when you take quick ratio, 0.6 to 0.4 to 0.6, it has improved, but it's not actually better. Still, there is a problem. So we can talk about that. So in the current year, quick ratio has improved. However, this is still below the required benchmark of 1:1. If there are any sudden cash requirements, you may still have a problem. Well, it appears with better receivables management, the cash flow is improving. However, any unexpected cash outflows may impact Huston immediately due to insufficient
cash. You understand my point? So I'm giving all this as points in the exam. I'm just giving a point so I can get my marks. Inventory holding days, what has happened? It has come down, meaning you are converting your stocks into cash quicker. The inventory holding period has fallen significantly in the current year. H is able to convert its inventory into cash quicker. Are we clear? Are we clear? This could also be possible because you have outsourced. Because you have outsourced, you're not holding much inventory. So as H has outsourced, the need for holding inventory is now lower. Are we clear? Understood? Are we clear so far? Guys, are we clear so far? Now in the exam, I'm simply taking small points. I'm just trying to get my marks because the main area I'm going to score will be my ROCE, GP margin, net profit margin. Yes, current ratio, quick ratio here are not significantly, I don't have points to talk about. So I'm just scoring my marks in the exam to get my 20. Are we clear? Yes or no? Are we clear? Everybody, are we clear? Are we clear? Yes or no? Are we clear? Everybody, go on. My receivable days once again have fallen. My receivable days have fallen from 69 days to 28 days, meaning I have better credit control system. I'm receiving cash on time. That has significantly improved my working capital. So trade receivable days have improved with cash being collected quicker. This has improved the cash position of H Huston. Overall, H is out of overdraft, which could be a bit risky to have because of high finance cost. So the working capital management, working capital has improved. Therefore, working capital of H has improved. Risk of bad debts is coming down. You can have so many things. Okay, now here, okay, now if okay, now she's asking, Jan, can I speak about in terms of receivable days, can I talk about risk of bad debts? Okay, if it is increasing, risk of bad debts is high. Reducing, okay, coming down. But apart from that, you can speak about what your company could have got into debt factoring. We studied it. Factoring with recourse, factoring without recourse. Factoring means what? Factoring means you're selling your receivables. So what if they are selling the receivables to another party? You understand? Factoring. The process of factoring is I have receivables in my balance sheet about 1 million. What I do is I go to a bank or a clearing house. I say, hey, look, I'm going to get this in 69 days. Okay, you give the payment to me today or within 28 days. You collect it from the customer. Factoring.
You could have got into factoring. So when you take trade receivables as a whole, you can talk about so many things. Yes, provisions, irrecoverable debts, factoring, like that, you can talk about it. Credit control, better credit control, bringing in a new credit controller, even those things can be spoken about. So overall, there seems to be an improvement in the credit control of which. Now see, I'm just taking a point and I'm writing. I'm not going too much there. Why? Because in the exam, I just want to make sure I give my 20 points, 20 marks. Guys, having said that, here, another problem that I see here is, yes, these have increased, but I do not know what is happening to the industry. What if in the industry it is not 28 days, 15 days? What if the inventory holding period in the industry is 70 days? You understand? Therefore, as a part of my conclusion, more information about the competitor and sector ratios are required. I do not know what is happening in the sector, right? Am I clear? Yes or no? Guys, are we clear? Yes or no? Payable days are reducing, meaning we are quickly paying, bringing in positive supplier goodwill. Having said that, we should also be getting good discounts by paying on time. Maybe bulk discounts, trade discounts, that we are getting probably. So that could be the reason why our payable days could have come down. So we can say yes, but that shouldn't affect our cash flows. That should also be spoken about. So in the current year, trade payable days have improved, have decreased, meaning suppliers are paid without delays than last year. Okay, now there's another problem. What if the credit period is 60 days? Last year I was paying within 138 days, now 106 days. Then that's a problem. I do not know what is the industry credit period. So I need information on further information on credit period and supplier contracts. You understand as to how I'm connecting? Yes. This could lead to discounts, and also this could be one of the reasons why my cost of sales should come down. Bulk purchases, right? You understand? So this could lead to discounts and could be the reason for cost of sales to reduce. Are you clear? Having said that, H must manage its cash flows very well. Our thing is, let's say if your credit period is 130, 140 days, why do you have to go and give it in 106 days? You don't have to do that. So you can speak here and there about it. Are we clear? Your gearing has fallen down, meaning your interest cost is coming down. So in the current year, H has paid off one of its long-term loans. Are we clear? Reducing financial risk. Therefore, gearing has reduced. Yeah, so we've spoken about it.
So,
Yeah. So no overall cost as well. But that's a provision. When you're talking about gearing, we primarily talk about our debt portion, primarily long-term debt. So let's build it based on that. You understand my point? So if you actually look at it, from 12% loan note, you have gone to 8% convertible loan, which is better or not better? You're paying 12% interest, now you're paying 8%. H has issued convertible. Now, guys, these can go as a different point, okay? I'm just putting it together so that you know in the exam I'm getting my 20 marks. Now, because I'm running out of time, but can be a different point. So, if you're running out of point, basically, if I'm you, I would say number 2, H has strategically decreased its interest rate by moving to a convertible loan note, as the original loan note, the loan note earlier, where are you, as the loan note earlier had an interest rate of 12% and now 8%, reducing finance cost. If you're reducing your finance cost, obviously your profits are going to be going up. As such, your interest cover might look good. As such, interest cover will improve and net profits will go up. Are we clear? Understood? But what is the problem with convertibles? So what is the problem? What does it affect? Convertibles, what does it? There you go. Brilliant. So your EPS is going to be affected. Your EPS will be diluted. So from a shareholder's point of view, your EPS will go up or come down? Down. It's another point. Third point. Number 3. Although currently convertible looks good, it could be worrying to the shareholders in terms of EPS. As I know some students have requested me to do EPS again. I'll be doing it again, or I'll be sharing one of my videos on the platform. Rather than, the thing is, if I start doing a theoretical area, now this is only for Sri Lankan students, okay, not other students across other countries. I only did EPS. For Sri Lankan students, there's another tutor who did, a brilliant tutor actually, who did it, but students want to follow my pattern because they're used to it. So basically, other students, you don't have to worry, I'm not going to do it for you, okay, you know it, I've done it. But Sri Lankan students, if I do a theoretical area like EPS, I'm going to eat about 3 to 4 hours of me, which I can do for past papers. So I'll try to give you one of my recordings on EPS entirely covered, which will cover everything. Our shares, what are your shares? So although currently convertible looks good, it could be worrying to the shareholders in terms of EPS, as the diluted EPS will fall with convertibles. How many minutes do we have to spend for section C? Section C, if you're talking about this particular requirement, it's 20 minutes, okay? In the exam, it's 20 minutes. So I would say 20 marks. 20 marks in total, we get 180 minutes for 100 marks. So 180 divided by 100, 1.8 minute per mark into 20. We are talking about 36 minutes in the exam.
but I am okay for you to go until 45 minutes. Section C entirely for 40 marks, you can spend 1.5 hours. I'm fine with it. 45, 45, 1.5 hours, 1.5 hours, that's it. At the end of 1.5 hours, you stop it entirely, go to section A and B. If you start with section C. But if you start with section A and B, first 1 hour and 15 minutes, you should complete section A and B. Okay, what am I recommending? Zian, should I start with section A and B or section C? That's your question. Well, it depends on your strength. If you ask me, my strength is section C. My personal strength is section C, although you don't like ratios. Okay, so probably you can, if I know most of you, okay, most of the students come to me, sir, I'm not happy with ratios. I know that. Okay, that's one of the reasons why I'm doing a lot of questions on ratios, particularly. I know ratios is a worrying area, but you cannot tell me income statement, balance sheet, or consolidation is a worrying area. You got to start off with your most strongest first. I will start off with consolidation because I know if it is a balance sheet, I'll get it balanced no matter what. Correct. So in the exam, you start off with something positive. I will start off with section C, consolidation or income statement, balance sheet, because that's where I'm going to nail my 20 marks. Because after doing so many questions on consolidation, you can't go wrong because you're going to get consolidation. Analysis question. Okay, it depends. I have had some students, honestly, I've had some students in this particular class, I marked the mock, I gave 20 marks for the analysis, 20 out of 20. I can tell you the name also. I was surprised. This bugger got 20 out of 20 for the ratios, and this bugger didn't get anything for the calculation. For the, what calculation? For consolidation, the second calculation, this bugger didn't get anything. Wait, I'll tell you the name of that guy also, okay? I was surprised. What the hell is this? I think I gave him entire marks. He got everything done. Actually, I've given 20. Zameen is here. Zameen is not here. Okay. This guy's answer was fabulous. He got all the ratios done. He got all the ratios correct. He got the commentary done. And you know the consolidation question, what he did? If you're there, Zameen, for consolidation, you got only 4.5 out of 20. I expected you to do well in consolidation, but you go and do really well. He did a brilliant job in terms of ratios. There are some students who are really good with your ratio calculations. So if that is your strength, that's okay, you can start. But the thing is, at this point in time, I'm telling you, I'm still focusing on ratios. I am going to do more questions with you. So we will do more questions in terms of ratios. So the thing is, today itself, I know since this is worrying, we will do another ratio question. Okay, so let's do another ratio question. But this time, let's pick a different style of ratio question. Okay, it's not a straightforward. Let's try to connect it to a consolidation and do ratios. So I've done ratios with cash flows. I've done a one-off ratio question. How many ratios have I done so far? 3. What are my 3 questions? I've done Huston. I have done, is it treats? I've done treats, I've done Huston, and I have done Satar. I've done 3. I'm planning to do another one today, and I'll be doing another one, or actually 2, during this week also. Okay, so guys, you can see the amount of questions I'm doing with you.
the amount of questions that I'm doing with you is actually big, a lot. Okay, now if I have to conclude, yes, I have to give some information. I have to give some information about how Spark's recommendation has had, correct? They say overall in the current year there have been what, positive or negative image, positive or negative, what has happened? There have been some positives, I'm not saying no, but at the same time, don't you think revenue dropping is a worrying thing for you? Don't you think, okay, revenue coming down is a bit worrying? Still revenue dropping. Overall, the current year there have been some improvements, in terms of profits. However, this looks due to one-off expenses being one-off items being removed, being one-off items, like one-off items like disposal of plant, gain on disposal, like charging development cost, overhaul cost, all of them are affecting overall. So one-off items affecting profitability. Further, Sparks recommendations have have been quite useful. I've been quite useful by outsourcing. They only recommended, correct? Have been quite useful to improve profitability of Huston. Overall, more information is required to make the analysis more conclusive, such as more information on breakdown of cost, sales, cost of benefit analysis. Give about 4 or 5, that's more than enough for you. Yeah, I can actually share the answer that got 20 out of 20. I'll share that also with you. No problem. But do you see how I want you to write? The student has done a good job, okay? He's done a good job. I hope he did not use ChatGPT or Gemini to get the answer. I don't think so. I don't think so. Are we clear? Okay. Let's go on for a break. We are taking a half an hour break. Okay, it's your lunch break. So now it's 12:53. We are taking a break until 1:30. We are back at 1:30 doing the next set of questions for ratios. Okay. See you soon. Bye bye. Everybody joined? Everybody joined? Everybody joined? Where are the others? Others are missing. Huh? That also we'll do. We'll do that also. Yeah, I'll send you the answers. Don't worry. I'll send you the answers. Okay. After class, I'll send you the answers. Okay. Right. Okay, let's start at exactly 1:40. Okay. In 4 minutes, let's start. There are some students messaging me that they're in lunch. Let's start exactly at 1:40. Okay. Will do. Okay, can we start? Akif, I'll come to you. Akif, I'll come to you. I'll give you the answers. Calculate ratios for Harbin. Calculate ratios for Harbin for the year ended 30th September 2007. Okay, now we are going back to about 18 years back. We are going to see what is happening in 2007. In 2007 also we've got something like this, but for 25 marks. For 25 marks. Okay, so I'm doing a bigger detailed question just to make sure that we cover more points and better understand a 25 marks question. Calculate ratios for Harbin for the year ended 30th September 2007 equivalent to those calculated for the year ended 30th September 2006. Show your workings. Assess the financial performance and position of Harbin for the year ended 30th September 2007 compared to the previous year. Your answer should refer to the information in the Chief Executive's report and the impact of the purchase of the net assets of Fatima. And the impact of the purchase of the net assets of Fatima. Okay? A very tricky question. I'm giving you a solid 10 minutes for you to go through the question, get an idea of the question, and then we are going to do it together, discuss it together. Okay? Start. Huh? No, I didn't send the question. You want me to send the question? Okay, I'm going to send the question then. Give me a moment. Okay, I've sent you the question also to the group. Read the question properly. It's a solid question. What do you think? What do you think overall? Overall, what do you think? Overall, what do you think?
Even though the profits got
Hmm.
it's more negative.
Okay, that's going to give you your marks.
Cash. So they don't have the cash. End of the 2017.
Okay, let's take a detailed summary from everyone. Okay, what you are trying to understand based on this. Okay, right, guys online, you're gonna start giving a detailed a summary as to what you see based on this. What is your summary?
They, in 2017 compared to 2006, they don't have cash. Moreover, they bought, they bank overdraft. So in cash flow side, the financial risk is high, and their payable period, receivable periods all this got increased. So the payable amount is got increased. That means the suppliers and customers are taking time to pay him. And even though profits is coming doubled, but even though profits is getting double, revenue wise, overall wise, it's negative.
Okay, so this is student physically, she says cash flows are affected, company's receivable days, payable days are affected, cash flows affected, but profits have gone up. Overall, it's mixed reviews. Guys online, anyone? Anyone? Asim, Ashfa, Chamudi, Akifa, Hajira, Hanson, what do you think? Karishma, Pratisha? Oh, that's a big list. What do you think, Asna? What are your thoughts about it? Harbin purchased a private owned company, resulted in bank overdraft, and we spent cash in bank, and it's also increased in liability also. That's all.
The company, the performance has been more like neutral. That means there has been no improvement.
Okay.
And whatever the figures they show are combined with the new subsidiary.
Super. Good one. There you go. That's what I'm looking for. Brilliant. That's what we are looking for. You should pick that. You should have picked that. Super one. What is happening if you really understood the scenario? 2006 figure is a single entity figure. 2007 is a consolidated figure. Good one, buddy. That's a good one. Meaning the results of Fatima has been consolidated in this year. And that's why you see an inflated profit, inflated revenue. You have just consolidated and showed it here. In 2006, it's not consolidated. That has to be your major crack in the exam. You can talk about anything, no problem. But there is a cracking point where you need to understand, hey, look, if you read this question entirely, okay, he's got a brilliant response, okay, very impressive. 2006 and 2007. 2006 is only Harbin's figure. 2007 includes Harbin and Fatima together. Meaning you can't compare them. It's not like to like figures. Shown below are the recently issued summarized financial statements of Harbin, a listed company for the year ended 30th September 2007, together with the comparative for 2006 and extracts of the chief executive's report that accompanied the issue. Turnover, massive, gone up, good increase. Cost of sales, gone up. Obviously, GP margin has gone up. Operating expenses, gone up. Finance cost is also going up from last year. Profit before tax have doubled, and your profit for the period has doubled. 100% increase. So looks like a very good company. That's what we will think in the exam. Fixed assets, goodwill. Under fixed assets, goodwill. We have goodwill probably because we have made an acquisition, and tangible fixed assets from 90,000 to 210,000. Stock, debtors, and bank. Okay, now these are new terminology. Stocks means inventory. This is an old past paper. I wanted you to show the catch. That's why I took the question. Stock means inventory. Debtors means receivables. Bank, no changes there. Okay. Creditors amounting falling within 1 year is your current liability. Bank overdraft, creditors is your payables. Corporation tax payable. Creditors amount falling due more than 1 year, that is non-current liabilities. 8% loan note. Last year you did not have a loan, this year you have a loan. Equity shares is the same. Your P&L is your retained earnings, right? So basically, if you look at your stocks, your inventories are going up, you're holding more inventory. Your debtors have gone up, your positive bank balance has now become a negative bank balance, which is an overdraft, which is a concern for you. From 23,000, it has gone up, your creditors and your payables have also, corporate tax has also gone up.
Extracts from Chief Executive's report. Highlights of Harbin's performance for the year ended 30th September 2007. An increase in turnover by 39%. Okay, now what we will do in the exam, you'll sit, you'll take the calculator, turnover 39% okay, 250,000 minus 180,000 divide by 180,000, yeah, 39%. You go and check the examiner. If the examiner got it right on. Anybody did it already? I know some students will sit and calculate, okay, examiner move haritama gattadu nadda 39%. Bugger got it right. You are not here to go and check the examiner. Don't bloody waste time in the exam. 39% is it correct or not? Gross profit margin, yeah, did it really go up from 16 to 7? If your examiner gives a point, that means your examiner has already calculated. That's what happened with our last question. With our last question, in terms of ROCE, I'm getting messages which I will solve. 37 and 31% students did not know how your examiner got it. And what goes and happens in the exam is you go and check, okay, fine, equity plus non-current liabilities, I take the figure, but that figure in my ROCE is wrong, so examiner has made a mistake. You come out, Zian, examiner has made a mistake. Can't happen. Can't happen. Okay, you do not know how to get this figure, I'll tell you how to get this figure. Don't worry. I'll tell you once we are done how to get this figure. And I'll explain you in terms of ROCE what we wrote. Okay. A gross profit margin from 16% to 20%. So gross profit margin has gone up. And a doubling profit for the period is what the chief executive is claiming. But the bugger is lying. Obviously, right? In response to the improved position, the board paid a dividend of 10 cents per share in September 2007, an increase of 25% on the previous year when your cash flows are severely hit. You have also been provided the following further information on 1st of October 2006, that is during the year 1st of October 2006. What did you do? Harbin purchased the whole of the net assets of Fatima, previously a privately owned entity, for 100 million. The contribution of the purchase to Harbin resulted in the following. Turnover 70,000. Your profit before tax 22,000. Turnover 70,000 means, okay, so 250,000 minus 70,000. If you remove Fatima's figure, 180, your revenue did not double. It is the same. Good point. He got it. He got it. What happened to your profit? Last year your profit was the profit that you are trying to take from here is 22,000, correct? So go to your profit before tax. They have given us how much? 22,000. You have added from here, correct? So in fact, from 12,000, which is my net profit, from 12,000, if I deduct 22,000, my original profit would have been minus 10,000. Yes or no? For this minus 10,000 of Harbin, Fatima's profit of how much? 22,000 was added, resulting in a 12,000 profit. So basically, the company did not make a profit. In fact, the company made a loss, a big loss. You should be able to challenge this in the exam. Tell the examiner, hey, look, you have made a loss. Are we clear? You see, a different way of looking at a question. It's tough to crack that. But now you know, I have covered multiple areas in terms of ratios now. But probably you might think, okay, I know everything in terms of ratios, but you go to the exam, still there'll be something new the examiner can come up with. So we will cover even more questions. This is where we are struggling. We will cover even more questions. Are we clear? Are we clear? Super. So, information given, there were no disposals of fixed assets during the year. The following ratios have been calculated for Harbin for the year ended 30th September 2006. ROCE, net assets turnover, net profit, current ratio, closing stock period, that is inventory holding period, data collection is trade receivables, creditor period is trade payables, and debt gearing over debt plus equity. Are we clear?
Requirement: calculate ratios for Harbin for the year ended 30th September 2007 equivalent to those calculated for the year ended 30th September 2006. Understood? Yes or no? Okay, I'm giving you about 5 minutes. This time I want you to calculate the ratios. Okay, copy these ratios. 2006 is given. I want you to calculate what? 2007. I'm giving you about 5 minutes. I want you to start calculating the ratios. Quick, quick, quick. And I want you to give me the ratios. Calculate it and give me.
So the calculation should be taking its parking or remove the.
What do you think?
I think we should remove.
Then you do.
Let's say equivalent to those calculated for the year ended 30th September 2006.
So think, what should you do? Video. Done. Don't remove. Don't remove. I mean, do it as if they have given, and then we will answer. Unless otherwise they tell you to remove.
They said equivalent, no? That means like we should assume they.
No, don't remove. Directly do it. Unless otherwise in the ratios they'll tell you if you have to do. But when you're explaining, you can remove and show. Because basically what happens is when it's consolidated, that is the figure that you have to use, right? That figure is correct, right? That's not wrong. You understand? But only for commentary purposes, you have to do. Everybody, calculate and give me the answers. Quick, 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 quick. Calculate and give me the answers. All this.
Done? Answers? Done? Answers? Answers? What do we need? So, coming back. Uh, Harbin, the ratios I need, my ratios that I need are ROCE, return on capital employed. They say profit before interest and tax over total assets less current liabilities. They are given us the formula also. So I have two things. Number one, I need to get my ratios. Ratios for 2006 is given. I have to calculate 2007. So there you go. And then of course I have to assess the financial performance and position. I'm not required to write a report, so I'm going to directly get my answers. Okay. ROCE, net asset equal to capital employed over turnover. Net asset turnover, net profit before tax margin, net profit margin, that is before tax, current ratio, inventory holding period, and then trade receivable days, and then trade payable days, and then gearing ratio. Guys online, can you give me the ratios, please? Guys online, can you give me the ratios? 2006 figures, can I get it? 7.1, okay. And then I got it from Asif. Guys online, others. I want your answers, please. Net asset turnover, how many times? 1.6 times. And then net profit margin, 4.2 percentage, 4.4 percentage, and then current ratio 2.5 times, inventory holding period 37 days, trade receivable days 16 days, trade payable days 32 days, and then gearing 0. Are you sure? Okay, last year is 0. Okay. 2007 figures. Charuki, Hajara, Hansen, Jasmine, Akifa, where? Naresh, Rubini, Sanjay, answers. Okay, ROCE, I've got 11.2% from Akifa, is it correct? Okay, ROCE, how do I calculate? My profit before interest and tax. My profit before interest and tax is at, where is it? My profit before interest and tax will be 16,000 plus 8,000. So equals 24,000 over my capital employed, correct? My capital employed will be my total assets minus current liabilities, right? They say take equal to capital employed, which is total assets minus current liabilities. My total assets are 220 plus 38, 258,000 minus 44,000. So 258,000 minus 44,000, 11.2%. 11.2%. Are you getting it? Okay, 11.2%. Are you getting it? Okay, superb. Net asset turnover. My net asset turnover will be my net asset equal to capital employed over turnover. So my turnover over capital employed. How do you get it? My turnover revenue over capital employed. Correct? Turnover is revenue over capital employed. Correct? Turnover and revenue is the same, right? So how much is my revenue? 250,000. So equals 250,000 over capital employed. Capital employed we calculated, right? How much is it? 214,000. 214,000. 1.16 times. 1.2 times. Can I take it as 1.2 times? Yeah. 1.2 times. Okay, fine. My net profit margin, but they say net profit before tax, correct? My net profit before tax is how much? 16,000 over 250,000. So equals 16,000 over 250,000 gives me 6.4%. 6.4%. Okay. My current ratio is going to be my current assets over my current liabilities. My current assets is 38,000 over 44,000. So equals 38,000 over 44,000. 0.86 times. 0.86 times. My inventory holding period. My inventory holding period is my closing stocks over cost of sales into 365. My closing stocks is going to be how much? 225,000. 25,000 over 200,000. 25,000 over 200,000 into 365. 45.6 days. Correct. So 45.625 days. My trade receivables. My trade receivables are at how many? I've got trade receivables. I've got trade receivables for 13,000 over my revenue. So 13,000 over 250,000 into 365 days. 19 days almost. Okay, that's done. And then I've got trade payables. Trade payable days will be trade payables over cost of sales into 365. Okay, trade payables. My trade payables is going to be 23,000. My cost of sales is, so 23,000 over 200,000 into 365 days, which is 42 days. My gearing, they say debt over debt plus equity. My debt is going to be 100,000. Debt plus equity will be 200 214. Correct. So 114 plus 100. So equals 100,000 over 214,000, which is going to be 46.7, 47%. So I'm going to take it as my percentage. Are we clear? Asim, have I made a mistake? 42 days where, are there any mistakes, guys? Correct, right? Everything's correct, right? No, sir. Okay, I'm fine. Super. Okay, thanks. So now I'm going back to my commentary. I'm going back to my commentary or my analysis. Okay, my analysis. I'm going back to my analysis. Guys online, are we clear? Guys online, are we all clear? Guys online, are we all clear? Okay. Take few minutes, quickly see what is happening. What is happening? Try to develop your points. Think about your points. Think of your points. Think about your points. Excuse me. What do you think ROCE? ROCE, what do you think? ROCE has increased or it's a problem? Increased. Okay. Let's start answering. Okay. Let's start answering in our style. Let's wrap it. Okay. So it's a positivity, right? ROCE is gone up. So in the current year, ROCE has increased by 4%, by 4% approximately, by 4%. Okay, are you clear? This appears to be quite favorable to the shareholders, positive, right? As an increase in ROCE simply means higher returns for the capital employed. So from a shareholder's point of view, you've got high returns for your capital employed. Clear? Right. But is that the case? However, a closer look into the financial statements will reveal that okay, will reveal that ROCE in the current year includes the results of Fatima, correct, which is going to be F from this point. Since F's results are consolidated, since F's results are consolidated in the current year, the ROCE is increasing. Am I right? In fact, if Fatima's results are removed from the financials of Habil, of which the ROCE would have actually been reduced or a negative figure. What do you think? It could have been a negative figure, right? Is it negative? Your profit before, so 16,000 plus 8,000, you would have shown 24,000 as operating profits, correct? The current year.
So, if they have given profit before taxes 22,000.
Profit before tax. Profit before
So it
tax.
will be 22 plus 16, 38,000.
22.
Minus, it will be minus 4,000. Profit before tax.
So wait. So we have your operating expenses. After operating expenses, okay. So that's your operating profits, no 22,000.
Yeah.
So here your operating profit is how much?
16,000.
Your operating profit. No, operating profit is 16 plus 8, 24. You have to get to this point. It's 24. Here it's 24. But here it's how much? 22. So basically you would have made 2,000 profits. Correct. So 2,000 profits means 2,000 would have been your operating profit that you will use to calculate ROCE. So technically it's not a negative figure. It would have been a significantly lower figure. So here 2,000 here 2000. Comparatively, you will have here 2000, correct? Here 8000, correct? So from last year to this year, your operating profits would have reduced significantly. So that would have been a 6,000 reduction. 6,000 divided by 8,000, which is about 75% decrease. So it's about 75% decrease. Okay. So in fact, if F's results are removed from the financials of H, the ROCE would have actually declined. Would have actually declined, as there is a 75% decrease in operating profits compared to last year after removing Fatima's contribution for operating. Guys, everybody, do you understand this point? Yes or no? Everybody, do you understand the point? Yes or no? Are we clear? Yes or no? Everybody understood? Yes or no? Yes or no? Yes or no? Everybody understood how I'm trying to get to my answers? Do you understand? Yes or no? Now look at this. I've given proper 3 points in the exam. Speaking about what is affecting what. Overall, yes, ROCE looks positive, but in the current year, ROCE has increased by 4%. This appears to be quite favorable to the shareholders. An increase in ROCE simply means high returns for the capital employed. Positive. However, closer looking at the financial statements, we believe that ROCE in the current year includes results of Fatima. Since Fatima's results are consolidated in the current year, the ROCE is increasing. If not, it wouldn't have increased. In fact, if results are removed from the financials of H Harbin, the ROCE would have actually declined, as there is a 75% decrease in operating profits compared to last year after removing F's contribution for operating profits. Are we clear? Yes or no? Okay. Your net asset turnover last year to this year has come down. So from 1.6 times to 1.6 times to 1.2 times. So basically there is a drop from 1.6 times to 1.2 times. There is basically a drop. So basically what is happening? Why do you think there is a drop? So your goodwill coming in could have affected what else? Think. Go through.
The fixed assets, you affect the company due to the date code.
Okay. What is happening? Your asset base is increasing. But still your asset base is increasing because of Fatima. And also goodwill is also coming in. Correct. So because of that, your net asset turnover is basically going up. But have they given you the results of Fatima's balance sheet items? No. So what is the conclusion there? You need details of balance sheet for you to understand how more information could help you analyze this ratio even further. So basically, as a part of my conclusion, further information, detailed analysis of Fatima's assets, balance sheet, financial statements, financial positions are required. So how are you going to say in terms of net asset turnover? So basically net asset turnover has come down, meaning your usage of your assets are less.
So in the current year, net asset turnover decreasing indicates a decline in the efficient use of assets to generate sales. Okay, it can be noted that the total assets have increased significantly in the current year with the inclusion of Fatima. You understand? Yes, revenue has also gone up. We know revenue has also gone up, but it looks like the assets increase is higher than the revenue increase. Although revenue has increased, it appears the percentage of assets increase is significant comparatively, leading to an increase in net asset turnover. Understood, guys? Are we clear? Are we clear? Assets increase with Fatima's acquisition, and regarding the revenue, HS revenue separately, it is not increased compared to previous year. When you compare, yes. Net profit margin. Your net profit margin, in fact, what does the chief executive say? Now you can go back and speak about what the chief executive say, because that is one of the requirement. Now your chief executive is saying that your net profit has doubled, but has it actually doubled? No. So yes, when you compare your net profit margin has gone up. I'm not neglecting the fact. So net profit margin has increased in the current year compared to last year, which means the profits generated through which means the profits, okay, let's not go to that detail about theory. Increase in the country compared to the last year. Okay. However, a detailed analysis reveals that the current year net profits are inflated with Fatima's results. But if you remove Fatima's results, what is happening? Exactly. CEO is arguing that current year profits have doubled. In fact, if Fatima's results are removed, Harbin is not making profits. In reality, Harbin is making a loss, which will result in negative net profit margin. Are we clear? So in other words, the CEO statement is actually wrong. Yes or no? This looks a bit worrying. To the shareholders as the company's revenue and profits are actually falling down. Correct. Revenue is also falling down. Profits are also falling down. Is that no? But But what if you, what do you think about Fatima's results? Fatima as an individual company, what do you think? Doing good or doing bad? Doing good. So what if you are acquiring a competitor? So the strategic reason for acquisition is not known. You understand? What if you are acquiring a competitor? So that means yes, you can go for a loan and get a competitor who is making profits. So then it makes sense. We do not. So I'll say further, the reason for acquisition of Fatima is unknown. However, if the acquisition is a strategic move to eliminate competition, this is justifiable. Number 3, because Fatima is doing well in the future, what do you think? Your net profit margin will increase or will come down? With Fatima currently making good profits and contributing to the group overall. In the future, the group as a whole can perform well. Do you understand how I'm wording my answers? Do you see? Do you see how I'm wording my answers? That's how you have to work in the exam. Understood? Hajira? Others understood? Yes or no? Superb. Current ratio. What is happening? A big drop in current ratio, which is going to be worrying for you. A big drop in current ratio is actually worrying for you. So why will it be worrying for you? Because your overdraft is also increasing. So there is a bit of problem in terms of your current ratio. Well. And even in this difficult period, what you have done is you have went and paid dividends. You understand? The thing is, we are also not very clear on Fatima's liabilities. So it could have also affected our liabilities, right? So what if Fatima had an overdraft? So we can start speaking about all this. Currently,
But I don't think because they have paid like 100 million. That means,
okay,
you know, if there were like overdrafts and liabilities, then the value would have been very low. Because the revenue is around 70 million.
their revenue is 70 million, correct? How much are you paying to acquire? Where are they saying that you're paying 100 million to acquire? Okay, here they are saying you're paying 100 million to acquire. You're paying 100 million to acquire.
So they don't have any finance. It's all operating expenses, profit before tax.
Okay. He says, Zian, look, the liabilities of Fatima may not have had a significant impact in terms of cash liquidity because there is no finance cost here. Because there's no finance cost here, I don't think there'll be an overdraft. Accepted? No problem. So here, 100 million you are paying to acquire. For that 100 million only, you have gone for a loan note probably.
Can be. Can be. So meaning you're stressing your liquidity. So company strategy is not known why you're stressing so much and why you are squeezing to pay dividends. Why you have made dividend payments. So that we can talk about maybe. Okay, I'm with you. Works sense.
It's actually an inefficiency of the main company. Because even the interest is only I think 8,000 and that is the finance cost.
Interest?
8% of 100. That means they have gone in for an overdraft because of the
Company's cash flow difficulties. 100,000 into 8%, that is adding our finance cost. Okay, current ratio. It can be noted that the current ratio has significantly fallen in the current year. And it is below the threshold. It is below the threshold of 1. Therefore, Harbin is currently facing short-term liquidity issues. Are we clear? Number 2. Second, number 2. In the current crash of liquidity, Harbin has still made a dividend payment, which is an increase of 25% to previous year. This does not look too good to the company as the cash flows are under stress. The idea behind the dividends payment has to be known. The current crash of liquidity, HS still made a dividend payment which is an increase of 25% to previous year. This does not look too good to the company as the cash flows are under stress. The idea behind dividend payment has to be known. Are we clear? And number 3, you have an overdraft, which is a problem. Currently H has an overdraft which could be coming at a high interest cost as it is short term. H must immediately find ways to improve its working capital management and try to resolve or repay at the earliest to ensure cash flows are smooth. Are we clear?
10,000 in dividends.
They are paying 10,000 in dividends when your cash is not quite strong.
10,000 in the sense eliminating the last 3 zeros.
10 million. Yeah, so that's what we spoke about dividends. No problem. So we've spoken about it. So we don't understand why they are paying it. What's the reason? Even during a crisis like this. Inventory holding period has slightly increased. Probably due to slow moving inventory. But do we have any more information about it? No. So probably we need more information about more information on inventory movements. Trade receivables have slightly increased and trade payable days have also increased. Trade payable days going up is probably due to your cash position being affected. You're not paying on time. So inventory
holding period has slightly increased, probably because your stocks, you're not selling enough, your inventory is outdated, so probably you might need a write-off, inventory write-off, you never know. So that might further strain your profits in the future. Inventory holding has slightly increased. Further information is required to understand the reasons for this. This could potentially impact profits in the future with inventory write-offs coming. Are we clear? With inventory write-offs coming in, because the inventory holding period is going up. So we need more information about why your inventory is also going up. So we also said that reasons for dividend payments is required to understand why they have made dividend payments. Trade receivable days is slightly increasing. Our customers are not paying on time, meaning our credit control system is also getting weaker. So trade receivable days are slightly increasing, and this is also affecting the cash flows. Okay, it could mean the credit control system is weaker, and this has to be immediately resolved. Are we clear? Further, what can happen? You can have bad debts. So failure to resolve the increase in trade receivable days could potentially lead to higher irrecoverable debts, further straining profits and cash flows. If this is not immediately looked into, the current ratios could further be affected, as they are already in a really worst case. Correct? Understood? Trade payable days slightly going up because your cash flows are affected. Trade payable days have increased quite significantly, which could be due to cash flow issues. Non-payments to suppliers on time could result in a risk of supply disruption. So goods may not be supplied to us on time. Further, this could lead to negative supplier goodwill, and H may lose out on early discounts and cash discounts. Clear? Gearing ratio. Last year you did not have gearing at all. This year your gearing has gone up to 46.7%. The reason for your gearing is because of you're gone for a loan note. So probably your interest is also going to eat up. The current year gearing is at 46.7%, which puts Harbin at financial risk. This is due to the acquisition of H of F, which was funded through a loan note. This could be a risky decision if Fatima does not generate enough profits to the group. With gearing comes interest, and if interest cannot be paid on time, this could result in going concern implications. Overall, the reason for acquisition for Fatima has to be known to understand if this is a justifiable acquisition or not. Are you clear? There you go. We are done. Further information, detailed analysis of Fatima's financial position is required. Reasons for dividend payment is required. Right? What else do we need? Comparisons of financial statements of last 5 years, and budgets are required, and forecasts are required. SWOT analysis, what is happening in the market. So conclusion, correct. So conclusion, overall, the performance of Harbin in the current year is not truly its own performance, as the performance is consolidated with Fatima's performance. Correct. You can get the sector ratios also. The analysis includes Fatima's performance in 2007. Therefore, the ratios includes Fatima's performance in 2007. The CEO's statement regarding good performance cannot be justifiable, as these are not solely the performance of Harbin. Without F, Harbin is making a loss and can be worrying to the shareholders. For the analysis to be more conclusive, further information such as below is required. What do you need? Detailed analysis of Fatima, financial position, reasons for dividend payment is required, comparison of financials of last 5 years and forecast is required, sector averages, SWOT, etc.
Now, if you look at this particular this thing, I completed within 1 hour with my explanation. Not 1 hour. We started at 1:45. I give you about 10-15 minutes. At about 2 o'clock only, I actually started. I gave you time to read and so within about 1 hour, we were able to complete this. Okay, I'm giving about 5 minutes. Quickly go through this. So Asim, coming back, you can answer in a Word document. I'm not saying no, but this is the best way to go about. This is the best way to go about. So how will it look in the exam? Have you seen the spreadsheet, how it looks in the exam? Okay, you can put a comment note there. Username, password, anybody? Six one five three four 615345. You wanna type the password? Okay, I'm getting it here. Okay. Asim is sending me a private message. Okay, so it's easy. Okay, you don't worry. 634 634 6522. Password. I love Afra. No, you don't love Afra. Who do you love? Okay, how do I get this right? Uppercase, lowercase.
In that other class, it's there already. Okay.
It's there. So can we all go to the other class then? Okay, it's okay. I love Afra, it's okay, correct. Okay, until it loads, let me quickly go and comment on what happened to ROCE here. Okay, super. Akifa, you are there? Akifa, you are there? Okay, super. Now, our ROCE, right? When we take ROCE, where can I write? So when I take my ROCE takes into consideration my operating profits. So I have my operating profits over my capital employed. My capital employed will be my total assets minus current liabilities. Okay, are we clear? Are you all clear with this? Yes or no? Are you all clear with this? Akif, are you clear with this? Yes or no? Everybody. That's correct, no? Your operating profits fell down, came down, or went up? Your operating profits came down or went up? In the last question that we did. Our profits, not this question. Our profits came down or went up? Our operating profits fell down. Our operating profits came down. So we have a decrease in operating profits. A decrease in operating profits will obviously reduce our capital, our ROCE, or will increase our ROCE? Will decrease my ROCE, correct? So if my operating profit is 10, capital employed is 100,
which is 10%, if my operating profit comes down to, let's say, 8 over 100, so 8 over 100 gives me how many percent? 8%. My operating profit falling will reduce my capital employed, correct? Sorry, will reduce my ROC, correct? Akifa, so to this point, are we clear? Yes or no? To this point, are we clear? Okay. Now here in this particular question, my operating profit is coming down, which will affect my ROC. But my operating profit, actually you have to take this also to calculate ROCE, 1360 plus 200. My operating profit comes down, has multiple factors involved. What are the factors that is involved? Obviously overall cost. Number 2, my research, my development cost. Number 3, my profit on disposal. So there are costs as well as there are some benefits also. Overall, it has been affected. Yes. Now my second issue here is capital employed. Now, when you take capital employed, if my capital employed falls and my operating profit stays the same, my capital employed falls and my operating profit stays the same, my ROCE, what will happen? For example, my operating profit is 10, my capital employed comes down to 80. What happens? 10 over 80 gives you, my ROCE will become 12.5%. Correct? My capital employed falling, employed falling will increase my ROCE. Akif, understood yes or no? Okay. My capital employed is a combination of total assets and current liabilities, correct? Okay. Now let's go in detail and understand what is happening to my total assets and current liabilities. Now, if you take my total assets in the question, I am selling, disposing some plant, correct? So that means my property, plant and equipment is coming down, correct? My development cost, my DC development cost is coming down, correct? If you take my current assets, my inventory and my receivables are coming down or going up? Coming down. My inventory and trade receivables are coming down. Okay, correct. So basically my total assets are dropping. If my total assets are dropping, basically my ROCE has to go up or come down? Go up. But still what is happening? My ROCE is falling. Meaning my total assets are not only affected, my liabilities are also affected. My current liabilities is also affected. My liabilities are affected because what is happening? My payables are also coming down. My payables are coming down, meaning my trade payables are coming down at a higher level. Plus, not just that, my overall provisions is also coming down. You understand? It's affected, no? Capital employed, no? Affected. My deferred tax is also coming down due to the disposal. You understand? So I'm not technically taking it as the current liabilities, I'm taking it as liabilities. Okay. So basically I'm taking it as liabilities. My liabilities are also affected. Because my liability is falling down, the value of my liability is falling down is higher than the value of my assets falling down. My liabilities, if my assets fall down by 10, my liabilities are falling down by 50. This is increasing than this. Because of that, what is happening? My ROCE is falling down overall. So the combined effect is, yes, the profits are coming down. I'm not saying no. But capital employed as a whole, when you see, is going up, further affecting my ROCE. Are we clear? Are we clear? There you go. So basically, you should be able to analyze it like that. Because the percentage of liabilities falling is higher than the percentage of my asset falling. It is having a significant impact on my capital employed. Because of that, my ROC is going up. Alright, my Indian students, y'all can leave. My Indian students, y'all can leave because with Sri Lankan students, I have another area to complete, which I have completed for you. Indian and other countries, Maldives, if you are there, I have completed for you. My Sri Lankan students, y'all can say. Oh, my ACCA, okay. Okay. Where's my ACCA? Go to my ACCA. It's loading, okay. Where's that? Once again, I have to fit and type 63 46 46 Guys, understood the session entirely? Guys, understood the session entirely today, whatever we did? Once again, for the marathon, we'll be meeting. Okay, Sri Lankan students, you're going to stay. Okay, very useful. Thank you. Sri Lankan students, you're going to stay. And for the marathon, once again, we are going to meet next Saturday. Saturday from 1:30 to 2:30 to 6 o'clock, or 1:30 to 6. 1:30 to 5:30. I'm sorry, 1:30 to 5:30 next Saturday, but 1:30 to 5:30, and next Sunday also we'll be meeting. Okay, next Sunday also let's make it the same time like today, 11 to 4. Okay, students, Indian students, you can leave. Sri Lankan students, we are taking a 15 minutes break and we are back.
So it will take 10 minutes.
5 minutes, 5 to 10 minutes. Okay, right, let's get going. If you look at our syllabus completion, we have IFRS 13 conceptual framework, and we started off with conceptual framework, right? We started discussing. So basically, guys, IFRS 13, we are gonna complete. It's a small area. I'm gonna complete that. Conceptual framework. Conceptual framework is also a small area, which we have covered partially, but remaining I'll also have to do it. Okay. Now, having said that, where are we? We've done Atlas, Kingdom, Dobry, Sautar, Gold, Treats. Today, what did we do? We did Huston. We did Harbin. Anything else? That's it. Okay. I want to have a class with you on Wednesday. Sorry, not Wednesday, Tuesday actually. Tuesday I want to have a class from 5:30 to 8 o'clock. Or is it possible if I can get an afternoon? Everyone, can I get a slot, afternoon slot? 1:30 to 5:30. Why? Working. One day let's take a sick leave.
Previously, I had to for consultation.
Can't. One day. Because the thing is, in India, since I have weekday classes, I've done a lot of questions with them. So I want to extra do some questions with you all. If I can get a Tuesday slot, can't do anything.
The Tuesday I'm also I also can after 5.
Why? You have PM. No, no problem. Even Wednesday is fine. During this week, if I can get a 4-hour slot, you tell me even morning or afternoon, I'm fine. You are working. Can't. Can't. Huh? You can. You can. Okay. Guys online? Guys online? Chamudi, Shan, Naresh, Senuri, Zara? Can't. Guys online say they can. Guys online say they can. Okay, I have to be fair between both. So I'll do at 5:30. 5:30 is fine. 5:30. 5:30 on Tuesday. 5:30, 6:30, 7:30. 6:30, 7:30. Yeah. 5:30 to 8. Okay. So that means I will try to do 2 sessions. On Tuesday one and another one on Friday. Or yeah. Oh wait. Okay, no, nothing to worry. I can go until 31st, right? I'm talking about. Okay, I was thinking next week is my last class. Now, yes, technically, officially until next week I can go on 24th. That's where I'm done with the marathon. But with you all, even following week I can meet you, right? It's okay, right? Okay. So that means next week, 23rd is there, no? I'm starting at 1:30, no? I'll start. Okay. But I'm going to go on my classes. I'm going to do my classes until when is your exams? 4th. Can I go until 31st? So next Saturday, next Sunday, I'll be meeting you. Following Saturday and Sunday also, I'll meeting you. That is okay. Okay, then I'll have a proper another 7 to 8 hours slot. Just that I want to do more questions. I mean, I don't have anything to do. At home also, I'm useless, right? I don't have anything to do. I don't like to just stay at home. So at least I'll come and do past papers with you. I am jobless, right? You understand? Okay, right? So, okay, no class on Tuesday. We can call off Tuesday's class provided you give me next Saturday and next Sunday. Anyway, it's there in my official schedule. I'm talking about following Saturday and Sunday. Okay, or I'll give you another plan. Next Saturday and Sunday we meet 24th. The following week, 25th week is there, no? That week, 2 weekdays I want to meet you. 5:30 to about 7:30. 2 weekdays. And then Saturday, Sunday also I want to meet you. You understand? The more I'm with you, it's more better for you. You understand? So, I mean, I can just simply say, okay, look, I'm done with the syllabus. I've done enough of past papers. I'm done. But it's just that, I want to give you more time. Okay, so then let's plan it accordingly. So by that time, you should also be prepared, okay, to the level that I am prepared. You should also prepare and come. Okay, super. So let's finish off IFRS 13 fair value. Okay, it's a small standard. I won't even take about 10 minutes and then I'm done. Okay, IFRS 13 simply is fair value. Okay, now what is fair value? We've been studying fair value. Fair value is the value that we incorporate in the financial statements. Now IFRS 13 gives us guidelines as to how we can account for this fair value. Okay. Okay, super. Hold on, I'm getting a call. Okay, super. Okay, let's come back. IFRS 13. IFRS 13 was issued for several reasons, the main reason being to reduce complexity and improve consistency in the application of measuring fair value. Because, guys, fair value, we use this word commonly everywhere. We use this under IAS 16 fair value means market value, under IAS 40 fair value means market value, under IFRS 9 we use. So under different standards we use. So there needs to be a consistency as to what is fair value. Many IFRS or require or permit entities to measure or disclose the fair value of assets, liabilities, or equity instruments. But prior to issue of IFRS 13, the description of how to measure fair value was limited, and in some cases it was confusing. For example, the investment property standard IAS 40, the financial instrument standard under IAS 39, and the standard on business combination IFRS 3 all use the definition of fair value. But what is fair value, you will only know in that particular standard, because the fair value changes based on the particular standard. Fair value, fair means correct, value means valuation. The standard says when presenting financial statements, we have to present in a fair value way, a very fair way to the stakeholders. So basically, another reason as to why this standard was issued was to enhance disclosure about what fair value is. So what is fair value? Fair value is defined as the price that would be received to sell an asset. So if you're selling an asset, the price that you will receive to sell an asset, or pay to transfer a liability. Okay, how much I'm going to pay to transfer a liability, to settle a liability in an orderly transaction between market participants. At the measurement date, in other words, we call it an exit price. Therefore, the standard gives us a fair value hierarchy. It says based on level 1, level 2, level 3. Based on this hierarchy, choose your fair value. Always go to level 1 first. If level 1 information is not there, go to level 2. If not, go to level 3. The fair value hierarchy. The entity should use valuation techniques that are appropriate in the circumstances and should maximize the use of observable inputs. Observable inputs means inputs based on market data. Market data information is much more reliable than any other data. IFRS 13 seeks to increase consistency and comparability through a fair value hierarchy. A hierarchy like this: level 1, level 2, level 3. It says first go to level 1. If you can't get information from level 1, go to level 2. If not, go to level 3. What is level 1? Level 1 inputs. These are most reliable values and based on unadjusted quoted prices in an active market for assets and liabilities. For example, if you want to know the price of a company, you can directly go to the share market, stock market. In the stock market, you'll be able to know the share price of the company. So if you can get the information from the stock market, that's the highest value that I can use. That is level 1 input. Now, if the company is not publicly listed, I don't have information about the company. Then comes level 2. Level 2 inputs are inputs other than quoted prices in level 1, but that are observable for that asset or liability. Example, quoted prices for similar assets or liabilities in an active market. So for that particular company that is not there in the stock market, I will see, okay, fine, what is a similar company? So based on the similar company, I'll try to do the valuation. Similar bonds, interest rates, based on that I'm going to do. Level 3 is the weakest form of input. It is the lowest form. So this is the highest, this is the medium, this is the lowest. So in a lowest form, it is based on the best information available. What is this best information? Your present value of future cash flows. Now you used company's discount factor. Based on that, you try to get an information about the company. That is the last and the lowest level of fair value hierarchy. So as we try to incorporate financial statements, in the financial statements we have to try and incorporate always level 1. Where level 1 is not there, we have to look for level 2. For non-financial assets, for example buildings, management must consider the highest and best use of the asset by the market participants, market information.
The highest and best use of an asset is the use that a market participant would adopt in order to maximize its value, the highest value that you can get. IFRS 13 requires the entity to consider uses which are physically possible, legally permissible, and financially feasible. That's it with IFRS 13. So all what you need to know is what is fair value, number one. Number two, you need to know the fair value hierarchy. If you know them, you are fine. Are we clear? Understood? Super. So technically we are done with fair value as well. Therefore, I'll see you next week at 1:30 sharp. We are meeting next week 1:30 Saturday. We are meeting on Sunday. The following week also Saturday, Sunday we are meeting. In between weekday, we'll be trying to have 1 or 2 classes just to do more past paper questions. Right. Thank you so much for the day, and I will see you on Saturday. Take care. Bye bye. Enjoy the rest of the week. Study plan. Okay. Now, guys, you have been asking for the study plan. Okay, hold on. Now, the study plan that I'm talking about is a 10-day plan. Okay, that I have. But right now, for you, all what you have to do is go back. How to get through. How do you effectively study? Very simple. You have this start notes. Okay. Now, this start notes gives you details of everything like I covered yesterday. Now, basically, what you can do is you can go in this order. Okay, IAS 16, property, plant, and equipment. You can see what is required and go back, do Kaplan. While doing Kaplan, if you're stuck, come to this. This will have your almost 90% of what you need is here. Try to work around based on this. And then go back, do Kaplan. Do Kaplan, once again, do all my chapter-based notes. All my chapter-based notes, questions that I've given you. Everything you have to do it 100%. Start working in the practice platform. You have to start working on the practice platform. Do on the practice platform, get to it, start doing the questions. Ratios. When doing ratio questions, don't just try to memorize anything. Go take the points. Based on the points, develop your points. Develop your points. Based on the points that you have, you add flesh to it. Make sure that you cover the point, like how I cover the point. If you get stuck, let me know. I have a plan, but I don't want to give you that because, the way you are doing it right now is better. Just go ahead like that. Follow Kaplan. Follow my standards that I've given you. Like this, in this order. Start working on it. That is more than enough for you. We'll be meeting for more questions next week and the following week. Okay? Thank you. Any other problems that we have? Any other things that I have to clarify? Any other clarifications? Right. Thank you so much. See you guys.